What a beautiful lineup. I think we're going to be good to go. Well, Kyle,
Right.
what
a
5 years and amazing work. We've done over 200 episodes together. I can't believe it. Tireless coverage. You're in great hands here, everybody. Enjoy.
All right, so everybody, welcome in. We've got a lot of live participants. We're also streaming live on YouTube as well as with securities.io. So major shout out to all of our partners and our sponsors of the Tokenize This Summit by Security Token Market. My name is Kyle Somlin. I have been building this business with Herwig now for 5 years. Today is actually our 5-year public anniversary of when we went live with the business. So very exciting to be bringing an exciting few-day panel. We've got all kinds of events lined up with some of the best and brightest in the financial markets, as well as the intersection of that with the tokenized world, the blockchain markets, and working with infrastructure around newer technologies to empower that capital market system. So I really wanted to take a second here to just introduce the amazing panelists that we have here today. So starting off with Cass, would you please give us an introduction of yourself?
Thanks so much, Kyle. I'm happy to be here, and good morning, everyone. My name is Cass Sanford. I'm Deputy General Counsel of OTC Markets Group. We are a market operator operating currently 3 ATSs, where approximately 12,000 equity securities are traded by over 100 broker-dealers. We do approximately $2 billion in average daily trading volume on those platforms every day. And really the offering that we provide is a marketplace for securities to be traded in a regulated environment by broker-dealers, any equity security that's not otherwise listed on an exchange. So like I said, that encompasses around 12,000 securities now, but a wide, vast variety from SEC registrants to large internationals like Roche, Adidas, and Heineken that are listed outside of the US, to companies that don't report to the SEC, that are publicly traded, to digital asset trusts like the Grayscale Bitcoin Trust and others, as well as many community banks and bank holding companies. So we offer a very flexible platform for many different issuers. And earlier this year, to add to our suite of trading services, we received approval actually from FINRA to facilitate transactions amongst the broker-dealer subscribers on our market in digital asset securities. So really what that means is any equity security that clears and settles or is otherwise represented in a blockchain-based system. And so we're very excited about the future of tokenization and happy to be here with you.
Amazing, amazing, amazing. Thank you for being here. Really, really excited to dive into all of your perspectives on the industry. Could you just do one thing for me before we move on to the rest of the introductions, is just define in a very high level the difference between a broker-dealer and an ATS, just for someone that's listening that's not quite as familiar on primary versus secondary markets?
Absolutely. So when I say broker-dealer, generally I'm speaking to the liquidity providers that are accessing our system. So we have over 100 broker-dealers and the largest liquidity providers here in the US. So think large market makers like Virtu, Citadel, GTS, all connect to our system, and they send in messages, quotations, and orders into our trading system to seek other counterparties and execute their trades. The trading systems are alternative trading systems, those we operate. So the difference there is it operates like an exchange under a different regulatory environment. But when I say broker-dealers, I'm generally referring to liquidity providers. However, as the operator of an ATS, which my fellow panelists know well, we are registered as a broker-dealer ourselves. So really think of ATS as the marketplace and the broker dealers all connecting to access liquidity through the ATS. That's how I think of it, but interesting.
Amazing.
Different views.
Thank you for that. I think that throughout this conversation and throughout the entire event here, I do think it's important to define some of these things. We're the authors. We recently just published Blockchain Explained, which is now a best-selling book on the blockchain and financial markets. And we spend a lot of it defining these things because even within client calls or intermediaries that are inside of our ecosystem, sometimes there are people on different pages around what the acts and operations of these different pieces of the puzzle are. And I do think it's so important to dive into that. And I would encourage anybody throughout these panels and anybody watching, please keep asking these questions. Sometimes the building blocks are really important to actually getting anything done. So with that, I do want to move over to Richard. Richard, please, would you introduce yourself and Castle Placement?
For sure. I'm Richard Leftig. I'm a managing partner at Castle Placement. We're a 15-year-old company. We are a FINRA broker-dealer. We do one thing, which is we raise private capital for companies. We do so through Reg D 506C, Reg A, and Reg CF. We've had a pretty good success. We've raised multiple billions of dollars for our clients in just about every industry that I can think of. And it's been primary issuance for the most part. We did get approval for our ATS a few months ago. We have not started trading on it, but we're excited about that. That's a long, arduous process from a technology and regulatory compliance and an approval perspective. So we're excited about that. Castle Placement has a quite different approach, I think, than most other investment banks, is that we built the company as a data and technology platform and a full service investment bank. And we fully integrated those two concepts. And it works really well. The main thing I would say is that we've spent 15 years gathering very granular investment criteria data. We have 60,000 plus institutional investors on our platform. And we know what they like to invest in: industry, size, geography, equity versus debt, et cetera. And by using that information, we're able to target the right investors for each client. And we've also built a very robust set of technology tools to facilitate all the transactions. Like, we have 110 live transactions right now. We have 40 bankers and thousands of investors. So you can imagine that it's complex to keep track of all that. And our platform does that nicely. And that has helped facilitate our transactions.
That's all great. And then one little small follow-up to you before we introduce our third panelist. Could you talk a little bit about what, I guess we'll maybe save the blockchain component for later in the meeting. That may be a longer question. I was going to ask you about the tokenization component, but we certainly may dive into that a little bit longer. But what are you excited about with respect to the blockchain technology with your business?
Well, blockchain, equity crowdfunding, traditional capital raising, and NFTs, and several other components are all smashing together. And when you put regulatory compliance and technology in the mix, it's an extraordinarily exciting opportunity for more new issuance and secondary trading, which is really not a gigantic thing right now, but we think is going to be a gigantic thing in every asset class: real estate, art, regular corporations, really every asset class. So could not be more fascinated by how it is all coming together.
Exciting. Yeah, that's a great segue into our third panelist here, Jamie Finn, who is co-founder of Securitize. They've been dominating this space from the tokenization component for many years now. Jamie, could you introduce yourself to the crowd and talk a little bit about where you guys are focused right now?
Sure. Jamie Finn, president and co-founder of Securitize. We work across a variety of different categories here. So we operate a broker-dealer for both retail, accredited, and institutional investors. We have a primary marketplace where you can go in and buy different products. We also have a secondary platform where you can trade, you can buy and sell through a limit order book on our platform. Again, it's available for people to log in and kind of access directly. It's a little different than Cass's world, where they're dealing more with broker dealers. We're dealing more with investors directly. And then we're also a transfer agent through Securitize LLC. And actually, we have a bunch of customers in common with the OTC markets folks, because we act as a transfer agent for a variety of those firms. So I think one of the key concepts here is that there is a real need to kind of work together across this ecosystem and kind of really connect the dots. We're on this topic, I think we're going to dig into liquidity, but I think liquidity begets liquidity. So we need more people connected to get there. And these, different players are all actually very complementary. It's an important thing to note in kind of what we do. And we work with others already. Our TA has multiple products that are listed with us, with T0, with INX, and with OTC markets. So you can see there's a real kind of interconnection there that I think is crucial to talk about.
Great. That's exciting. And you mentioned liquidity, and that's really what the focus of this panel is. I've been in the security token industry now for, as we said, it's the 5-year birthday of STM. And as we've been building this, it's been more than that. And this is the holy grail of tokenized securities. This is kind of what has always been pitched as this really exciting opportunity of leveraging a digital asset to represent what is traditionally a very paper share that is very difficult to move from one place to another. If we can use technology to enable that, there's a huge opportunity here. The problem, as we've explored and as we've seen STM, we track a lot of data on what's going on in the secondary markets, and it's very thin with respect to the liquidity. And there are maybe a lot of reasons for that. We can dive into potentially what some of those things mean. But first, I want to start with Richard and talk about, with the placements that you've done so far on the primary fundraising side, when you have an issuer, when you have a client come and they're looking to fundraise for whether it's debt or equity, whichever structure they do, what are the investors getting with respect to that? And what's their timeline look like to actually potentially receive a return or a payout for one of these more traditional instruments?
Sure. Two totally different answers. One for Reg D 506C, and the second for equity crowdfunding through Reg A and Reg CF. Totally different animals, different process, different technology, different investor base. In the institutional space, it's really a 3 to 5 month process. And the investors are doing an extraordinarily deep dive into the opportunity. So there's a virtual data room, and they're looking at financials, legal, strategy, competitors, cash flows, projected cash flows, and asking thousands of questions and negotiating complex legal documents that are specific to that structure for that transaction. In the equity crowdfunding space, completely different. There's one place where the information is. It's on a landing page at castleplacement.com, and the investors just bop on there, whether it's from an ad or they just come to the Castle Placement website, or they hear about it from a friend, or they read about it, and they read about the opportunity on that landing page. It's all contained. There's an offering circular attached to the landing page through a link, and they can read the offering circular. Some do, some don't. But when they want to invest, they just click on our Invest Now button and put in their information and the amount and the fields that are required for us to do the requisite background checks, AML, KYC, suitability. And then they just pick the way they want to pay for the investment: credit card, ACH, Apple, Google, self-directed IRA, mail in a check, wire the money, whatever they want to choose. And they click and they're done. So it's a much less rigorous analysis. It's much faster, obviously. It's lightning fast. And it's an important distinction because I think secondary liquidity is going to fall much more in the camp that's closer to equity crowdfunding than it is to an institutional due diligence and closing process.
Jamie, would you agree with that perspective, that the secondary markets kind of are starting to look a lot more like the equity crowdfunding process? And has that been your experience with TokenizeThis?
I mean, in terms of trading, I don't see the link directly, because what we see is people come in, maybe in the speed, I suppose, in terms of transaction, because people will come in, they'll have a look at the asset, and then they'll decide if they want to buy or sell based on kind of the information that's available, and not doing a deep dive into the firm, although all the information is available for them to do a deeper dive. I think most people are kind of learning about the firms and then making decisions there. So I think there's a lot of different ways to trade these things, and I think that's a really important nuanced concept. Is like, do you operate a continuous market? How do transactions get processed? How long does it take to settle a trade? Who can buy? Who can sell? How are those things put together? How does the money get transferred? What does settlement look like? I think there's a ton of questions that pop up because not all of these kind of environments are the same, and so it's important to understand kind of the features of each one and what's available. Because just having an ATS isn't. It's hard to touch and see. Like, you need to be able to use it as well, and so that's the piece that, at least for me, I've struggled with understanding over time, is like, how do I actually access and use this product?
Right, that makes a lot of sense. Do you think that may have an impact on the user experience of an investor trying to participate in the secondary markets?
Well, I mean, for an individual investor, there's really a few marketplaces, and they kind of all work the same way, to be honest. Some of them are more crypto. When we talk about tokenized securities specifically, some of them are more kind of crypto experiences, like INX is more of a crypto experience, where like T0 or securitized markets is much more of a like Coinbase type of experience, where you have a centralized kind of market where people come in and trade. You're not using a crypto wallet per se to process a transaction. So they're just very different experiences that are out there.
Right, makes sense. And so, Cass, this is kind of where I want to ping it over to you. When your firm may see a client that's looking to work with OTC markets for that secondary listing and liquidity opportunity, what does that path traditionally look like for them? And is this a viable, feasible opportunity? Are there a lot of kind of headaches in making that process happen due to some of these infrastructural components? And just, could you walk us through that a little bit?
Sure. I think it helps to kind of, if we're talking about just a traditional company, maybe joining our markets, and perhaps it's someone who's raised capital privately through a 506C deal that Richard spoke about. And that's what we see primarily, right? That's where a lot of the dollar volume is, at least in the private markets, is through private capital raises. So I think there's a couple of tracks to look at. If you look at that kind of traditional company they've raised shares privately from investors, and really what we see is, okay, maybe there's not an IPO onto an exchange on the horizon, but their investors are starting to call and ask about liquidity events. What's the plan? Are you going to go public? How can I get liquidity? And so one option is to join the OTC markets, which is a more streamlined, less burdensome and costly method of being public. And it's really an interesting pathway for those types of companies that are not subject to registration requirements with the SEC. So they've not met that threshold that to become a SEC registrant, but they still want to develop a private market. So we have a pretty streamlined process to go public. I think the biggest hurdles from the corporate perspective, from looking at it from the issuer's angle, is really you have to take on ongoing disclosure requirements. Again, they don't necessarily have to be through reporting to the SEC, but you need to publish annual and quarterly reports, because that is the only way to develop a true public market here under the regulations. So if you're transacting privately, you're not necessarily having to go through those disclosure requirements. But if you really want to access the public markets, you're going to have to do that. And then there's a few other back-end things, which I think lead into the conversation about tokenization a bit more, which is, generally speaking, if you want to kind of be able to access that institutional liquidity in the public markets, so have access to those market makers that are really going to be able to transact in those shares, you're going to need to get DTC eligibility. And so I'm jumping right into the kind of back end of the public market.
Let's do it.
It's important because what we're thinking about as we're kind of contemplating the future of public markets, and particularly in the more alternative space that we play in, what does an alternative to DTC look like? And just for those out there, it's the Depository Trust Corporation, and that's really how all institutional firms are able to transact, in milliseconds in the public markets in equity securities in the U.S. So how they're able to clear and settle, and so
One company kind of at the top connecting everything together, right, between all the institutions.
That's right. So I think that's kind of the traditional path. And like I said, we have a lot of different avenues to going public. But I would say if within this context of raising capital privately and then going public, that would be the most traditional path. Of course, you can do a share registration with the SEC. There's many options for non-US companies, but that's really what we're looking at now. And I think it's really about how do we make other rails for securities to perhaps trade, settle, clear. Jamie mentioned transfer agent services that TokenizeThis provides. How do we build, transfer agents 2.0, clearing firms 2.0, and so that we can move away perhaps from this centralized system that we're working on now and explore other more efficient options.
Yeah, so I was exactly what I was going to ask. Like, from your perspective, do you see this almost as an efficiency within a time to settle perspective, and then maybe just a cost of capital perspective for really where the benefits of tokenization are applied in that context?
Yeah, and I think it's also just about building other models that maybe even serve a lower volume or more thinly traded market, right? Like a lot of the securities that trade on our system, and I think a lot of the tokens that we've been speaking about, they're not going to trade in the volumes of Apple and Facebook, right? And so the more centralized systems like DTC, they're really built around those high volume exchange listed stocks. So we're very large proponents of supporting smaller companies that have they're maybe more thinly traded, but brokers still want to trade them. There's still investors to serve. And so other options is really, I think, what we're after as well for different types of market models.
Fascinating. Richard, you also mentioned tokenization potentially being an opportunity from the distribution perspective, perhaps, getting exposure to a wider base of investors, perhaps bringing down the investment minimums required to process a transaction. We've certainly seen TokenizeThis leveraging that with some of the funds that they've worked with on an institutional side. Do you think the real exciting opportunity within tokenization on top of some of the things that Cass mentioned, or do you see it a different way?
Oh, no, I see it exactly the same way. And I think Jamie made a great point, and he even used that controversial word, centralization. I give him kudos for having the courage to say that word out loud. So we've found that the most important thing by far, like 95% of the equation, is the marketing. It's the bringing the investor and the issuer together. And unfortunately, most people in this industry, I don't think, focus on that component. I think most people focus on the technology more than the marketing. And I think it's a big mistake. You can't just, throw up a marketplace and hope that people will come. You can't do a capital raise and hope that people will come. Maybe someday, and there are some platforms that have a built-in audience of participants, and it will be easier for them to access investors. But for the most part, you have to build a system to bring investors to the opportunity. And that has been our focus for 15 years. And it's really hard. 10 years ago, when we built our app, it's called the CPGo app. And we were so proud and excited, and we launched, and no one came. Like, how would they? How could they? How would they know about it? Like, we didn't understand how much hard work was required to communicate to the world, I guess, that there's this really good tool. There's this, whether it's a marketplace or whatever, you got to get the people to the party. And that's really hard. I don't know if anyone read the book, The Cold Start Problem, but that's what it's all about. It's cold start. You've got investors here, you've got issuers here. In the secondary market, you have buyers, you have sellers. You got to get them there. eBay figured it out. We all together, and I think Jamie mentioned collaboration, hugely important. We all together have to figure out how to connect the dots.
Yeah, what you're saying really resonates with me. We actually conducted a crowd fund using TokenizeThis platform, and it was a all hands on deck effort over a very consistent period of time to advocate for the offering. And certainly there are restrictions around how you can communicate and what you can say and all these different pieces, but it took quite some effort to bring that product to market and to see any level of success. And we're very proud of that. But I definitely, what you're saying, it certainly hits close to home with us.
And you learned a lot about escrow agents and transfer agents.
That we did. But we were one of the first, or perhaps the first Web3 offering. We actually issued a token behind it on Avalanche, which we're pretty proud of, that does represent the underlying security. So, I think there is a best of both worlds opportunity there. And so I want to kick it over to Jamie, who's our real thought leader in the tokenization side of this equation. And so looking at how crypto has built extremely deep liquidity in these assets that are certainly much less attractive from just an institutional perspective when you're looking at what they're actually valued at. Maybe perhaps the only reason they're attractive is because of the liquidity that they've been able to bootstrap. What can we borrow from that, or what do you think is needed in order to create more liquid markets in some of these private securities specifically? Do you believe that they're just inherently less liquid because of the fact that they're earlier stage, there's maybe less information coming out, holders have a longer time horizon because they're expecting it to appreciate over time? Or do you think that there are opportunities like empowering more LPs, building market making opportunities, having underwriters? Where do you see the opportunity to build more liquidity in some of these private markets?
Yeah, I mean, I think as a firm, we've spent a lot of time working with funds, and that space I think is a really interesting category when it comes to secondary market transactions, because there's a ton of secondary transactions that happen in the fund space. In fact, there are funds that are set up just to buy and sell secondaries. They're called secondaries funds, right? And so there is inherent liquidity in the market. It's just not at the retail kind of level. So I think what you need really is a high quality product that's well understood by the investor community, and when that product's out there and they know the firms that are in it, they know what's involved in it, they're able to trade it. Because if you were to go in and let's say you take an example, your friend's venture fund who's, in the second year of operation, probably not going to have a ton of liquidity. People don't know the firm's in it. They don't know what's in there versus, I don't know, a KKR fund that's trading on a secondary market where actually there's a ton of institutional investors that know everything about every company in that KKR portfolio and can decide if it's fairly valued or not. Because at the end of the day, there's normally a kind of a liquidity discount that kind of comes up. That is another one of these painful realities is how do you transact, and do you expect, why would I pay you a premium on a certain product versus, taking a discount on it? And I think that one of the key pieces is as the market gets made, you're not going to see things necessarily trade, particularly in the fund space, at NAV. You'll see them trade at a discount, but you'll also see it traded amongst, more intelligent kind of investors who are more savvy or sophisticated, more sophisticated investors who understand the intrinsic value. And the other, piece, and Richard mentioned this, is like, how do you bootstrap liquidity, right? And I think in the crypto world, what they did a great job of is inventing magical internet money, like my co-founder Carlos says all the time, where it's like you come and you buy or you trade, or you put money into a market making, app or DApp, if you will, and then suddenly you get like some random governance token that's worth money that you can sell somewhere else. That's how you bootstrap liquidity, right? And they did a great job of that. And building a two-sided marketplace is extremely difficult. It takes a ton of investment and time and trust. And I think that, at least on our ATS, we see people transacting on a daily basis. The volumes aren't huge, and you wouldn't expect them to be, right? You'd expect them to be kind of smaller transactions. But as you have more products, somebody like OTC Markets, who has, literally tens of thousands of listings, they're going to see a ton more liquidity than, what we're going to see with 8 or 9 things listed. And so it's really about connecting these networks to be able to kind of drive a lot more liquidity into the space and making it a bit more homogeneous so that it's not like a bespoke special relationship to get something to work. No, it should just work, right? The interfaces are there. Stuff should just work. If it's on a blockchain or it's in a traditional format, who really cares? What people care about is the asset and what they're buying or selling, and it should just be easy for them to do that.
Jamie, you just absolutely nailed it. In 2003, all we talked about at our office was Netflix. And people would come in and we're talking about Netflix, and they had no idea, they thought we were a little crazy, but it's no different. Capital raising is no different. You need to have a bunch of subscribers, and you need to have really great content. And the more great content you have, the more subscribers you'll have. And content is issuers or secondary securities for sale, and subscribers are investors or buyers. And just like Netflix had to have some breakout shows where people would come into the office or at a party and say, oh, did you see, you've got to see. That's what is required in our space. It's got to be, hey, I just invested in this really amazing company. I just bought KKR shares in secondary. It's awesome. And you got to get that buzz, and then the investors will come to the platform. And if the investors will come to the platform, then the issuers/sellers will come to the platform. And that's the whole game. And quite frankly, we're not doing a great job, I don't think, as an industry. I think a lot of it is because of the regulatory challenges. I think, people spent 5 years building secondary platforms, and then they ran into blue sky laws, and they had to kind of hit the brakes real hard and say, what are we doing here? And in secondary sale of corporate securities, people figured out that there are rights of first refusal that the companies hold and other legal impediments to just freely trading stuff. and it got a little ahead of itself, just like the ICO market got way ahead of itself without thinking about the regulatory compliance and legal ramifications. So there's a roadmap. It's definitely going to happen. No question, it's going to happen, but it's challenging.
Yeah, I think you make some great points. Certainly, this has been a common talking point in the private security, specifically in tokenization, where many of the deals coming to market are risk capital deals, right? They're entrepreneurs or they're companies that are kind of looking at all of their opportunities to raise capital, presumably because some of the traditional methodology hasn't been as prosperous for them. And so we've heard this quite a few times. I think it really is interesting to hear you saying it as someone that's spent a lot of time on the traditional side of the industry, that quality of deal and quality of messaging are so important. I do, though, think that there is an infrastructural component here, especially on the secondary side, because, and I want to kick this over to Cass and hear her perspective, because I know that there are, and I'm certainly no expert, and none of us on this panel are necessarily providing any legal or financial advice. But as far as I understand, from ATS as a secondary marketplace, there is a differentiation between order books and order matching. And then I believe that OTC, you guys have now an intra-broker quotational system. So could you talk us through a little bit about what those secondary mechanics look like? Because I think that can have a pretty significant impact on price discovery and how quickly an asset can change hands, which may also play a part in secondary market activity.
Sure. It's not often that I get asked to talk about our inter-dealer quotation system, but
I'm a finance nerd, and so is everybody else listening. So.
That is that is the technical regulatory term. It's called the inter-dealer quotation system, and that's our core trading system. We've had that for years. So that is really, that term in statutes dates back to the 70s, and really the idea is that you've got a network of liquidity providers, brokers. They're all connecting to publish quotations. And those are all terms of art. So I'll try and break it down for you. Which is the key part is publishing quotations. So think about it as a very high tech, high speed message board. And that's really what's happening. And so you have broker A putting out a bid in a security and posting that up and saying, here's my interest. And then broker B on the other side putting up their ask. And those two parties are meeting. They may even be messaging each other to find a price point where they can trade. And so it's not that is a fine distinction between an exchange model or a traditional matching engine ATS, where the two orders just come in blind and match in the middle. It is about posting quotations, and that type of model, it tends to work better for more thinly traded securities and for alternatives. And so that's actually, that's the ATS that we received approval to trade digital asset securities on. And the kind of, the great part about that system and the way that it works is that it allows for collaboration with other market participants. So just to get back to Jamie's original point, we are wanting to work with and connect to any different type of market, whether you're a market maker and you're providing liquidity as a service, you're standing out there to quote and get that liquidity going in the various asset, or whether you're another marketplace ATS and you're sending your exhaust to us because you perhaps had a quote that didn't match on your system and you want to reach a broader audience. So connecting that system that we use, that's really just, we're not receiving transaction fees on those matches on that system. What it is about obtaining the network effect. And so, like I said earlier, we have over 100 broker dealers that also have their own ATSs. Some of them that are connecting to that system just to source greater liquidity. And once you get that price transparency out there, I think that's what accessing the network of liquidity providers and then getting price transparency out. So investors can actually see, okay, this is the current bid ask, and here's the spread for this asset. That's really when you start to develop that network. And so what we're just really excited as well to collaborate with folks that are more acting in the private markets and looking to transition some of those assets to the public markets, as well as those that have alternative models, right? I think it's like we need to start, it's a very flexible system that we have because it operates just as that quotation medium, right? It's not very prescriptive. You can post a bid and an ask, and then you can clear and settle that with your counterparty on whatever system you choose. Generally it's DTC, but like I mentioned earlier, but it could also be a blockchain based system, and that very like the interdealer quotation system model accommodates various, market models.
Yeah, no, I think that was a great breakdown, and I think you're spot on. I believe that most, certainly retail investors, are much more focused on market orders as opposed to limit orders with respect to the price. They're more interested in, I want to buy these shares to I want to get involved with this company, but I want my order to be filled. I don't really want to have to haggle over specific prices or filling different orders at different quantities, as sometimes you might see with an order book style of model. The other question that my mind went to immediately when I'm hearing about this kind of we find a price in the middle style thing is I'm thinking bid ask spread, which makes me think, well, is there an opportunity potentially to layer in third-party market makers that could inject some additional liquidity into this system? Does that present an opportunity that you see in the relative term, or is that maybe a longer term wishful thinking kind of strategy?
No, I think that's one of the problems we're trying to tackle now. A lot of the newer blockchain-based models out there are focused on serving the retail investors, which is fantastic. But we're trying to introduce the different kind of framework with which market makers operate, right? So to get those models to speak to each other is going to take a little bit of, I think, operational just understanding, because the market makers have a very different, they don't want to know who the end customer is, right? And so there's understanding how retail brokers work and the markets that are serving directly the retail customers, and how to connect those to the real liquidity providers, the market makers, is going to be huge, I think.
Jamie, what has tokenization allowed your business to capitalize on with respect to this process? So you guys are a broker on the primary side. You certainly have the transfer agent to manage the underlying cap table. You've got the secondary market ATS. You have the tokenization engine to create these tokens and host them in a wallet. Where do you see the opportunities with tokenization? Is it leveraging stable coins for payment, which maybe kind of streamlines the payment rails? Is it the managing of the cap table by having, more of a smart contract style system? Or what do you see tokenization providing to this process now that you have a lot of the end-to-end process all in-house?
Yeah, I mean, I think what we see is it's really important to understand kind of the key thing that the blockchain brings to private securities, which you don't have in the traditional world. And that's, you have provenance, right? So you can absolutely prove who owns what and if the asset's encumbered or not, right? So at any point in time, the token serves as proof that whoever it is who's transacting owns it. And then that means that they can do something with it. Now, what you can do with it, I think we've only seen kind of the early use cases of. And just like we've seen in lots of other industries, be it, music, which has evolved tremendously, or communications, which has evolved, tremendously once it became digitized. I'm sure we're going to see the same thing here. So like the most basic thing to do with the token is be able to transfer it from person to person. Great. Next step up is trading, buying and selling from, people who don't know each other, or groups that don't know each other. The next step there is borrowing. Right? Borrowing and lending. That's a really interesting space. How do you do borrowing and lending? Well, I don't know yet legally, but I can tell you that the first step to be able to borrow something or lend something to somebody is to prove that you own it. And once we can prove that you own it, then you can do something with it. And then you don't want the same thing happening two times, right? So if we do a deal where I take a loan from you for $100,000, against my KKR position, then you don't want me going on an ATS and selling that position to somebody else without you knowing, right? And so blockchain technology prevents that from happening programmatically, which is great. In the real world, you could do weird stuff like that because it's paper-based. So you could sign a piece of paper with one guy, make a trade with another person, and in the end, someone's got to clean it up in a lawsuit. So I think, from that point of view, we're at the very, very early stages of this. There's good applications that have come up. I think they're the most obvious ones. I don't think all of the use cases or kind of apps, if you will, have kind of come to market yet. And it's interesting to see the different worlds, right? So the US has a very, its blockchain regulation doesn't really allow for certain things that would be really cool. Like the ability to transact on an ATS directly using Web3 technologies, you can't really do here. You have weird intermediaries to make it happen, or you do a centralized approach. In Europe, we operate we've launched it. Everything's up and going, where we have a broker dealer in Europe as well, which offers primary and secondary. And the European regulator has demanded, this is totally weird, that the ability to transact, with an atomic swap is the primary way that it should work. And if you just take a second to think about that, it makes a lot of sense, because when you're using a Web3 app, you basically are transacting dollars for securities instantly, and they move from one person to the other instantly. And there's no clearing or anybody in the middle. There's no transfer agent that has to manage that. It's a direct transaction between the two. And it's a lot more efficient, and that really eliminates cost. I think that one of the issues we have, and that I've observed, at least in the space, is when people move into the tokenization market, they look to replicate all of the infrastructure they have in the traditional market and then add a token. That is a huge mistake, because you're just adding more cost on top of it. And for this tech to succeed, it really needs to be cheaper, better, and faster. And the only way to do that is to get rid of intermediaries that don't provide value. But the regulation here does give you some challenges with respect to that. I think most of it can be overcome. At least we've seen it, and we've been executing some of that stuff for years. But when you get, a really traditional asset manager wants to do something where they have a token, they kind of want to do it all the same way. And so re-engineering that process and that way of thinking, I think, is going to be one of the biggest challenges overall.
That's a really, really great perspective. I think that anybody listening is really getting quite valuable insight from all three of you. We have about 13 minutes left here in the panel. I just want to take a second to let everybody know that's listening here. We have a full schedule of events. This is not the only panel that we're going to be talking about today. We're covering real estate. We're covering compliance and back office. We're covering the technology and everything inside of this amazing industry here at TokenizeThis Summit. So I wanted to thank our sponsors, Oasis Pro Markets, Red Swan, and a whole host of others. You can find all the information throughout the event, and we're certainly going to give plenty of coverage to all the different keynote speakers throughout the day. So I want to kick it over and back to Richard. So talking about the fundraising environment today in 2023, and certainly less than liquid environments than we've seen in the early 20s, and with some of the more liquid environments, and certainly from a fundraising perspective, what are your outlook for 2024 on what this environment might look like? Are you bracing for trying to find new and innovative strategies to capture the same amount of capital? Or are you feeling like, this is maybe just, burning out some of the non-serious players, but your capital stack and base will be fine? What's your perspective for 2024?
Sure. So, we were born coming out of 2008 and the collapse of the entire system. And we've kind of always thrived in the esoteric or contrarian strategies. So this is all fine for us. We actually rather, we don't want to see anyone suffer from losses or pain, but our investors like that. And just a perfect example. So I don't know if anyone's following the mortgage banking space, but it is the worst it's ever been by far, including 2008. Mortgage bank platforms are just suffering immensely. No volume and very high costs, and it's just a real problem market. So one of our clients is very contrarian. They're a large mortgage bank, and they hired us to raise $100 million to go out and buy a bunch of platforms that are challenged right now. And that is attracting incredible investor interest. Whereas other sectors, to your point, are not. It's just, so I would expect that 2024 will be more of the same. Certain types of strategies, certain markets, certain industries will be in favor, and investors will be quite active. Certain sectors, you don't want to go near it. That's my thought.
Does anyone else on our panel have any thoughts around that? Not particularly. So then let's go into the other question I had. And Jamie, I wanted to start here with you, and then maybe we can kick it over to Cass and get her thoughts. Here at Security Token Market, we're tracking all kinds of tokenized assets. And what has really caught our attention over the last 18 months has been the meteoric rise of institutional debt financing leveraging tokenization. We're seeing banks all around the world exploring test cases with institutional debt. UBS has done half a dozen, for example, and many other banks are underwriting and providing services for this. We're seeing Swift network trialing payments infrastructure using public blockchains, private blockchains, enterprise chains. We certainly are seeing, to your point, the MiFID frameworks coming out of the EU, the regulatory systems, the sandboxes in the Monetary Authority of Singapore, and everything going on worldwide. What are your thoughts on this kind of banking application of the tokenization technology, and how does that impact the rest of the market?
It's a pretty big question. Look, I think that the firms are looking for more efficient ways to transact and to be able to deal with these assets. And I think that right now, a lot of the things you've mentioned were really kind of in the kind of science projects phase still. I don't think we've seen, anybody really do something at scale seriously and just commit to it. I do believe we're going to see that in the very near term, because I think we've seen a lot of sort of subpar products come out that are attracting significant interest. So if you were to look at, what's going on with money market funds outside of the US, right? Because the interest rates here are so high, there's a bunch of real world asset tokens, which are not the real thing, but they position themselves as the real thing. That seems to be working. People seem to be really locked into that. I'm confident that, we're going to see the real thing kind of come to market in a real native crypto way, not something where it's sort of encumbered and locked into a specific app or use case, because the power of all of this stuff really is about it being open and accessible. If you're going to do it in your own app with your own stuff, don't bother to make a token. It's just extra cost. Just use a database. So, I think that that's really the core piece, is this kind of global access to real tokenized product. Seeing stuff on, private permission blockchains, not really that excited about. We've never been that excited about it because you can't do anything with it. And so the whole developer community gets thrown out the window. So, I think that doing things properly, bringing it and making it the real thing, not somebody else's version of it. Like Coke is the real thing. Like, you got to have the real thing with the real brands, with the real firms getting into the space. And then you're going to see real innovation and adoption at scale. So in my opinion, those are the types of things that are missing in this space right now. But it feels like, we're going to see this evolve very quickly. I mean, I think if you look at the evolution of the ETF market and kind of what happened there, is not going to be, I think you're going to have kind of a very similar trajectory in this world on the blockchain side to what happened to ETFs. And it really just went from nothing to, scaled up. And I don't think people anticipated it. And now they're kind of tapping out because of the cost associated with it. So you want to lower cost, reduce friction. Tokenization is a really good example of a way to do that.
Yeah, I would just supplement what Jamie just said, because he's exactly right. 5 years ago, we had a potential client, very, very good friend of of ours. And he started a new company in the pharmaceutical space, and it's a great company, and he wanted to raise $35 million, and he wanted to hire Castle Placement to do it. And he's a very innovative guy, and he wanted to sell tokens instead of selling securities. Or instead of selling, I shouldn't say that, instead of
Traditional format.
Instead of selling paper.
Traditional format, thank you, exactly. So we said no. And the reason is, at that time, we didn't have investors that had wallets. They didn't, we would have to present the investment opportunity to them and then teach them how to open a wallet. And that putt is way too long. So we just said no. And it turns out that someone else said that they would do it, and he tried to do it, and unfortunately we were right. And now fast forward 5 years, I still think the type of investors that play in this space, for the most part, don't have wallets. So that's just one example of I think what Jamie was articulating. A lot of components have to come together for this to really take off.
Awesome. Awesome. Well, this has been a great panel. We've got just a couple minutes left, so I want to give last words to our three panelists. So Cass, do you have any final perspectives? And otherwise, what if people wanted to reach out to you? Who are you looking to connect with? We've got a lot of great institutional people that are in the audience here, some great speakers coming up, as well as a lot of industry participants, potential issuers, all kinds of clients, partners, and investors. So what are you looking for, and what are your kind of final thoughts here?
I love to connect with anyone who's trying to really solve and create, a good use case for this technology. Honestly, I think the provenance question was raised earlier. Folks that are trying to figure out chain of custody. These are wonderful things that this technology does, and that they're trying to be players that are trying to be transfer agents, broker dealers, ATSs, but that don't look like traditional transfer agents, broker dealers, and ATSs, that are trying to be more efficient. And rather than, I think this has been a theme, but rather than leading with the technology, try and lead with the problem that you're trying to solve, right? We see, our subscribers would love to be able to look under the hood and see, oh, this is the same person that has owned the security, or here's who owned it, and here's the chain of custody. That way I know that I'm safe in facilitating the transfer of this. That's the problem. It isn't, however you solve that, if you're trying to figure out how to solve those problems that exist, there's friction points in our markets today that I do believe can be solved with some of these innovative products. But so those types of folks that are working on solving that, and you're going to figure out how to be registered as a transfer agent or an ATS or a broker dealer, but you might not look like the traditional one. Those are the people that we'd love to work with. Like I said, we have a very decentralized approach to this, meaning that come connect and facilitate, connection with your counterparty through our markets, but bring whatever model that you have. So we're always interested in talking to anyone who's doing anything innovative there.
Wonderful. Richard, final thoughts, people you want to work with, give us the sauce.
Well, we always want to work with great companies or people who have great projects that are seeking capital. That's what we do. My final thought is that, first of all, you guys are all super smart and well spoken, and I learned a lot. For us, it comes down to a couple of things that the people on this panel discussed: quality, credibility. That's what is going to attract investors in the secondary market, and the technology, although complex, plays a huge role in facilitating trust and credibility. And that's the opportunity.
Wonderful. And finally, Mr. Jamie Finn, can you close us out?
I would invite kind of everybody to try it out. Our platforms are live and operational, which is a nice thing that everybody on this call can access. And we're always looking for great kind of right now, we're very focused on funds and asset managers. We think that category lends itself very well to tokenization at this point. We've worked with obviously great companies on like yourselves, and Exodus tokenizing equity works out great. We did a huge Reg A with them. So the products are there, the platform's there, come and check it out and try it. And I think that's the key thing here is we're all learning together, and you got to use this stuff.
Wonderful. Well, thank you for everybody for tuning in. Thank you to my amazing panel. We are queuing up another panel as I speak. So we're going to take a quick break here on the video to get the next panel in. Anybody check out Blockchain Explained, our new best-selling book, if you want to learn more about the technology. And we'll talk to you with the next panel. And hopefully good. Perhaps we can all leave. Thank you to everybody in the panel. And
thanks, guys. Appreciate it. I'll Cass, I know you well. Richard, I'd love to connect with you. I'll send you a note. Maybe we can chat.
Likewise. Great job, everyone.
That'd be fantastic. Bye.
Thanks.
thank you. So I'm not sure if I'm still online or not, but if I am, I can regale the crowd with a great breakdown of Blockchain Explained. So the funny story here is that Herwig, my business partners, Herwig and Peter and I, 19 months ago, started writing this book, which actually worked out to be pretty good timing for the industry, because while, of course, over the last couple of months, there has been some issues with respect to the technology, or at least the financial price of the technology. We've been in a little bit of a bear market as of recently. So, it actually worked out pretty good to write a book, because that's fortunately when a little bit less of the innovation is happening, because there's not quite as much venture capital dollars that are being deployed, because the innovation isn't exactly accelerating at such a pace. It gave us a good tranche to be able to work on the book. So we talk about everything in there, specifically security tokens, as that's been our focus over the half a decade now of security token market and everything on board. But we really cover everything from blockchain fundamentals to the cryptocurrencies to the blockchain, and how all of the business use cases of these things come together. And so it's been a really exciting journey. It took us 19 months to get it done. We cover a narrative of 150, 200 pages of what's actually going on, and then define every terminology of everything throughout the book, and have graphics and images, and it's been exciting. We've used it as an opportunity to teach at local universities here in Miami, between University of Miami and FIU and others. And it's also presented a great opportunity, I think, to help define a lot of the jargon. As we talked about on that most recent panel, it's not always clear what everyone's talking about. And even when you have seasoned professionals who are, raising millions of,
not realizing that the Lehman Brothers lease in Canary Wharf in London was guaranteed by AIG. That type of domino effect, I think, can be eliminated by perfecting the documentation of counterparty documents, swap agreements, repo agreements, etc., into smart contracts. When I was at Credit Suisse and at the Bank of America, one of the key abbreviations that was often thrown about was called STP, or straight through processing. The nirvana was that the operations, product control, compliance, or the whole back office for that matter, would have fewer people touching each individual trade. What we found, and this is verified through a PwC study, is that there would be an 80% productivity gain using digital security tokens versus traditional securities. in the areas of operations, product control, compliance, etc. So we are moving into a new phase in the capital markets and the financial markets. And I can address some of those issues now. I'd like for this to be an interactive conversation. So for those of you who have questions throughout my presentation, please put them into the chat. Jason can filter them and he can feel free to interject at any time. So I don't know, many of you may have seen Citibank put out a long report a couple of months ago. And by their estimation, they're looking at tokenization of real world assets to reach $10 trillion by 2030. So in 7 years, they're thinking about seeing this market grow to $10 trillion. It's truly amazing. Some of you may have seen the recent news this morning from JP Morgan, where they announced a tokenized money market fund as collateral. This added this additional utility to a traditional product that gives it, an asset class that is typically underutilized as a collateral form is truly amazing and could be a game changer. Margin calls are going to be completed in seconds rather than overnight. So this technology is trickling into one of the most important interactions between major financial institutions, which is the repo market. Citi, JP Morgan, Goldman Sachs have all announced various initiatives in the digital space. Citi came out with a tokenization service announcement last week. JP Morgan obviously has the Onyx blockchain that they're building internally. Goldman Sachs is using the DAML platform for their tokenized efforts. So what does this mean for real world assets? TradFi firms are way ahead of where the market believes they are right now. Many of them have been working in this blockchain space for 5 to 8 years. One of the biggest use cases that we're seeing is the tokenization of the portfolios of private equity companies, or even potentially tokenizing new funds. So think of a KKR private equity fund that's a healthcare fund. Perhaps it's the $250 million fund. The minimum ticket size that for an investor would probably be in the neighborhood of $250,000. That puts most Americans and average investors outside of that circle of these attractive alternative investments. Tokenizing that fund or that ticket into a fraction of 5 or 10% makes it much more affordable for your Main Street investor. So you're going to begin to hear the term democratization of the private equity markets or the private markets used more and more. And I think that's extremely important. I think giving normal investors the access to the returns that have traditionally been generated by these private securities is extremely important. And it also opens up a new pool of capital to these large asset managers and private equity funds. We are seeing a number of use cases for yield-based securities. If you think of a mortgage-backed security or an asset-backed security that's tokenized with a smart contract, it will all but eliminate the need for a third-party asset servicer, because the principal and interest payments will all be made online. Simply, the CFO in an office can hit a button on his PC and make the principal and interest distributions himself. Everything will settle on chain via the smart contracts. We talked about a little bit about counterparty risk earlier today when I talked about the financial crisis. It's even recently, within the last 12 months, I think you all saw the GameStop Robinhood fiasco, where a number of trades failed, large number of trades failed, because the counterparties didn't have the ability to settle the trade, or they didn't have the cash, or they didn't have the securities. With digital security tokens and using an exchange such as Oasis Pro Markets, both parties have a pre-verified digital ability to settle a transaction. In other words, I know that you've got the security. You know that I've got the digital security, the digital currency. Therefore, we make a match, an atomic swap, and in seconds, the trade is settled and nothing fails. That's one of the biggest benefits I see in the space of digital security tokens using digital currency. Jason, I don't know if any questions have come up, but I'm happy to answer any at this point. Unless, Jason, you have some topics you'd like to raise with me.
Yeah,
Hearing.
no questions yet from the audience, but if you can talk a little bit more on OPM's business model, where you guys are headed, what you see the future of capital markets looking like, and your involvement in that.
Sure. So we have an institutional focus, really. We are working with some of the largest and well-known financial institutions in the world who have expressed interest in participating in these markets using our technology, which is state-of-the-art, best in class. We've gotten comments from the number 2 person at one of the largest asset managers in the world, telling us that our tech stack is really cool. When you hear that from somebody, especially somebody with gray hair like myself, it really resonates. And I think, to that point, I was at a Connecticut Crypto Forum breakfast last Friday. It's held every Friday. It's held every month on Fridays. This wasn't your typical digital asset or crypto crowd of 20-somethings wandering around in hoodies. It was many people like myself, gray hair, blazers, maybe a vest, but certainly a collar. We're interested in this, how this technology is going to transform the financial markets. Even the founder of Knight Capital was in the audience. Of those of you who know Knight Capital, one of the biggest market makers in the world, was there listening intently to how this technology is transforming the capital markets. One of the regions that's really exceeding the rest of the world is Asia. Asia seems to be well ahead of Europe and the Americas with respect to digital asset adoption. Much of it is running through Singapore. The Monetary Authority of Singapore, as many of you know, is running Project Guardian, which is a pilot that will test the guardrails and the infrastructure around the issuance of various digital securities in different asset classes. It is making its way to Korea. It is making its way to Taiwan. And I'm sure it will begin to spread west. I think one of the big, we spoke to the Singapore Stock Exchange or the Bond Exchange a couple of years ago. They were really well ahead of where the rest of the world was. And I'm not surprised that this pilot is being run in a regulatory compliant manner with proper oversight. I'll pause there and just see if anybody has come on with any questions.
Can you talk a bit more about, who you're working with, some partnerships, anything going on there? What's your collaboration look like within the,
Sure.
the industry?
Sure. So we have a number of partners. Some of them I can't disclose. Many of them are large financial institutions, but others I'm happy to chat about. We have a great partnership with Invenium. Invenium is a platform to this price discovery and data validation on private security assets, including real estate. They have been fantastic with us. We refer business to each other. They've got an incredibly talented team. And I can't be more proud to be partners with people like Pat O'Meara, Frank Walchuk, Todd Stevens, among others over at Invenium. Redwood Trust is one of the biggest issues of mortgage-backed securities in the country. They invested in our Series A round. They recognize the benefits of digital security tokens in the issuance of mortgage-backed securities. Again, as I alluded to earlier, the elimination of third-party asset servicing is a huge cost savings that can be passed on to investors in the form of additional yield. Murray Asset Management, which is like a BlackRock of Korea, is one of our investors. We are talking to them about potentially using our technology stack in some initiatives that are being run out of Seoul, Korea right now. Avalanche, the blockchain protocol, The Blizzard Venture Fund, which is part of Avalanche, is one of our major investors. Again, we work with them to source issuers for our platform that will go on to Avalanche. That's an overview of where we are basically with a number of our partners that have been publicly announced. A number of other announcements will be out in the next 4 to 6 weeks that we're very excited about. It will be names that everybody here is familiar with, projects that everybody here is familiar with. And it's a testimony to the great momentum that we have not only here at Oasis Pro, but within the digital asset markets as well.
Fantastic. We have a question from Jonathan. What does Oasis see as time horizon for security tokens pre-regulation or post-regulation, or some projected timelines? What are the leading platforms looking for in issuances for new or potential asset managers raising capital?
A great question. I think the regulatory environment remains unsettled. I think the adoption of CBDC, central bank digital currencies, is coming. I do know that the reason we put a digital transfer agent into our tech stack and as part of one of our offerings is that the SEC is not going to recognize the blockchain as the authoritative ledger. Even though we all know it's an immutable record, there is a hesitancy right now to use the blockchain as the authoritative ledger. Therefore, transfer agents are still going to be required. Therefore, we put together a digital transfer agent. The regulatory environment will continue to evolve. I think one of the most important things is that we need to separate digital asset technology, blockchain technology, from cryptocurrency and from FTX. The FTX debacle and the crypto winter set a number of platforms back, only because there was a lack of knowledge or maybe education. Blockchain is not crypto. Blockchain is not FTX. FTX is a fraud that's happened time and time again in the financial markets. MF Global, which was the John Corzine Fund, was the most recent example of commingling of customer funds and the firm's losses. We've seen it over and over again. It's just a lack of control, a lack of real oversight that led to that. I think it's important for everybody to recognize the benefits of the digital security tokens with real custodians, with a compliance framework, will provide the guide rails necessary to eliminate those kind of risks. With respect to asset managers raising funds and raising capital, again, as I said earlier, I think using digital security tokens will open up a new pool of investors who can participate in some of these fundraisers on a fractionalized basis, rather than on writing those big checks, like I mentioned earlier, $250,000.
Thank you, Bob. And we have another question from Daphne. How are TradFi players working with U.S. regulators to shape what compliance looks like for blockchain transactions and tokenization?
Another great question. We have a very robust compliance function here, a robust compliance team. Many of the big banks are definitely interested in how their compliance teams, their compliance requirements match up against blockchain and digital assets. Obviously, I think there's some concern about using public blockchains. Therefore, private or permission blockchains are more attractive, which is why you see what JP Morgan has done by building their own blockchain called Onyx. I think that gives some of their compliance folks a level of comfort. I think one of the most important things, and I did not mention this earlier, but digital security tokens in our platform still needs KYC AML, which we do. We KYC AML everybody that comes to the platform, whether they're investors or issuers. We follow the same compliance framework that you would follow in the traditional markets. And I think that's what the big banks are focused on, is that what changes in their mindset from a traditional offering versus a digital offering. I think in many respects, it's the same. It's just the ability or the desire to understand the technology. I think that is maybe raising some concern. I often use the phrase education, regulation, implementation when it comes to the digital asset ecosystem. Education is getting investors, traditional finance players, compliance people, regulators up to speed on what the benefits really are. Regulation is when the regulators get comfortable with this technology and allow it to move forward, is when we'll get to implementation. So I like to use those words, actually have them written on a whiteboard in our office here. Education, regulation, implementation. That's, that's why it's probably a 10-year time frame from the time we move from where we are now in this very nascent industry to where we have, as Citibank suggested, a $10 trillion market by 2030 in security tokens.
Thank you, Bob. And we have another question from Josh. Hey, Bob, how does DTCC and on-chain security transactions work together or compete against each other? Will DTCC go full blockchain, or will the two settlement systems compete for the market share in the private securities space?
Great question. We're part of the DTCC private security tokenized tokenization project, certainly for private markets. We have lended our subject matter expertise, our technology folks, to provide them with the guidance and instructions on how their model should work. I think overall, in general, DTCC and the equity markets, which I think are very efficient as they are, I think they're very focused right now on settlement times. I know they're driving very hard right now towards T+1, and from T+1 they can probably go to T+0, and they can do that pretty quickly. They are definitely focused on this. They understand the implications for it, and they need to be part of it, and they recognize that.
Fantastic. Another question from Xander. Let's say Redwood does a hybrid primary issuance on and off chain, off SEMT shelf, and I'll want to participate. Who am I able to trade with?
Great question. One of the attractions of using somebody like Redwood, which has an existing investor base on the buy side that recognizes the benefits and the efficiencies of using digital security tokens versus a traditional method, would be more than happy to plug into our platform, use our state-of-the-art matching engine or our RFQ, request for quote technology, to provide liquidity or to get liquidity when it comes to their holdings. For a traditional investor, you may want to use the paper or the traditional security. The question is, how do you trade it? You need to call around to 2 or 3 different banks, and you might need to get attorneys involved and do the transfer, which could take a couple of weeks. Here we have a platform that allows you to do it online, instantaneously, with all but eliminating counterparty risk. We have another question here. I'm sorry. I'm sorry, I'm just struggling with reading this one. Give me 1 second. Somebody's asking, is it safe to say that tokenized real estate is likely have a significantly longer tail versus tokenized bond and treasuries with shorter duration, as the next bull cycle compels new market makers? Another good question. I think it's difficult to say. I think market making activity needs to evolve along with platforms such as ourselves to understand the implications of digital securities, how to trade them, how to create liquidity, how the liquidity pools are traded, et cetera. So I would say, tokenized real estate offering is very much like a bond. You're essentially tokenizing an LLP or LLC. You're not actually tokenizing a real piece of real estate. You're not tokenizing a mall or a commercial building. You're tokenizing the LLC that has a direct interest in the cash flows being thrown off by those properties. So it's very much like a bond. So I think it would be relatively similar to what you're saying with respect to tokenized bonds and treasuries.
Fantastic. Awesome.
And, yeah, it's like, yeah.
Yep. So we have
Yeah, Ashish looks like he's got a question. Do I have time to answer it? So Ashish, what's been your biggest challenge to get this platform up till date? Where do you see your biggest challenges going forward? Another great question. I think anytime you're scaling a business and you're growing it, the most important thing is to hire the right people. We've hired a tremendous technology team. We have a CTO, Viren Kandawal here, who was best in class, a true visionary, who surrounds himself with technology experts and has brought relationships with third-party vendors that has helped us scale this platform and bring it to life. I think our future is bright, really, as a result of the hard work of every one of our employees, the vision and leadership of our CEO, Pat LaVecchia, who's often viewed as a subject matter expert and is often sought out for his opinions, thoughts, etc. Not only by venues such as this and various conferences, but by the regulators such as FINRA, who have reached out to us and to Pat on more than one occasion to participate on panels to discuss the evolution of the capital markets into digital asset markets.
fantastic. And then I believe I have another question here from Xander. Are you currently in talks with any brokers in structured product space regarding onboarding? I know some regional or mid-sized names may have interest and are worth exploring. Excuse me.
We have we've been approached by a number of issuers with various types of structured products. We've had conversations with the boutique structured product shops, but our team is actually focused on institutions where we have relationships at places like Citi and Jefferies, Morgan Stanley, et cetera. And we've been reaching out to them with respect to some of the structured product offerings that we have on our plate. I don't think we're quite ready or mature enough yet to have some of the smaller niche players involved, but we'll get there.
Fantastic. Well, Bob, leave us off with any last comments, and then I'm going to go ahead and start backstage for our next panel or our next session.
No, look, I just want to thank Jason, you and your team for providing this opportunity. It's a great webinar. We're very proud to participate in it. If anybody has any additional questions, I can always be reached, bob@oasispromarkets.com. Happy to chat. I'd like to thank you, Jason, and thank the participants of this webinar. Thank you all.
Thank you, Bob. And that concludes this session, everyone. Give us a second while we transition on to the next one. And we'll see you there shortly, which will
happy to connect with anyone who's interested in this space and go into greater depth. There's a lot to talk about. Liquid is a federated open source settlement network that allows people to issue and custody assets and trade assets with strong privacy, auditability, and security guarantees, which is a very dense technical sentence. But what it really gets down to is that businesses that are issuing and trading assets that have been tokenized on Liquid can enforce their own compliance without needing to supervise their counterparties or trust a centralized authority. There is no centralized authority enforcing the rules on the Liquid network, and yet all participants on the network can have total cryptographic confidence that the rules that they need in order for their tokenized assets to be compliant within their personal jurisdictions can be true without needing to have any visibility into or insight into the jurisdictional responsibilities of their counterparties. Everyone sorts their own business out and remains perfectly private while doing so. So that means those who issue assets on Liquid can perfectly audit their investor base, and they can enforce whatever compliance rules they need, obviously KYC, AML rules, but then also potentially rules about transfer sizes or accumulation of control of a particular asset without needing custodial control over that asset and without needing the asset table to be visible to the network at large or to third parties. They can prove the total quantity of the asset that has been issued and or burned, and hence by implication the supply, without needing to disclose investor holdings, which means that they can prevent rehypothecation and give investors confidence in the share of the supply that they actually own without needing to sacrifice the privacy that you would normally need to sacrifice and without anybody needing to relinquish custodial authority over their own assets. Investors can trade assets on the Liquid network between multiple parties and multiple assets in a single atomic transaction, which is both useful in and of itself because it eliminates counterparty and escrow risk, but it is also the fundamental building block of more complex and interesting financial derivatives like options and futures and things like that. Transactions on Liquid reach settlement finality in 1 to 2 minutes. So there are blocks on Liquid approximately every 1 minute. So depending on your security model, 1 to 2 minutes is reasonable. In general, unlike in most crypto economic networks, Liquid does not have reorgs. The nature of federated consensus is much more coordinated, which means that finality happens much more quickly. Also on Liquid, all transactions are confidential by default, which means that the asset quantities and types that have been traded in a given transaction are obfuscated from the rest of the network, including the validators that actually operate the network, which means nobody can know what transactions you're actually making on the network or what the economic nature of your behavior means. It means you're protected both from sort of simple front running and leaking corporate intel, but also from more complex sort of systemic threats like maximal extractable value or MEV, which has proven to be a real destabilizing force on many smart contract networks. On Liquid, the validators have relatively little visibility into the meaning of transactions and relatively little discretion over the nature of how they're validated, which means they have relatively little opportunity to interfere with the function of the network in order to benefit themselves. The MEV threat is functionally reduced as a result. In general, the most valuable thing that the network allows you to do is to self-custody assets and to trade them without needing an escrow service and without having counterparty risk, which means you can eliminate counterparty and rehypothecation risks for the assets that are tokenized on the network. What the tokens mean in the real world is a definitional agreement between the investor and the issuer. The network itself does not have any understanding in what tokens are meant to represent, but it does enforce the rules of how they behave, guarantee their supply, and guarantee that they are only transacted with in ways that are deemed valid by the rules of the token itself. As for Liquid itself, Liquid operates through a federated consensus, which means it does not have any proof of work mining. It has none of the environmental footprint of proof of work mining. It also does not require any equity-like staking token in order to power or incentivize consensus, which means it has regulatory clarity. It uses as its base transaction fee token Liquid Bitcoin, which are pegged 1-to-1 with Bitcoin, in which anyone can create by pegging into the network. The purpose of the Liquid network is to be a neutral ground that enforces transaction ordering, finality, and validity, but does not take a stance on what transactions mean or what the participants in the network are trying to achieve with them. And that allows economic models to exist within totally independent jurisdictions with totally different responsibilities and still trade with each fluidly with confidence that both rules are accommodated without needing to have knowledge of each other's rules. Liquid also is a side chain of Bitcoin, and I'll go a little bit more into what that means, but the most important implication of that is that Liquid inherits a lot of the battle-tested consensus logic of Bitcoin itself. Liquid is a UTXO system, just like Bitcoin, and the Elements codebase, which is the codebase that Liquid is based on, is largely forked off of the Bitcoin codebase. In crypto economics, the only way to really achieve security is by putting money in a system and then seeing whether or not it is exploited. And so Bitcoin is de facto the most secure code base in the world because it has had the most wealth stored behind it for the longest period of time. And that is the strength that Liquid is inheriting from by building off of that foundational framework. Liquid itself has also been running in production since 2018 without security incidents. So it is starting to accumulate its own history of performance, but it is still a huge value add that we stay so close to the king, if you will. Liquid, as I mentioned, is a federated consensus. Here is, I think, a slightly out of date, but not crazy out of date list of the companies that are part of the Liquid Federation. Being part of the Liquid Federation is a fairly open-ended participation that just basically means that you want there to be a neutral ground where people can make trades with each other with cryptographic confidence. So I mentioned that Liquid is a side chain. This is functionally what that means. Anyone can deposit Bitcoin from the original Bitcoin chain into an address managed by the Liquid validators. Sorry, I'm saying that too many times. I'm going to say that from the beginning so that I get it clearly. Anyone can deposit Bitcoin from the original Bitcoin chain into an address controlled by the Liquid validators, and in exchange, they receive a secret that allows them to claim the equivalent amount in Liquid Bitcoin. Similarly, you can go through a process to peg out Liquid Bitcoin back into Bitcoin in the original chain, which means that Liquid Bitcoin within Liquid is functionally pegged to the value of Bitcoin and is essentially just a receipt that allows you to cash your Bitcoin in if you ever want to exit the network. Liquid itself has 1-minute blocks. The blocks are signed by the functionaries. They have a round-robin consensus system, so they each take turns proposing a block, and then they each sign that the block is valid according to the rules. The validators have no special insight into the network. They can see all the same things that you can without any special privileges. The only privilege that they have is that they are the ones that propose blocks and sign blocks. And because the set of folks who control the proposing and signing of blocks are this set of functionaries, it means that the chain itself is extremely stable. There's no reorgs, and it can have a much faster block time than more open networks like Bitcoin can. This is like a really quick snapshot of what the sort of architecture of the network looks like. At the top layer, you have users that are able to self-custody funds and to trade with each other and with covenants, which is the smart contract technology that we use on Liquid. In a fully self-custodial way with no counterparty risk to each other or to some central custodians. The network allows for a wide range of assets. I'll mention a few of them later that are already issued on the network, and essentially arbitrary assets and derivatives of financial assets can be tokenized and can take advantage of all the things that Liquid enables tokens on the network to accomplish. The network itself is neutral on the nature of what the tokens are meant to represent, which means we have stable coins, we have promissory notes, we have debt, we have security, we have derivatives, et cetera, et cetera, et cetera. The AMP Blockstream Asset Management Protocol is a system to allow asset issuers to embed the rules of compliance for their asset into the asset itself. So I'll go into that in a little more detail in the next slide, but loosely, that's a system that allows any asset issuer to have confidence that their compliance rules are being adhered to without needing to cede control to some central authority of the network or without needing to supervise any counterparties or investors in any simple way. And then at the bottom of the stack is the network validators that are just neutrally ordering and signing off on the cryptographic validity of transactions, making sure that people have the assets that they're trading in using the zero-knowledge proofs that power confidential transactions. So this is the slide I was alluding to about asset management platform. The asset management platform essentially allows the issuer of an asset to be a co-signatory on future trades of the asset. So because Liquid is a UTXO system, we have native multi-signature rather than needing to emulate multi-signature in a smart contract, which, side note, is the source of a lot of the exploits that you see in the DeFi ecosystem, particularly bridge exploits. We support true native multi-sig, which means that the signatories don't have to trust each other. They can be fully and completely segregated. They might even be counterparties in a trade. In this case, the signatories would be, one would be the asset holder, and the other would be the asset issuer. And the asset issuer can use whatever sort of discretion they want in order to enforce the set of rules that they need to stay in compliance for their particular asset definition. So in a lot of cases, that'll be simple KYC AML, but it may also be more complicated rules about their cap table or about whatever distributional rules might apply to the particular asset that they're defining for their use case. AMP is a neutral technology, just like the network itself. You can think of Liquid itself enforces the validity of transactions in an absolute sense, and then AMP allows every asset to add its own idiosyncratic rules of validity on top of the base rules of the network. That allows everyone to build custom compliance for their particular jurisdiction and still trade in a completely neutral field. So again, what are the sort of base value propositions of the Liquid network? The most simple and obvious one is confidential transactions. Unlike most crypto economic systems, The transactions on Liquid are confidential by default, which means you can have true corporate intel be transacting on the network without fear that your counterparties will see it, without fear that it will become public to whatever third parties might be deleterious to your business interests. In general, the purpose of confidential transactions is to allow you to confidentially act on the network without needing to worry about supervision. It also prevents front running and it prevents MEV. So it's useful in sort of more systemic ways as well. Liquid is also built from the ground up for regulatory clarity. There was no pre-mine, there was no ICO, there is no equity-like token. There is no system within Liquid that requires additional regulatory definition in the way that many systems have a sort of a token which may very well be declared to be a security of some kind, but is still currently in an ambiguous state. In addition to that, Liquid is built from the ground up to enable native enforcement using the AMP system. It allows compliant tokens from the very beginning as a sort of natural constituent of the network. The purpose of Liquid is to enable tokenization and digitization of assets that still want to maintain regulatory relevance, still want to be part of the TradFi system, but want to take advantage of the rapid settlement and the covenant smart contracts and the various other properties that are achievable, the rehypothecation protection, the self-custody, the things that Liquid enables tokens to do without necessarily seeking to exit any particular jurisdiction. Liquid is built to enforce and enable those use cases rather than to sidestep them. And fundamentally, Liquid is a platform that's built for what I like to think of as industrial grade security. So one of the reasons that we see a lot of the security exploits that we see in the DeFi space is because there have been a lot of shortcuts taken. And the shortcuts are helpful for building rapid prototypes and trying out wacky new things, but they're not helpful for when you need to put really serious grown-up degrees of finance into those rails and have confidence that they will perform in the way that you would expect. And Liquid is intended not for simple prototyping, but for really profound, serious use cases. And a simple example of that is that what we're working on right now is a language called Simplicity. Simplicity is a deceptive name. It's a challenging language to work with. It's a little bit close to assembly. But the reason that it's useful to be able to build smart contracts out of a language that is so close to assembly is that it allows you to do fundamental mathematical validity proofs about the nature of that smart contract's behavior. So it's a little bit more challenging to build, but then on the flip side, you're able to mathematically prove that the smart contract is only capable of paying out to you or your counterparty, and thus is incapable of paying out to some third-party exploiter, no matter what they did. That's a simple example of what you might do with a validity proof. Validity proofs are really powerful. They're often used in systems that use OCaml today. So if you're familiar with the advantages of OCaml, you can make a similar inference to the advantages of Simplicity. Simplicity I use as an example. It's a future-looking thing we're developing, but in general, Liquid and the UTXO architecture is built from the ground up to have a serious weight towards long-term security, long-term confidence, the confidentiality, and the total certainty that you need to be able to put billions and trillions into the system. Liquid is built to sustain the true economy of the world and not just a series of interesting prototype examples, which is what we've seen mostly in the crypto economic space to this day. So to give you a few examples of some of the things that are being done on Liquid today, this is a couple of the exchanges that you have that take various approaches on the nature of what parts of an exchange should be custodial and what parts of an exchange should be non-custodial, various points along the spectrum of decentralization. I don't want to get too much into the details, but they're all very interesting in their own regard, and each of them offers a different set of trade-offs than what's possible in the traditional financial world today. You know, we've talked a lot about FTX over the course of this morning. I'm sure it will continue to come up over the rest of the conference. In general, FTX is a really good example of a threat that, while not synonymous with crypto, is certainly very relevant to crypto. And these systems are meant to allow traders to engage with exchange-based use cases without needing to expose themselves to the kind of rehypothecation, misallocation, and appropriation risks that FTX ended up being such a dramatic example of. Some other tools that, I already talked a little bit about AMP, so I won't repeat myself there, but Blockstream Jade is our hardware wallet, which allows you to store Bitcoin and liquid assets using a full hardware wallet. You're also able to use it with multi-sig if you're a sophisticated user with a serious use case where you want true desegregation of private keys. Boltz is a really interesting use case. It's had a lot of growth recently. Boltz is a non-custodial exchange between both Bitcoin, liquid Bitcoin, and the Lightning Network. So it's a way to fund liquidity to Lightning channels channels or to withdraw liquidity from Lightning channels into a Bitcoin-like system in a cheaper way. So they've had tremendous growth in Liquid recently. Liquid, I believe, last I checked, now represents around 65% of their overall volume. So Liquid is essentially the leading system that's attempting to build these crypto economic use cases on the example of Bitcoin, building with a true long-term future in mind, building with fundamental security, building with privacy, building with a serious intent to not enfranchise a new centralized authority, but instead to build a system that actually does not have a centralized authority with any special privileges, and to build the governance system that can help make that a long-term part of the crypto economic future. So that's what I've got prepared. And now I'm going to pause, give myself a sip of water so I can clear my throat. And then I would love to hear any questions that might occur, because I know I just talked about a lot of stuff very quickly. So have we seen any questions come through on the chat? You're on mute, I think.
No questions yet. You're good to continue.
Okay. Well, I don't have more slides, but what I will do is kind of highlight a couple of the use cases that I think are particularly interesting examples of what's being done with Liquid today, and what I think may be inspiring for folks to contemplate how to incorporate into their own use cases. Mifil is a company based out of Mexico that handles, among other things, promissory notes. So promissory notes are a form of debt in Mexico that happens by local debt laws. So it's a particularly desirable way to hold debt, but it is a local paper instrument, and it therefore struggles to access the global liquidity, because in order for global lenders to have confidence that they're not dealing with rehypothecation risks, they have to have an individuated trust relationship with the issuer of that promissory note. So what Mifil is doing is Mifil is tokenizing promissory notes and then letting those tokens serve as pristine collateral to global lenders who are now comfortable lending against those assets because they have greater confidence in the total supply and in the lack of rehypothecation risk. And then that additional liquidity is being used to create more tokenized promissory notes in Mexico. So there's like a flywheel there that basically amounts to a locally valuable but stranded asset is able to access greater global liquidity by eliminating trust relationships and replacing them with cryptographic proofs. So Mifil says, don't trust me that this is how many notes I have. Use the cryptographic proofs of Liquid to know how many notes I have issued and how many you hold. And then you will know that that is the ratio of the assets that you have claim to. And Mifil basically just serves as an anchor point connecting the traditional financial instrument and all of its legal privileges to the tokenized asset and all of its cryptographic strength. And by doing that, they're sort of enabling both markets to access each other in a stronger way. Another interesting use case on the opposite side of the world is Japan, where Digital Garage has a product that they call SettleNet. And SettleNet allows mostly cryptographic exchanges are the ones that are using it today, but my anticipation is that this will be a much more widely needed banking service over time, which is exchanges of pairs between Liquid Bitcoin and their Canadian and Japanese yen pegged stablecoins. So for exchanges that want to be able to purchase either stablecoins or Liquid Bitcoin in order to rebalance their exchanges locally as their customers either buy or sell, they're able to do that in a single atomic asset swap, which and then with 1 to 2 minute settlement times. So they're able to transact much more quickly and with a much smaller degree of exposure in order to top off their coffers between the Japanese stablecoin or the Canadian stablecoin and then Liquid Bitcoin as usually the counterparty of the pair. But fundamentally, you can do that same asset swap settlement across any two arbitrary tokens on the network. Another interesting use case is SideSwap, which is a decentralized asset exchange that allows users to do one-to-one pairwise swaps of any arbitrary assets without needing to trust each other or SideSwap itself. The whole thing is done in an atomic transaction so that you as the user never actually have a moment where your asset is gone, but you haven't received payment. The moment where your asset leaves and the moment where you receive payment are a single atomic transaction that are confirmed simultaneously by the network. Another interesting example of something that's happening on the network right now is Fuji Money. Fuji Money is a stable coin that is backed by Bitcoin itself. And the way that it works is that users that want some access to liquidity on their Bitcoin without relinquishing self-custody can lock some Bitcoin up as collateral, receive some Fuji Money as a sort of loan against that collateral. And then there's a process by which people can claim those vaults if the value of Bitcoin goes below a certain threshold. So functionally, it creates a Bitcoin-backed stablecoin in the market for arbitrageurs who want to buy Fuji stablecoin in order to close out whatever vaults are in arrears or what have you. So that's another interesting example of what's happening. And what's cool about Liquid is that each of these different systems can have greater or lesser regulatory scrutiny. They can have greater or lesser degrees of controls or restrictions on the nature of how the asset is used, and still be able to all interoperate smoothly. And a user can choose to bridge across whatever suite of those assets is relevant to their portfolio without there needing to be any centralized authority that understands simultaneously that rich, diverse suite of potential rules that are being adhered to. So like the Japanese regulatory environment and the Mexican regulatory environment and the various regulatory environments that are involved in all of these different products can all interoperate without having knowledge of each other and without needing any sort of central authority. So yeah, that's pretty much what I have to say today. I'm happy to answer any questions that folks have, if there are any that have come up. Or perhaps I was just so stunningly convincing.
Oh, that's all.
I've seen some Q&A.
Oh, you see some Q&A? Fantastic.
Great. Curious on how the regulators view the anonymous counterparties and assets. How is this handled? So the nature of the network is that the network doesn't have any knowledge of its counterparties, but you as a user are entitled to enforce your sort of discretion over what counterparties you want to be allowed in the assets that you issue. So if you are issuing an asset and you are concerned about the risk of anonymous counterparties, you can use the AMP system to basically restrict the set of addresses that are allowed to hold your address or allowed to hold your asset to whatever list you like. And that can be a list that you have individually KYC AML'd, or it could be a third-party service that offers KYC AML as a service and just allows you to say, like, I want to be available to European investors or US investors or whatever might be relevant to you. So the network allows for anonymous interaction, but it's up to the asset issuers what they deem as a valid interaction for their asset. The next question, can we talk about interoperability? How does Liquid interact with other blockchains? In general, the nature of blockchains is that they are aware of themselves and not aware of other blockchains. The two ways that you see interoperability between networks are a centralized bridge, like an exchange that just allows you to deposit on one network and withdraw on the other, or a smart contract that emulates the behavior of a centralized exchange in a hopefully compliant and sensible way. In general, writing those smart contracts is extremely difficult, which is why you see so many bridges with multi-million-dollar exploits. So I don't really think smart contract bridging across blockchains is a wise security practice. I think if you do want to cross blockchains, you're probably better off building a trust relationship with a specific party that operates on both chains, or being that party for yourself. We have the next question is, are the tokens settled on Bitcoin or are they off-chain? So the nature of Liquid is that it has its own chain. It is a side chain to Bitcoin. And then you can deposit Bitcoin into an address that's relevant to the side chain, and then do things on the side chain, and then withdraw back out onto the original Bitcoin chain. So it has a relationship to the original Bitcoin chain. You're able to exit back out again, enter and exit from the Bitcoin chain, but it has its own chain, and that's why it's able to settle at 1 minute times as opposed to 10-minute times. So it does actually have its own, I don't know if I would go so far as to call it off-chain, because there is still a base relationship, but it is not, each of the transactions is settled on the Liquid side chain, and the only time that you have a presence on the Bitcoin chain is if you're actually withdrawing back out in a peg out transaction. The next question is, what are the costs per transaction? I don't remember off the top of my head, but the Blockstream website does have a block explorer that lets you look at any given time. In general, the Liquid network is very similar to Bitcoin, but has blocks about 10 times as often. So we usually have lower fees. That's not a fundamental property of the network. the network is congestion priced, just like Bitcoin is, so that it is an auction for block space, but we have a lot more block space. And we have a lot more luxury to expand block space because we're working with a federated set of validators, as opposed to needing to make it so that like someone with a Raspberry Pi and a satellite connection can still stay connected to the chain, which is something you need for a chain like Bitcoin. What is the Liquid chain? It is an elements-based chain. It inherits a lot from Bitcoin, so it operates very similarly to Bitcoin, but rather than using the proof of work to validate which block is valid, there's just a set of permissioned validators that are approved by the Federation, and those are the miners, if you will. But other than that, it's very much like a Bitcoin chain that's 10 times faster and has a few extra bells and whistles. It is literally called the Liquid chain, which is sort of a bit redundant, I suppose. It's entirely possible also to use Elements, which is the code base that powers the Liquid blockchain, to run a separate parallel network. So, you or I could go off, fork the Elements code base, or not even fork it and just run it ourselves, but with our own validators, and have a Liquid-like network that was with a federation that we preferred for whatever reasons, and maybe had different rules in service of the goals of that federation. Liquid, I think of as being the network that is aimed at being the most neutral, but you could conceive of other networks that are interested in the federated consensus, but maybe are aimed at a more focused jurisdictional target. Are the two parties of the atomic swap the only ones that can see information about the transaction? That's a great question. Everyone on the network can see that a transaction took place and the two parties involved in the transaction. No one else on the network can see what the assets exchanged were or what the quantity of assets exchanged were, just that a transaction took place. Everyone can verify that no tokens were created or destroyed in the course of the transaction, so we can all verify that the supply has remained stable. And then the two parties of the transaction are in possession of unblinding keys that would allow them to, at their discretion, unblind that information, possibly to a third party, or if they wanted to, they could do it more publicly. I don't know of a practical reason to do that, but there might be some clever cryptographic game you can do by later revealing unblinding keys. So the two parties of the transaction have a secret key that they could release that would reveal the nature of that specific transaction if they so choose. So they retain the ability to relinquish privacy later. The data isn't lost. But if they choose not to, then the transaction, the only thing that's visible to the broader network is that a transaction took place, not the nature of what the transaction was. Cool. Well, I think that's all of the questions so far. Get them in if you want to get any last minute questions in. Otherwise, I'm also always happy to catch up offline. Cool. Well, thank you. I'm going to stop sharing here. I appreciate everyone's time and energy. And if you want to learn more, definitely reach out to me. I'm odin@blockstream.com. Cheers.
So far, we've heard from the liquidity problem, excuse me. We've heard about Oasis Pro, our title sponsor, and now Blockstream as well. So a lot of good stuff going on from different angles. I'm Jason, your COO, and we are joined today in the Future of the Markets panel. This is a panel that we put together containing a variety and diversity of perspectives in the industry. We're joined by Tal Elyashiv, our managing partner at Spice VC, Scott Smiley, co-founder of High Yield, and Alan Qureshi, president of Blue Water FinTech. Gentlemen, how are you doing?
Good to be here. Thanks for having us, Jason.
Absolutely. Thanks for joining us. Awesome. Well, why don't we start with some introductions? Tell us a little bit about each of yourselves and what your company does and what its role is for this industry.
All right, so maybe I'll start. Tal Elyashiv, you mentioned that I'm the managing partner of Spice VC. It was founded in 2016, 2017. It's the first tokenized VC fund. And I'm also a co-founder of Securitize, one of the major players in.
This is our
space. And I've also, for the last 3 years, been publishing. I think I published over 100 articles, all related to blockchain and Web3. And you're the first to hear that I'm launching a book exactly a month from now in the Digital Asset Week in London. So I'm knee-deep in tokenization and blockchain since 2016.
All right, I guess I'll go next. So I'm Scott Smiley. I'm co-founder of High Yield. Before I got into the crypto space, I worked in traditional finance. I worked in on asset-backed securities specifically at Deutsche Bank, and then started to get into blockchain and cryptocurrency in early 2017, and haven't looked back since. I spent the majority of my career in the blockchain space working on a project called the Icon Project. I did token economics, governance, business development, and did a lot of product development there as well, working at the application layer of the Icon ecosystem, and have now since been branching out, trying to leverage my background and the background of my co-founders to build High Yield, which is providing infrastructure for on-chain capital markets with a focus on lending and fixed income to get started.
Excellent. Hey, my name's Al Qureshi. I'm the founder of Blue Water Financial Technologies. We are a fintech platform that is primarily focused in the mortgage asset ecosystem. What that means is with our technology, we're able to deliver assets on-chain in a fractionalized form. And through our processes, we've been able to digitize the mortgage asset origination process here in the US with regard to pricing, trading, transferring, diligencing, and delivering assets and tracking those assets seamlessly through an all digital platform.
Fantastic. Well, thank you very much, everyone. This panel is called The Future of the Markets. But before we dive into the future, I do want to stress that, we've been around for, 5 years is, our birthday today, actually, at Security Token Market. And the industry has been around for a bit now, but it's still somewhat of a nascent industry. And nonetheless, we have seen some progress in those last 5 years that we've been tracking it. But, I want to hear your perspective, in those last 5 years, what are some of the top highlights in terms of, notable strides of progress in terms of the adoption of tokenized securities?
I think my domain is one of the first ones to have grown over those 5 years. Capital markets, more specifically the securities part. A lot of people were looking at adoption from the perspective of liquidity in the market. And I think that the expectation from blockchain to be the magic that will bring liquidity to private equity and to small private securities was not very realistic. I think that blockchain and tokenization has the possibility of providing more access to these and smoothing a little bit the transactions in those arenas, but this is not what creates the liquidity. But where everybody were looking at liquidity, what happened in the capital markets arena is that almost every major player today in capital markets is using blockchain one way or another for some parts of the process. And I think this is the big progress that we've seen. All the major players, incumbents and new players, are all using blockchain for simplification of some of the complexities in the process. And to me, this is a very exciting thing to look at, because it was part of our vision when we created Spice VC back then. But it also reinforces the expectation that 10, 15 years down the road, all financial assets will be riding on blockchain one way or another. It doesn't matter which blockchain, it doesn't matter which protocols, because these will change over the next 10, 15 years. What is important is that blockchain is going to be a key infrastructure behind the securities industry. And that means over $100 trillion worth of assets over blockchain one way or another. To me, this is the mega progress that we've seen over the last 5 years. We can look at small things, right? If you look at tokenization of financial assets, then initially it started with less interesting assets, and the result of that was almost no liquidity. But over the last couple of years, we started seeing mega players being interested in being tokenized. Hamilton funds have been tokenized. There's some other mega players in
Franklin Templeton, right?
Yes, and that again is an indication that tokenization is not just the magic that will create liquidity. It really simplifies processes. It really solves a lot of problems in the securities arena. So I think this is probably one of the industries that have seen the most progress in that regard.
Yeah, no, definitely kind of, sorry, yeah, just to jump in there, definitely agree that, like liquidity isn't necessarily, like blockchain doesn't solve for liquidity. It's not just gonna like bring money to a product that's like not interesting on its own right. That suddenly it's gonna become more interesting and a better investment opportunity because settlement happens on chain. I think ultimately where the efficiencies come in is like more in the settlement process. And it like where we've seen a lot of growth over the last 5 years is through stable coins. I think like, I know we're talking about securities and you specifically asked about securities, but stable coins and, USDC are like kind of the first like tokenized RWA being dollars. And that was like a major form of, using blockchain to settle dollar transactions is certainly more efficient than traditional financial rails. And now with interest rates being higher, like storing assets on chain in stablecoins is becoming more costly. So now we're seeing more of a push to bring other assets that have the same settlement properties of USDC. So I think we start seeing like most of the stablecoin holdings start diminishing as the amount of tokenized traditional financial products increases and start using maybe bank deposits for settlement as opposed to specific, instead of like just USDC specifically or some kind of yield bearing stablecoin for settlement. And kind of, like that's what I was looking at JP Morgan, their Onyx blockchain. They've been doing a lot of settlement of repo transactions as well using Onyx. So that's something that I think like, settlement processing of transactions, really the bank's middle office is where blockchain adds a lot of efficiencies. Oh, Alan, you're on mute. Love to hear what you have to say, though.
Thank you. Appreciate it. Yeah, I guess for my part, what I would say is that, listen, if I think of the developments that have happened over the past 5 years, I'm going to take a capital markets view of looking at this and the shakeout and deleveraging that have happened with the functional equivalent of our Enron or our WorldCom with FTX, or even on the banking system with regard to SVB, and the move by investors to look at alternative ways to get access to assets, right? As one particular sort of watershed event, I actually think that shakeout has been good for the industry. I think that the potential for regulation is good for the industry. I think that having less hype and more focus on, as we're discussing right now, right, real world assets that provide real value and solve real capital needs and investment needs on the one hand, right? And that's what I think about with regard to people who want access to assets, right? So-called token investors. And then on the other side, people who need distribution and people who are looking to unlock. I think we started with, well, hey, liquidity is just a start. I think it's the other aspect, which is, okay, hey, great, like there's a pool of liquidity on the capital side, But what I've seen, certainly from my seat, particularly coming from the U.S. mortgage arena, where there is a fair amount of still processes being done manually, is this sort of parallelization of, on the one hand, token technology getting better and better, sort of democratizing and digitizing. And then on the other side, real world assets being made available in a form that's consumable for the other side of the coin. So I think it's sort of really, two things. The fact that, hey, a lot of the hype's being extracted and we're actually focusing on real world assets. That's a really good thing. And then the second piece is the fact that, quite frankly, a lot of these other sort of ancillary assets that are very, very interesting, that have very interesting yields, that are very deep and liquid, right? $14 trillion US mortgage market. That's a deep market, right? And the fact that technology is now catching up on both sides, I think that's highly positive and very accretive to tokenization just generally.
Awesome. You guys have a very interesting perspectives on this, actually. And we touched on multiple points, right? We talked about liquidity, operational efficiencies, democratization of the capital markets. On the liquidity side, it's, something that is still missing. And I do want to dive a little bit deeper into that. But on your other points about operational efficiencies and whatnot, I mean, it's things that we've been seeing, especially this year as things come out in terms of, what people are seeing, whether it's back and middle office, or simply other things that are just more, how do I say this, of an option. So for example, on the liquidity argument, a lot of people bring on is like, hey, I just want to tokenize an asset so I can trade it easily. As you guys mentioned, that does not bring liquidity just because it's represented by a token. What it does do, though, I think, is create liquidity optionality, as we like to call it, the option to be able to trade a little bit more efficiently in terms of the process of doing it, but not so much as in terms of like the amount that will go back and forth. Some assets are a little bit more liquid than others. As we know from the public markets, assets trade based on information, right? How much do I know about an asset, and do I have to be able to make an informed decision if I want to buy or sell it? Private assets are not necessarily obligated to report as much, and so as such, liquidity won't be there, or at least it'll be missing. But that may bring me to my next question, though, is, the liquidity problem. I think we've all, noticed that it's not there yet, not where we would like it to be. But what's it going to take? And are there different types of liquidity? Is it just trading, or are there other options that are considered liquidity?
First, let's talk about what is it going to take. So I think we touched on some things, right? Assets need to become more and more interesting, and tokenized, not because it's the only way, because you can't raise money any other way, but because you really want to make it more accessible, and the asset is very attractive as is. The second thing is they need to be big assets, right? If you tokenize a $10 million worth of an asset, there's not going to be liquidity, no matter what. There's nothing to do with tokenization. Assets that are very small will not see a lot of liquidity. If there is not a lot of change, it doesn't have to be volatility, but change, growth, whatever, in a value of an asset, again, you're not going to see a lot of liquidity, because people buy and hold and nothing happens, right? And there are also assets that are financial assets that normally are treated more like OTC, not because there's no liquidity, but because people buy them in order to hold for a longer period of time. Venture capital is a good example. Private equity is a good example. So you have a bunch of private equity funds tokenized, and Spice as a venture capital fund is tokenized. But people invest in venture capital not in order to sell it a week later for 2% more. They buy it to hold on for the longer period of time, typically 5, 6, 7, 8 years. They want to know that liquidity is an option, but that's not why they're holding it. And therefore, you're not going to see a lot of transactions in the market. So you need to see more assets that are naturally more changing hands at a higher velocity in order to see more liquidity. But there's also another thing. The market started from the bottom, rather than from the top. So not only small assets, but you have small portion that is being tokenized, and a lot of the exchanges, marketplaces for tokenized assets are not sharing order books. And there is no protocol in the industry at this point anyways for sharing order books. And what it means is, instead of creating more liquidity, the more players there are, the more broken the liquidity is of an asset, if you will. And that will have to change. I think that players will have to come together and figure out that in order to create liquidity in a market that is growing from the bottom, you have to share order books and allow different players to fulfill an order or to create liquidity together.
Sure thing. And Tal, I'm glad you brought up, bringing on more assets that are probably more prone to tradability, to changing hands. You're an investor in this space. Your fund is tokenized. Tell us about what a future looks like of of having an existing portfolio that is tokenized, such as yours, and the individual portfolio companies also being tokenized. So what does that look like? What does a tokenized fund of tokenized products look like, or assets?
It's very interesting because our portfolio companies are not tokenized. Right, the fund is tokenized, the portfolio is tokenized, but so the relationship between the fund and the LPs is what is being tokenized. But the investments are traditional investments in traditional equity in those companies, at least for the majority of the portfolio. But you're asking me about the future and about portfolio of tokenized companies. I don't see any difference, because as a VC fund, you invest for the longer run. So the fact that equity in a company is tokenized is a technicality. It's not really for the purpose of creating liquidity for us, anyways, because that's not our business model. It makes it easier to liquidate assets or liquidate a portion of your portfolio, but that is less consistent with the way VCs work with portfolio companies and play a significant role in the growth of those companies over time. It definitely, I can tell you that tokenizing the relationship with LPs was the right thing to do from many perspectives. A typical VC fund usually has, 10, 20 LPs. Beyond that, it's getting really complicated to manage. We have 450 LPs and way less administrative burden than a traditional VC fund with 1/10 of this of LPs, and that's because the relationship is tokenized. And it really simplifies from a regulatory standpoint and also from a day-to-day standpoint the whole management of the relationship with LPs. Right now, I don't see an immediate value for a VC for portfolio companies to be tokenized, but it's also not necessarily a bad thing.
Sure. Yeah. And look, to your point, a VC has a different investment strategy than, say, a hedge fund or just an individual investor. So you make a good point. You have the relationship that's tokenized technically between your LPs and yourself. And then you also have potentially, just the ease of rebalancing a portfolio, maybe not as prominent for VCs, but for other investors, they may want to be more granular in terms of, how you rebalance that portfolio based on, whatever your underlying companies are doing. But I want to shift the conversation a little bit over to, a little bit away from the liquidity aspect. I think that's a lot of conversation we've talked about a lot, which is fantastic. But let's look at the other side of the coin that we explored earlier, which was the back and middle office. Alan, you're working with digital mortgages. Talk to us about how tokenization enhances mortgages in the back office or from the secondary market perspective.
Yeah, no, and what I would say is that it's needs driven, right? So the ultimate finished product has to be, and I think this dovetails, by the way, quite nicely with what Tal was talking about, which is embedded in all of this. For something to be on chain, it actually has to have some level of trust associated with it. It has to have some level of diligence associated with it. It has to have a degree of transparency around what is the thing that you're buying, right? So assuming that's the end goal, the front part of that, or all of the concurrent activities that lead up to good delivery, include asset verification, right? Price certainty, right? So, hey, I bought it at some price or some yield or some cash flow. What does that actually, how does that manifest itself in terms of the underlying assets? Have they been reviewed? Is that process also digital, right? We would hope that it is, so that everything that tokenization provides on the back end can be afforded on the front end. And when we think about that, when we think about something as archaic historically as has been mortgage, we start to think about the fact that we need an ecosystem to ingest all of those assets on the front end and make that very streamlined under this concept of delivering good product that has been reviewed. In our case, our processes are insured by certain underwriters of Lloyd's of London, right? So that means that not only are you getting interesting product at an interesting yield, but it's been reviewed, and that process itself is insured. So all of a sudden you're in a zone from a back office and ops perspective where the product that you're boarding on chain has very clear provenance, has very clear sightlines into what the asset quality actually is. And I think that's highly essential, going back to what Tal was talking about vis-a-vis trust and liquidity. Make sense?
Yes, and I would add to this, Alan, that one of the things that's still missing from the market is enough, I'll call it rating agencies, that rate assets and compare assets so people can look and find their value proposition and their parameters in the different assets that they're flipping through. Right now, it's almost non-existent, except security token market and maybe one more resource.
Well, and Tal, it's interesting you say that, right? When you think about your traditional kind of third-party rating firm, right? TPR firm, heretofore pre-Blue Water, certainly in our zone, they might take 8 hours for a given loan file, right? Truly, 8 hours to review a loan file with offshore resources, and that's stare and compare, literally butts and seats, right? Think about how arcane that is in terms of where the final resting place of those assets are, right? So we spent a lot of time digitizing that process from end to end. And there is a question around what's been one of the hardest issues to solve. Well, that would be one of them, right? Creating that end-to-end ecosystem, that layer that goes all the way across. So ultimately, you're handing off a baton to the tokenization piece, right? Good delivery, trusted assets, right? That have been reviewed, as Tal would suggest. Yeah.
Yes, just a quick question for you, Alan. I actually just recently went through the property, purchasing property process. Didn't mean to create an alliteration there, but a lot of when I think about trying to create efficiencies in the market or in this transaction, I'd say it's maybe like a 2-month process. There's negotiation between the buyer and seller. I don't really see digitizing that. There's the legal contract of all the nuances of that individual deal. The seller is going to pay for this, the buyer is going to pay for that, negotiating all of these terms to come to a final price and who's paying what costs and, calculating my all-in costs that takes time. So I'm curious. And then, the legal review of both sides, right? Both sides need to have lawyers to make sure the contract actually reflects upon what was agreed. And then the final 3 days of the transaction is the actual settlement and signing of documents and things to that effect. So I'm curious to hear from you, because from my perspective, I've been seeing a lot of people trying to bring efficiencies to the mortgage market. But then when I went through it myself, I was having a hard time thinking about how you can automate and digitize a lot of these steps that were actually the most cumbersome, difficult parts of the process.
Sure. So we primarily focus on the U.S. residential market, which
Yep.
For what we've built is an end-to-end process. You must just be exhausted having described all of that. That sounds like a lot. And listen, like there are various aspects of the mortgage market, mortgage ecosystem, right? We started with mortgage servicing, which is a very interesting asset. It's negative duration, it's high yield, it's fractionalization ready, right? Wonderful. We built out a platform, pricing, trading, transfer, QC due diligence, right? We started with MSR, right? What you're talking about to me sounds like a non-QM loan. Well, we've built, all of the secondary market capabilities from the front end all the way to the back, right? Back meaning, hey, here's your token, let's go, right? So when we talk about the underwriting of mortgage assets, when we talk about the actual front end manufacturing of mortgage assets, that's an area where we're investing heavily, where there's a lot of opportunity for throughput, right? So if I think about a typical mortgage loan right now, or mortgage underwriter, they might take time to do 2 loans a day, right? With Blue Water technology, they can do 10, right? Now think about that throughput, right? So your point's very well taken. My gosh, it's sticky. It takes time, right? It's very cumbersome. Point well taken. At the end of the day, right, we see thousands of loans a day through our platform, right? We're the largest private entity in terms of trading, our various mortgage assets. What we're able to do through this technology is deliver, to your point, after all of that, right, a very streamlined, good delivery loan file, going back to this concept of trust.
Okay, so it's more after the initial, it's like,
Yeah,
you make sure it's digital from start to finish, but all the process I described is still there. It's just if the bank that did the initial mortgage wants to trade it or give it to someone else, that whole trail is digitized, and the trading of my existing mortgage is what would be faster and more efficient with your tech. Is that right?
Absolutely. And I think, as Tal was saying, right, in 15 years, those who are efficient will still be part of this conversation. Those who are inefficient will likely not be, right? Because what's the limiting form? The limiting form is better margins, more efficiency, and scale, right? That was one of the other things I wrote down as Tal was talking, was, quite frankly, we need trust, right? We need good delivery, and then scale, right? Can we move assets through the front door, right? And can we do it in a meaningful way that's broad enough, right? Certainly from where we sit, we see it. It depends on what the asset is. Like, to your point, again, to dovetail off of Tal, offering bills out, right? T-bills, like, that's great. We can do scale, we can do size, but unless we're sort of worried about, unless we're trying to solve like a currency sort of transaction, right? It really comes down to what does the return look like, and what problem are we trying to solve, right? Who's our end buyer, right? Like, there are only finitely many people that want bills vis-a-vis token. But if you can unlock mortgage assets, for instance, right? And you're going to talk to us about high yield. And if you can do that in a way that delivers all of those key elements, trust, scale, et cetera, where we're starting to get is we're solving problems for investors who want access to assets that they otherwise can't get the same way, for whatever reason. They can't trust it. They don't know what the delivery standards are. It's at a different return target than what they're looking for. And so I think it's a number of these different things that we simultaneously have to solve for, on both sides of the coin. I'd love to hear your thoughts with regard to high yield. Scott, I don't want to dominate.
Yeah, no, I mean, I definitely think that, like, the exchanging of mortgage assets and, like, trying to create efficiencies by having like a standardized process and, an open platform that anyone can participate in, and that will definitely add, some efficiencies to the secondary market of, borrowing and getting leverage against these mortgage positions that somebody has. Like, my background is in ABS, and I think a lot about from start to finish, having the loan origination on chain, the loan repayment in USDC. Like when I was working at Deutsche back in the days, we'd have I get like a spreadsheet of like 10,000 consumer loans, and the whole process of one person repaying their loan to that dollar flowing through to the end bondholder, that charges, let's say, maybe 50 basis points throughout that process, perhaps. And on a multi-trillion-dollar market, that can be really meaningful. And that's kind of, I definitely agree that the starting the process digitally native is a good direction to go.
While we're on this, Scott, why don't you just tell us, how does so you mentioned how, this would enhance, lending and borrowing. What does high yield do? Like, how does it work? What you guys are doing in lending and borrowing? So I want to know, how blockchain enhances it, and where you see lending and borrowing going in the next 5 to 10 years based on what you're doing.
Sure. Yeah. I mean, for those familiar, like you could think of the high yield infrastructure as like an on-chain repo facility. So, we kind of allow individual lenders to create, custom parameters and bespoke lending facilities for their partners in a scalable way. So if they want to provide on-chain repo against treasuries, they could just kind of set the parameters once, and anybody who has, tokenized treasury that matches this type of, whatever these parameters, they can get, they could borrow against their position for, short-term financing. And I do think like this is like one piece of, broader on-chain capital markets infrastructure that, the way I think about this is kind of starting one step at a time, proving out the technology, showing that there are genuine efficiencies in like one transaction type, and then starting to apply that on a larger scale. And I do think like repo, for example, is a really good use case considering, JP's, I was just reading a report the other day. I don't know when the report actually came out. I think it was maybe late 2022 on Onyx, JP Morgan's private blockchain. And, they've been settling, they settled over 400 billion worth of repo transactions across like the banks involved in the, in Onyx. So I do think that's like a good place to start. And we're seeing that with traditional financial institutions as well.
Thing, yeah, we saw Broadridge as well. We've seen, $1 million, I believe, in savings for every 100,000 transactions. That I'm sure can add up quickly. So right. Again, we're seeing some numbers finally come out, something that we didn't see necessarily in the last 5 years, or maybe a little less, but we didn't really see some data, tangible examples of like, hey, what is blockchain really doing for us here? It's something that we're starting to see a lot more this year. I like to think of 2023 as a transitional year. We had the crypto era, the NFT era. 2023 to me was a transitional year into tokenization. It's what people are talking about nowadays, finally. And so 2024, I'm hoping is going to be huge for tokenization. But that being said, we've talked about those examples. Are there any other examples that you guys want to talk about, in terms of use cases that you're working on? I know that high yield, you guys have some exciting news coming out with Avalanche Vista. Can touch on a little bit on that as well.
Sure. Yeah. I mean, definitely excited to be building in the Avalanche ecosystem. I think they're like clearly aligned with the RWA narrative. I mean, they commissioned a research piece on the block. They help a lot on like kind of the business development side and just like doing research to see like where demand is in this market for like these types of products and people interested in piloting new technologies. So that's been super helpful. And then I guess more broadly, just like on the direction or like the other examples of tokenization. It's not necessarily something that I'm looking into specifically with high yield, but I do think like markets that don't have good existing infrastructure could be good places to target for, I guess, loans for high yield or just broadly like tokenization. I'm talking about like art, for example. I'm not an art connoisseur. I'm not like super involved in that space, but I was chatting with a few others about, how like the issue with tokenizing existing securities is that you kind of have this like double ledger system. They have this like existing infrastructure that you need to comply with. And then you're also trying to move settlement and other types of transactions on chain. You kind of have to mirror both in both infrastructure. But in the art space, and, I am looking at other space as well, just kind of, looking further out and, where the next pocket of demand and pocket of efficiencies can be. I do think that, looking at areas without existing infrastructure that you have to mirror, that you could just come in and bring efficiencies to like transparency, history, and transaction settlement is a good place for people like builders in the space to work towards.
I would
Fantastic.
agree with Scott. One of the interesting domains I've seen over the last couple of years is supply chain.
Yep.
Supply is really mirroring the same story that you just described, Scott, without the regulatory existing system and set of rules, and a tremendous amount of inefficiencies because the supply chain, even when it's digital, it's really mimicking a paper process. And there are tremendous amounts of efficiency to create there, and many players are doing that. That's very interesting. I think we're going to see a bunch in healthcare as well, although it's a very slow to adopt industry. But there's some very hairy problems that the industry has been trying to solve since the 90s that I think blockchain can offer some very unique solutions as an infrastructure.
Nice. Yeah, I'd definitely be curious to hear if you know of like anyone building in that direction, just to kind of read about it from a research perspective.
Generally, the concept of being able to buy and sell receivables, however they manifest, right? Whether it's through healthcare or factoring vis-a-vis logistics, I think that's obviously very interesting. Yeah, again, I'm very self-interestedly going to talk about talk to my position, and that position is just the fact that listen, at the end of the day, the U.S. mortgage market is ripe for this sort of activity. We've been focused on MSR, but coming down the pike are whole loans, coming down the pike are non-QM products. And listen, at the end of the day, the average end investor doesn't have access nor scale to be able to get access to these assets. Tokenization creates that natural segue. Again, we have to figure out what problem are we trying to solve for them? At what return? How do we enforce trust, right? How do we do it in a way that makes it interesting with scale, as Tal was saying? We feel like we've solved a lot of those problems. There are others. I think there was a question on that, but it comes back to it's a chicken and egg, right? Part of the reason that we're not here already is you need a number of the key infrastructure solutions in place. We spent years building it. We're here. We're ready. We're chain ready. My expectation is both Tal and Scott, with regard to what they do, are chain ready. But it really has been heretofore a chicken and egg concept, and we got the chicken, and we got the egg. Does that make any sense?
I actually really like that, how it segues into one of my final questions, I guess. We do have 5 minutes left, by the way. I do want to thank our sponsor, Oasis Pro, our title sponsor here, as well as Red Swan and Venium, and others that have made this event possible. But with 5 minutes left, I do want to hear each of your perspectives into, any predictions that you want to share for the next 5 to 10 years in terms of tokenization or blockchain technology in general for the capital markets. And specifically, the question I wanted to ask was, who's going to make this happen and bring it to the next level? Is it the fintechs or the incumbents?
I think I already answered this on the Q&A text, but I think both. It's actually very interesting because the way it started was new players and bottom up, right? And this was a very hard work of trying to roll a big rock up a mountain. But over the last 3 years, we've seen many of the incumbents seriously getting into this and not just investing money, but doing serious stuff with tokenization, starting from the really hard areas of settlement and so on, and then moving to making things more accessible to investors. And I think the answer is very much like Alan said it before. The ones that will adopt the technology will win, and the ones that won't will not be here. Some of them will be incumbents. There's some very innovative incumbents that are playing. We see our what's in front of our eyes in the US, and we know some of the players that are doing this. Some of them are huge. BlackRock is there, Fidelity is there, HSBC is there, there are a bunch of others, Bank of America is there. But in Japan, most of the capital market players are kind of very deep into this already. So those that are going to take advantage of the technology will be here and will make it all happen. Some of them are going to be new players, some of them are going to be old big players, and it's going to move both top down and bottom up and meet somewhere in the middle. I think it's going to be a very interesting process. And I think it's also important to recognize this is going to take 10, 15 years. This is not happening next year. We'll see steps and steps and steps. And part of this is also the regulatory framework, right? I think the US has been very fortunate that the SEC moved very early in 2019 and said, digital securities are securities, everything applies, go play. And that made things much easier in the digital security space than in any other blockchain related space, but there's still the duality where the SEC wants to see everything settled the old way, even if it's on the blockchain. I think the day is not very far where the SEC, because of a lot of main market players coming into this, very big traditional players coming into this, will recognize that regulation can change and adapt to blockchain as a standard and will allow the settlement to happen in a natural way, and you won't have to have the duality anymore. So we'll see that as well. But again, I mean, these will, when they happen, it'll be a big step forward, and we'll see much more happening, and we'll see more players joining into this and more standardization. But it's a 10-15 year process. The nugget is that at the end of this 10-15 year process, you see well over $100 trillion of assets on blockchain. So it's very, very worthwhile staying for the duration.
Absolutely. Well, 1 minute left. Alan, Scott, any last minute thoughts before we hop on to our next panel?
I'll just echo what Tal said here. Saying that both fintechs and large financial institutions, I agree, will have their kind of place and their niche in the future of capital markets, and that absolutely, all capital markets transactions. I'm looking forward to ending that duality, however long that takes. You've already seen it in Europe, I believe, Swiss DLT. Legislation recognizes blockchain-based transactions as legally binding. You don't need this duality of managing both systems. So I'm looking forward to that day coming, and for high yield being well positioned when it does.
Thanks, gentlemen.
All righty. Well, thank you, everyone. I appreciate your time, and all three of you for shining, your insights upon all of us, and getting to learn about, what each of you is doing, what you guys see this market going in the next few years. And I think it's a bright future for all of us. So with that, we're going to close it out. Please join us on the next panel for the RWA blockchain adoption. All right. Thank you all.
See you guys.
Avalanche. We're joined by Hyperledger. We're joined by Stellar. We have Polygon, and we have Coinbase joining us shortly. So thank you all for coming on. I am very excited for this panel. I think it's something that a lot of people are looking forward to. It's definitely something that's been requested. So without further ado, let's get into some introductions. Morgan, why don't you kick us off?
Sure. I'm Morgan Krupetsky, Director of Institutional and Capital Markets Business Development at Avalabs. And I just realized I don't have my little descriptor on the bottom, so I apologize for that. But in my role, I really kind of partner with the whole spectrum of financial services institutions, from banks to asset managers, hedge funds, private equity and credit firms, venture funds, and then on the other side of the spectrum, the more kind of crypto native liquid token funds, as they deploy capital into Avalanche and different companies building on it, as they use the various applications built on Avalanche, or as they actually build different applications and use cases themselves on the Avalanche blockchain. It's great to be here.
All righty. Fantastic. Colin, why don't you go next?
First off, Jason, thank you so much for having me. I'm Colin Butler, Global Head of Institutional Capital at Polygon Labs. Polygon can be thought of as an Ethereum scaling solution. Look forward to the panel.
Great. Daniela?
I'm Daniela Barbosa. I'm the executive director of the Hyperledger Foundation. And thank you, Jason, and the rest of the team there. I think the work that the security token market reports are doing are really helpful in the description and the definition of what this market really does. So we really appreciate that. I have been the executive director of the Hyperledger Foundation since 2021, but been here at the Hyperledger project since 2017. And for those of you who don't know Hyperledger Foundation, we're part of the Linux Foundation, which has for the last 25 years really been the home for open source code projects, including obviously the Linux kernel, but Kubernetes and cloud computing, PyTorch and AI, newer projects like the Open Wallet Foundation. And these are all open source and openly developed communities building core code projects that are implemented in large institutional organizations. Hyperledger since 2016 has been the home for blockchain and blockchain related projects. And today we have 13 different projects and 50 different labs that really address what the need for blockchain and tokenization is at the enterprise level, and the ability to have these code projects that are really not just open source, but openly developed with communities as global communities as we continue to grow. So I'm very excited about joining this panel today and talking about some of the work that our community is doing. So thank you.
Absolutely. Thanks for joining us. And Rob, certainly, last but not least, give us your intro and what Stellar's doing.
Yeah, even though I come last, I need to reemphasize the congratulations for what STM is doing, and particularly for this conference. I've been seeing the lineup, and it's very exciting to see all those players coming together on this, very promising topic for the next, decade or so regarding tokenizing assets. So I'm on the partnership side at the Stellar Foundation, specifically focused on what we call tier 1 assets. So regulated assets issued or managed by regulated entities worldwide. And we do have a dedicated team to support those partners. Some of them speaking tomorrow, like Franklin Templeton and Wisdom Tree. Others that engage with the foundation to kind of help them assess if Stellar is the best option or one of the best options, and how to kick off the project. So it's a multitude of people, from lawyers that you would assume, project managers, developers, and partnerships folks to try to grow that portfolio. So very happy to be here. Before blockchain, I was on TradFi as well, so more than 15 years in banking. So it's kind of easy to be on both sides of the table here as we talk about the projects that we want to get done.
Very cool. Well, we're excited to see that perspective as well on both sides. Well, we see a comment already in the Q&A from Jamie. Avalanche and Polygon, go at it, fight. This is meant to be more of a collaborative. We're trying to learn from each other here, but I do encourage some friendly competition as well. But before we get into any of that, anything blockchain specific, let's go a little bit more agnostic. Crypto and NFTs certainly are fun. They definitely have their own use cases, but how does blockchain affect real world assets?
I'll take that, because, we here at the Hyperledger Foundation, our community has been working on all the boring stuff for the last, 8 years. And a lot of the, tokenization projects out there are things that are not sexy. They're not, big splash headlines. It's really about creating efficiencies in the markets, efficiencies in markets that now need to be 24/7, whether it's supply chain or trade finance, or obviously just moving money and value across countries, whether it's central bank digital currencies or other types of platforms. We're seeing a huge amount of ROI after many years of work. And remember, these are enterprise systems. It is a big digitalization thing. It's not just about, hey, we got a blockchain, we're going to put our assets on a blockchain and make it work. These enterprises, these multinational companies, financial infrastructure that has regulatory requirements behind it. It is not fast moving. Roberto said 10 years, some will even venture to say it's going to be more than 10 years. People ask me all the time, when is blockchain going to be a thing? It is a thing. And we're seeing huge amounts of reports coming out over the last 13 years around that efficiency in the markets. Things like dispute regulation, resolution for these large, trade finance systems where they're, down to like 70% of disputes in their trade network. That is a huge amount of savings, not only in time, but once again, in people, resources that they need to do. We're seeing, supplier onboarding and in trade networks where the reduction is, over 1.5 million, and all these case studies are on our website. If you go to hyperledger.org with this ROI numbers, where, over $1.5 million of revenue are being saved per year in just supplier onboarding for, companies and ecosystems. And that's not, people don't think that's sexy and fun, like we don't have panels about this stuff. But the reality is the technology and the implementations of the technology in real world assets and real world use cases are there. They're providing value. And certainly a lot of them are being powered with Hyperledger open source projects worldwide, and happy, later to talk about some of those. But that's our perspective. We're a long way off. But it's very exciting and there's real value here. And the companies now get it, right? And you see them over and over. Last comment on this, last year when FTX failed, right? It was fraud. It had nothing to do with blockchain. What did you see? Saw all the big financial banks and all at the C-level suite coming out and saying, hey, it is not about the technology, right? This was not about the technology. We have projects. We have had projects for a while. We're doing this work. And I think that's what is exciting. We keep getting one step back, but 15 steps forward. So it's great time to be in the industry for sure.
Yeah, and I can take a segue here, just trying to materialize some of the examples that we've been coming across where real world assets have been bringing practical benefits to people, starting from the very basics. My name kind of give it away in my accent. I'm from Brazil. I do travel a lot to Argentina, Brazil, and some of our Latin American countries where we have presence with partners. Just by growing in the 80s and 90s there, or even today, to be honest, for you to be able to have access to a more stable currency just for the sake of protecting your wealth or just making sure that you get some sort of reserve of wealth, it's very challenging due to regulatory and technological aspects. A lot have evolved, so I don't want to be dating back to the 90s, but even today, for you to hold dollars in Brazil, for example, it has to be through a regulated fund with administration fees and some sort of prerequisite on a KYC perspective. The same in Argentina, right? And with stable coins like USDC, Paxos and others, you would be able, and there's people doing that on wallets on Stellar, and pretty sure doing that on other of our colleagues' platforms here. So I think that the just very simple use cases that are not available to many emerging countries and some geographies, even positioning yourself on equities, on companies that everybody heard about, like Tesla, Apple, and others, but you don't have access to those shares, right? Unless you're really a big investor or a client of a multinational bank. So those things can be quite easily enabled through blockchain and tokenization of real world assets.
I think people, like to your point, Roberto, I think people a lot of times take for granted just how impactful just the growth of stablecoins has been, and kind of not just giving historically those who maybe haven't had ready access to it, but just even the atomic settlement and swapping of these things, not only what that means just for retail use cases, but even wholesale banking use cases, and enabling the atomic swapping of two currencies, which in turn reduces counterparty credit risk and opens up kind of all this historically trapped capital that's trapped as a result of collateral and initial margin. Like, these are all the things, Danielle, that you were saying that were the unsexy things. But I think part of it is those are the things that we saw maybe weren't working that great when we were in TradFi. And the things that, at least for us, kind of get us out of bed every morning is kind of operationalizing these things, where for the end investor, oftentimes they don't know or frankly shouldn't know that they're using blockchain rails or a tokenization wrapper, but it's the thing that basically enables them to have access to something that historically they didn't have access to, or a better user experience, or a lower cost of capital, or a higher return, because certain third-party service providers and intermediaries aren't necessarily necessary in those cases. These are kind of the real world things that I think span the spectrum from retail end users all the way to institutional end users.
Absolutely. Lots of different perspectives here for sure. Roberto, I'm really interested in, what you have to say for this next question that came in the chat, because I identify with it too. The other portion is, remittance payments. We've seen those be quite expensive over the years. And for some people, it may not make a difference for those sending, but maybe for those receiving, it does. And that kind of aligns with this next question from the chat, which is, can you speak on the partnership with MoneyGram and Stellar? Also, can you talk about some of the projects that are tokenized on Stellar?
Yeah, it will be hard to keep that short, but I'll do my best. I think with MoneyGram, this was a kind of a natural progression of what Stellar has been doing since 2014. So I think the first use case that really struck our community was cross-border payments, and especially for retail, and just to make it less painful for people to remit funds to their families. So we started with smaller players because we were a small player, and as we learn and improve our features, and we invested a lot on KYC and interoperability capabilities on top of the Stellar protocol, that kind of triggered the attention of bigger players. And MoneyGram was the one that ultimately, for multiple reasons, we landed on a bigger partnership. It started with the idea that any agent on the MoneyGram network, which is roughly 330,000 agents across 170 countries, but I might be off by a few countries or agents, is that you could use any wallet that operates on top of Stellar and call their API to use geolocation, give them a PIN on basically the teller of the mom and pop shop, and either give cash in whatever currency you're in the country, and you get deposited the converted USDC to your non-custodial wallet. And the flip side, right? You would be able to get your USDC from, Coinbase, Kraken, wherever you purchase it, sent to a non-custodial wallet, and then cash it out through MoneyGram. So the first idea here was just to increase the footprint, right? Like a lot of arguments on why blockchain is not mainstream is the lack of accessibility to the everyday person. So that was the barrier that we were trying to overcome there. Now we're gradually increasing that portfolio with MoneyGram with their own wallet, and then turning this as a potential crypto Venmo, right? Just allowing people to pay to each other cross-border real time using a wallet. And we want to come a time where people don't even realize there's blockchain behind these things, right? Like it's just operating in a seamless and convenient way, but leveraging from the brick and mortar infrastructure that has been built, right? We should minimize that. So that's the MoneyGram aspect there. About other projects, I think I could maybe park it for later, but Wisdom Tree and Franklin Templeton has been the two biggest one regarding tokenizing actually securities and stable coins and commodities. To be honest, there's quite of a breadth of portfolio here on Stellar, but it's still early stages for us to test the adoption and the features there. And I'm happy to share that there are many banks from Europe and North America in the process of testing tokenizing regulated assets on Stellar as well. So yeah, I'll pause there, but there's a lot of exciting stuff, and I'm sure my colleagues also have a similar pipeline, so happy to hear.
100%. Thank you for that, Rob. I do want to steer back the conversation back to tokenized RWA, so that's a great segue. But before we do, we want to welcome Anthony Basili from Coinbase. Thanks for joining us, Anthony. Can you kindly give us an introduction to yourself and what you're working on?
Hi, everyone. Thanks for waiting on me. I'm sorry I'm late, but glad I made it in via mobile. So I'm Anthony Basili at Coinbase Institutional, and I lead a number of different businesses, but one of them in particular that's relevant to tokenization and real-world assets is called On-Chain Solutions, and it's a newer effort here at Coinbase that we put together that kind of brings together our institutional business and our support for multiple networks, including our partners here on the phone, but also Base being our newest blockchain that we've launched as well. And so the way that we're focused on tokenization today is a lot of folks start with Coinbase, and they start with the wallet, and they're looking for a network, a place to list their products, to use smart contract composability. They're looking for apps to be able to utilize the power of their products to come on chain. And so, for Coinbase, we kind of hit this point as a firm where scaling becomes incrementally harder the bigger you get in terms of launching new products, and we want to make sure we're doing our part to bring what we vocalize as the next billion users on chain. So to do that, we thought launching Base as a blockchain would be a natural evolution and kind of bringing users who are already in the Coinbase ecosystem and are already part of that early on ramp into engaging in digital assets to come on chain and start to engage in products on chain. And so our focus is holistically today, bringing users on chain to have them engage in open finance Web3 ecosystems, Base, Avalanche, Polygon, other networks included. So on-chain solutions kind of brings the full infrastructure layer of Coinbase together. So that's Coinbase custody, Coinbase wallet, our relationship with Circle on USDC as a liquidity instrument, across multiple networks now. Our footprint globally, having fiat on-ramps and off-ramps in, more than 80 different countries around the world. And a lot of that infrastructure are things that folks kind of have to put together themselves with different players, right? And that's actually pretty hard. So the early adopters have pursued that and put together their own, call it vertical tech stack. Our approach today is actually to bring that vertical tech stack together as much as we can through bringing a solutions-oriented product set to our clients. So that's what we're doing today, and now we're focused on real-world assets as a component of the things we want to bring onto Base and other networks as well. So this isn't for Coinbase just a tokenization real-world assets theme. For us, it's broadly across all on-chain categories, but certainly the addressable TAM, the amount of impact we can have on the financial system within tokenization and real-world assets is a really important objective for us. So glad to be here. And I'm sorry I missed the intros earlier.
Not a problem. Thanks for joining and for that intro. And before we actually go into some of the institutional questions that I did have on RWAs, I did want to ask, you brought this up, Anthony, is bringing on more users on chain, right? I want to hear what each of you is doing to, help onboard people, educate them about, how do you use a blockchain? How do you create a wallet? Morgan, you previously talked about how maybe sometimes you don't even have to experience, such a complex, situation. You could make it a little bit more person friendly, if you will. So Anthony, let's kick it off with you actually, and then maybe I want to hear from the rest of you as well. But Anthony, when you guys launched Base, you guys had on-chain summer. Talk to us a little bit about what that was and how did that, generate people to come on to Base.
Yeah, so I'll speak to it from, so on-chain summer was certainly a really exciting endeavor that Coinbase put together. And a lot of that was about creating, creating excitement, for folks to know that Base is a new chain that's out there that people should go on and explore. And we launched with dozens of apps on day one that were doing all kinds of things from traditional DeFi to NFTs. One of the exciting applications that really took off, which is really great to see, was Friend Tech, which is one of those examples of you don't really know which app is going to catch the wave, right? And really get people excited about using it. But the way that Friend Tech integrated Base as a blockchain solution, but had a really seamless consumer experience for users in the app, for what we consider maybe as the future of kind of social networking, that really kind of set the tone for the power of using scalable backend blockchain technology with a front-end, easy-to-use consumer interface, right? So on-chain summer was all about activating our customers to be able to go on-chain and do so safely. And so it was actually really easy to go into the Coinbase wallet and then kind of navigate over to Base and move your Ethereum over and start to engage in different apps on-chain. That's now ended. We're now in, maybe it's on-chain fall. And we've kind of shifted to really focusing on that core group of applications that are building and that want to come onto the Base network today for Base in particular. And for tokenization in particular, this is actually a much more institutional conversation. And so, something like an on-chain summer is really interesting for the retail audience who finds it easy to bring crypto on-chain and navigate with crypto apps. For an institution who's looking to bring traditional registered products, for example, on-chain, there's a number of different layers of complexity around licenses, regulations, compliance, KYC, permissioning that you have to answer, around tooling as well. That becomes really important around safety and security of your assets and ability to scale that across a large enterprise. So the way that we're, to answer the question, the way that we're helping our clients on the institutional side to navigate this is through this effort of on-chain solutions, right? Where we in our institutional business are taking a kind of multi-network approach, right? Where we say, like, we've got a modular tech stack. You can use wallet, you can use custody, you can use USDC, fiat rails, et cetera, and utilize those to simplify the process to navigate around different networks, around different tokenized products, and bring those on chain. There's a lot of folks that are which are joining us on this call on different panels that already have different pieces of a tech stack as well. And so you're gonna bring a lot of this stuff together to create the full end-to-end seamless solution for tokenized assets on chain.
Very well. Yeah, it's the two sides, right? You have the retail investors that may want to come on board, but you do have to provide tools for the institutions to also want to come on board. We've seen headlines come out. Sometimes they're just headlines. Other times they're actually building stuff. They're actually tokenizing assets and deploying them. So I want to hear more about your perspective from each of you on, what are the biggest asset use cases that you guys have seen, and what tools are you providing to further onboard institutions into this realm?
Yeah, I can chime in, and as I think I relate to a lot of what Anthony said between the retail and the institutional relationship. It's very different. That's why we kind of split the folks within Stellar talking to those partners and fintechs, just because on the retail side, there's a lot on the user journey, wallet, UX, speed. And on the institutional side, it's a very different conversation. You usually get lawyers in the room right in the beginning of the meetings, and we talk about regulations and things like that. So I think we're learning through this process, as I'm assuming all of us are. But one thing that's helped us a lot to help those bigger institutional regulated partners that want to really do something is to have a functioning sandbox. So we actually have two sandboxes. We have one custodial and one non-custodial, and you can literally issue a stable coin or a smart contract and play around with controls, parameters, KYC. And that is something that is quite stable for you to demo to your own management committee, steering committee, to potentially approve a POC becoming a pilot. The second part is just making sure that we have most, if not all, the basic features that you would need for a regulated asset built into the protocol. So try to depend less on additional layers of logic, so you get it more performative and more trustworthy from a code perspective, because the protocol has been audited many times. So if you think about things like clawback, freezing, whitelisting, blacklisting, external authorization, multi-signature, that's all been built into the core of the protocol. Therefore, people know that it's been audited many times, as the protocol has been tested by thousands of assets at this point. So those are things that have been helping, and we're learning to even help partners talk to regulators. We're not giving legal advice, we're not joining those meetings, but because we've been in many conversations, at some point we kind of anticipate what questions are going to be asked, and why, to a certain extent, we think Stellar has some of the features that would appease and please the regulator on what concern a regulated asset being issued on chain.
I know we're supposed to fight, but I agree with everything that everyone has said.
They're supposed to fight.
I was also just going to say, it's funny. One time someone asked me, they're like, how do you convince banks to use blockchain? And I'm like, I don't, because we have enough institutional partners at this point who are like far enough along in their journeys and who have been progressive enough in the space and in tokenization that there's relatively lower hanging fruit to kind of focus and hone in on. I think a lot of the work that we've been doing with our institutional partners, particularly as they build on Avalanche subnets or custom blockchains in the first instance, is a lot of education around how our solution effectively gives enterprises and institutions the best of both public blockchain development, infrastructure, DeFi innovation, robust developer communities, as well as the controls and the idea of owning your end-to-end blockchain environment that have historically, driven them to launch on what we would call enterprise blockchains. And I'm sorry, Danielle, I know you represent Hyperledger. But in this way, a lot of institutions are kind of looking at subnets as like a stepping stone into the public domain, while still enabling themselves to consider and meet internal and industry-wide regulations and other types of considerations. I think similar also to what Anthony and Roberto were saying, I think from an L1 business development perspective, we spend a lot of time ensuring that we have the right kind of institutional grade infrastructure integrated with our protocol to ensure kind of fully end-to-end tokenization solutions and strategies operationalized for institutional partners. So things like not only the applications, but also dev shops and requisite support, custodians, digital transfer agents, wallets, stable coins, all of these things that when you put all the pieces together kind of really help institutions, again, operationalize their tokenization use cases. And then the last thing I would just say is from our perspective, there's a lot of us that come from the traditional financial services space. So over time, we ultimately form like trusted advisor relationships with a lot of our institutional partners where, we help them kind of get through internal and external stakeholder governance and approval processes, help them get regulatory approvals, help them position their business cases in a way that resonates with their businesses respectively, and helps them kind of in turn address any blockers that they may have along the way. So I think between the tech side as well as the kind of trusted advisor side, that's the way that we've really been partnering with our institutional partners.
Yeah, Jason, you're going to be super disappointed in this conversation in particular. Unfortunately, because I also have to agree with Roberto and Morgan. If you're thinking about the institutional conversation, they're not coming in at the 101 level, they're coming in at like the 401 level. And they really want to understand how they can participate in essentially the rewiring of the global financial system. And that is what's happening at 1,000 miles an hour right now. Like literally the four other panelists on this call are literally the busiest people in crypto. Like if this is a bear market, I do not want to see what a bull market looks like for the folks on this call, because none of us would survive. Like we all could work weekends. I could work 24 hours a day.
We want a bull market though, to be clear.
Oh, that's true, by the way. We do want a bull market. Just I don't want to misphrase. But what it looks like to me is the numbers that, for years, and I got to give a lot of respect to the people that have been working on this for years and years, including president of Avalanche, John Wu, right? So you can look at his old kind of webinars and podcasts. He'll talk about these massive trillions of dollars coming on chain. And I see it happening. Like I see this as the inflection point. It's happening right now. HSBC is going to say 19 trillion by 2030, whatever it is. The second worst part about this conversation, it is the unsexy part of probably the whole conference, because what's happening is it's the rewiring of the basement. It's the back office. And so nobody's really talking about it. The public's not aware of it, but it's going to change the whole landscape because of three major things. One, cost savings at the banks, large investment managers. Two, increase in revenue. And three, de-risking of the system. And then you add things like, fractionalization and 24/7 trading and the ability to use collateral. Like everybody on this call is going to the same place. And here's where I may say something controversial. It's probably the only controversial bone I have in my body for this call, is that we're probably all going to wind up working on it together, because you can't have fragmented liquidity when you're attacking 8 billion users. Like they're not going to be like, oh, but I'm going over to the Stellar blockchain to move my assets today. Like that's absolutely not the user experience that any of us could ever engender. So over time, we're going to develop the technology, and it's ultimately going to be all through connectivity. Our version of that, here's maybe the controversial plus one, is our view at Polygon is that it's based on zero knowledge in the future. So the whole industry over time, I think, probably coalesces around that idea as the highest in security in order for us to be all interoperable. But that's also TBD, right? The industry changes minute by minute, but Polygon spent $1 billion on that technology. So that's our vision for the future. And quite frankly, we're looking to work with everybody on this call to contribute to the blockchain future in whatever form that is. But for now, for us, I think we're going to be kind of leaning into that as a way to bring everybody together in an interoperable fashion that's highly secure, that does support the mandate for all the institutions that we're all here to service.
And I'll add, Morgan, you don't need to apologize about enterprise blockchain, and the definition itself needs to be relooked at, right? What it really means, because the reason that you are all walking into those rooms and they have institutional knowledge about what blockchain and what the technology itself does, that 4.0 knowledge, is because they have been involved in enterprise blockchain use cases. And today, at the Hyperledger Foundation, we've actually, grown the types of projects that we we have, for example, Hyperledger Besu, which is an Ethereum virtual machine. It's been in the foundation since 2019. It has a very healthy ecosystem, both on the permissioned blockchain side. We saw recent announcements like the City Token Services that is on Hyperledger Besu. Some of the largest central bank digital currency projects are using Hyperledger Besu. What's unique about this community and the work that they're doing is that it's enterprise grade. They're focused on building enterprise grade solutions to bring to the market that are secure, that have, multi-vendor support within the ecosystem. But very importantly, that are starting to meet the needs of the enterprises today and in the future. So Besu, just as an example, actually is an execution client on mainnet, on Ethereum mainnet as well, right? And there's a lot of interoperability work happening today in the foundation that is supporting interoperability between permissioned, pure permission networks, public networks, and obviously, and all of you, minus Coinbase, I don't think we're there yet, with projects like Firefly, for example, that support Avalanche, that support Polygon, that support Stellar, that support all the permissions. So I think, the reason that we're here and we all feel we're here and that we could talk about the plumbing, Colin, I call it the plumbing, like it's the plumbing of the new financial infrastructure. And what we're excited, because when we all got involved in this, and at least myself in 2016, I was most excited about the fact that I knew that financial systems, I was at Dow Jones for 17 years, were going to be rebuilt, and I wanted to be part of it. I wanted to also have like this opportunity to do it in the open, to do it collaboratively, right? And that's what Hyperledger brings to the market is we're coalescing these users. For example, we're having a workshop in early November where we're bringing the banks and financial services to talk together about what they need these protocols to do, right? What are they building and how do they need it? So collaboration is so essential now. Fights are great, and I love panels when people are fighting over things, but I think we're all in agreement, right? We all need to work together. It is not going to be one blockchain to rule them all. It's a known fact. Maybe in 2016 you could have convinced me that might have been the case, but that's no longer going to be the case.
I'm glad to hear
and just a quick note. Sorry, just a quick note. I think for the audience and whatever legacy we're leaving from this panel, the collaboration is much more constructive. I know that the argument sometimes is exciting, but the pie is growing so fast that I think we don't want to steal anybody's piece. We want to make us to work together. I think the comment that the banks are not coming one-to-one, they're coming one-to-many, and therefore they want to feel the confidence of getting similar answers from different protocols. I think it's very strong. And there's been a lot of attempts of doing multi-layer solutions. For example, from Hyperledger Besu is being part of the CBDC solution with a layer 2 on permissionless chains. And then, we need to work together to make sure we're using the same terminology and we're thinking about sharing liquidity. So that gets me much more excited than actually bumping heads, to be honest.
I'm so glad that this is the sentiment. As I said in the beginning of this webinar, we're here to collaborate. We're here to learn from each other. Obviously, you guys all have different levels of experience or narratives based on the conversations you're having. So, Jamie in the audience, sorry, man, but you didn't get your fight.
Just reading his comments.
But it's always fun, nonetheless. And we've seen tokenized assets go on, the same asset on multiple chains, right? Which is really cool. So let's shift it back to the real world assets. You're all working with them. You're all doing something. Is there a common issuer theme? Is it private equity? Is it private credit? Or, what's it look like? What are some of the key themes that you're seeing from the people that you're either working with or that have issued on your blockchains?
Jason, I'll start, and because mine will be the shortest, because we're the new kids on the block here. So we just went live with. So I'd say the theme is treasuries on chain. It's yield on chain for digitally native users, right? So users are accessing tokenized treasuries, tokenized money funds, types of products to make sure that they're capturing yield for as close to risk-free as possible. In different ways that they can get it. So there's a lot of different versions of this happening across multiple different networks. And, we just launched with Backed just earlier this week, our first, tokenized treasury on Base network issued out of Switzerland under the Swiss DLT regime. I think we're the 7th chain in that launching sequence, right? So to your point about kind of cross issuance across different networks, right? You're certainly seeing that play out, which I think is fascinating and really interesting to watch, just to see how users gravitate towards towards a product across multiple networks. And that's a concept that I don't think really exists in TradFi, right? In the closed loop systems of TradFi, you have one firm that makes products available to their customers, and you don't get that level of interoperability or maybe choice, right? So to speak, for most participants. With this stuff being on chain, anybody can come from any network, right, in their wallet and connect to their chosen network, their network of choice, and access a product. So that just launched this week. We've got an interesting pipeline of things across different asset classes. I spent the formative part of my career in the buy side and managing large institutional portfolios for our clients. Portfolio construction is difficult. My vision is that portfolio construction happens in the wallet, and it'll be really easy to navigate from product to product across networks. Maybe the networks themselves get abstracted away at some point, to Colin's point earlier. But I'd say most of the focus today is tokenized treasuries, making that particular product segment work. And we're retooling it in a lot of different ways across different networks and different regulatory regimes, so that the market's getting pretty smart about how to capitalize on that one product segment. The rest of the stuff feels really POC to me. I'll open it up to everyone else.
I was just going to say, Anthony, I think there's about like 30 tokenized T-bill and money market fund teams that we've met with over the course of the past year. So yeah, I think a lot of them in the first instance, a lot of those teams from a go-to-market strategy perspective are trying to hone in on crypto natives as a way to kind of diversify exposure to non-yield bearing stablecoins. I think that part is still trying to be figured out in terms of what the product market fit might look there. But I think to the extent that those tokens can generate greater utility, I think the better. But definitely many focused on tokenized T-bills and money market funds, as well as different types of stablecoins. On the other end of the spectrum, I would say, in terms of what we're seeing, is really focused on alternative assets and private market securities, whether it's private equity, credit, infrastructure, real estate. And that really is a very big focus, actually, for both individual protocols as well as for large institutions. And I think part of the reasoning behind that is just that that's the area that's the least standardized from an administration perspective, as well as the most operationally intensive, and therefore probably the one that stands to benefit the most in the first instance from putting fund admin, accounting, reporting, and other things on chain to kind of make lower deal sizes and lower investment minimums economically viable for GPs. And then at some point, I think there's like general consensus that everything's going to be tokenized, or every security is going to be tokenized. But in the first instance, I'm kind of seeing thematically focus on the extremes from a liquidity perspective.
Yeah, I think just to add a little bit to what Morgan said, if you look at what KKR and Hamilton Lane did on Securitize, I think that's a typical example of things that are coming first because there's a large use case. And in both of those cases, that would be an increase in distribution, right? It's like the idea that you can lower minimums and get to a wider cross-section of people globally. It broadens ultimately your distribution and increases your revenue. So you start with kind of the simple, obvious, low-hanging fruit, like massive increase from the prior solution for whoever the product creator is. And then eventually on the other end of the spectrum, you get to like equities, which are already very efficient. I would say there's a much tougher argument that blockchain is going to significantly help that space. But somewhere in between, call it private equity and funds, which is what we're really seeing now, and disrupting equity markets or the plumbing of the equity markets, there's going to be like structured products, there's going to be bonds somewhere in there, derivatives, the things that may trade every once in a blue moon or would benefit a lot from blockchain. Those are the ones that are going to be first. And I think, again, with what Avalanche did in Securitize with KKR, like that was really kind of the first mover in that space. And then from there, there's kind of a spectrum going into the future.
Yeah, and I'll add, from concerns from, interoperability. And, I do think that a lot of the reasons, and I don't know who said it, about POCs, a lot of the reason that a lot of this work is still in POC stages is that, it's a big commitment to select one protocol, one, format, and how do they go about doing that. So I think interoperability and making sure that there's interoperability that is not about creating connections between everything that needs to get done, but more, and we have a project called Hyperledger Cacti that's addressing this more as as an SDK of SDKs, right? You're not building every time you need to connect into a new protocol. You're not building a new plugin. You're just using what's available there. So we're hearing very much across the world that interoperability and making sure that if they make a selection, that it's going to be a long time, infrastructure selection, that it's going to be able to, to be used for a long time, because these are costly. All of us who've been in the other side, we know these are very costly, not only to build, but to maintain. And the technical debt that comes with making the wrong decision is not taken lightly at these organizations, for sure.
And just a quick note, I think there's always what's next, but there's a lot to be done on what's present. I think the stable coin and the treasury tokenization, there's still a lot to be done in the sense of getting access to people that don't have access right now and might benefit from it. So if you think the dollar, the euro, other global reserve currencies, that is a form of hedging wealth, and it's not easily accessible in many wallets and layer ones, and the treasury tokenization, I think, also connects to that idea, right? It tends to be a safer investment. It is pegged or close to a currency, and you got the safety of earning some yield. So I think there's a lot to be done there on the accessibility, on the interoperability, as Daniela said, and we're working still very hard on those present use cases while we look a bit into the future. I think into the future, real estate has come a lot to us. Real estate funds is something that folks are talking as more of a barrier to entry portfolio that could become simpler as you tokenize it. And one that I'm particularly excited is just exposing emerging countries to S&P 500 and Fortune companies that are, harder to access as you're in other jurisdictions, right?
Absolutely. We're almost at time here. So I do want to thank all of you for, sharing all of your insights with the audience, with myself and with each other. So I'll give you a last chance to, go ahead and share any last minute words. Otherwise, we do have the next panel starting in a minute.
I just want to encourage everyone who's, over the years heard about Hyperledger to take a new look at what's happening within the foundation and to join us to really, help build this new infrastructure and these new solutions in the market. And I think that, open source and open development and really collaborating together is what we've been doing here at the Linux Foundation for the last 25 years. And it's going to be critical to getting these technologies across everyone here today, and even more into these firms and into governments as well. So thank you for having us.
Yeah, similarly,
Thanks
we've done some work. Oh, sorry, very quickly, we've done some work reorganizing our content and brand as well on the Stellar side. So I encourage people to visit us as well. And particularly on the logic layer, we're launching our smart contract platform called Sorobun. So hopefully that's something that will spark additional interest.
Yeah, the only takeaway that I would leave the audience with is the future is interoperable, and it's coming a lot faster than you think. So Jason, thank you so much for hosting. It's been a pleasure.
Thanks, Jason.
Thanks for joining.
Thanks,
Absolutely. Thank you all. All right, see you everyone. We'll give us a
Hear it from some of the top experts in the space. So I'm excited to get into it. Adrian, you and I have been a business partners for over 10 years now, which is incredible to say. Some people are questioning
some gray beards.
That old. Exactly. But why don't you go ahead and tell everybody who's watching and listening who you are?
Sure, it's a really pleasure to be here. This is an amazing conference you guys have put together, and I'm really flattered that you guys asked me to be on here. I'm Adrian Alvarez. I'm an attorney. I also have an MBA from the University of Miami. Been in the financial tech space now for, like I said, over a decade. Herwig and I founded a company, InvestReady, which was at the time called Accreditify back in 2013. And we do accredited investor verifications for Reg D 506C issuers and platforms. Also been doing consulting on the security token space for a few years now, also along with Herwig and independently. And then just in general, we help with different issuers and allow them to be able to connect with the investors and provide the service through our own Invest Ready platform as well.
That's awesome. And Daniel, I've had the pleasure of actually, retaining you and working with you directly, as well as, some of our clients on the advisory business have worked with you, all amazing rave reviews. Why don't you tell us a little bit more about your background and how you help the space out?
Well, thank you, Herwig, and good to be here with everyone. I'm Daniel Stabile. I co-chair the digital asset practice at the law firm Winston & Strawn. And equally important to me is the extracurricular work that we do. We wrote the first law school textbook on digital asset regulation, and I've proudly been teaching as an adjunct a digital asset regulation class at the University of Miami Law School since 2018. And we're doing everything we can to try to ensure that the regulatory environment stays fair and reasonable in the United States and creates an environment in which innovation can flourish.
Yeah, spot on. And I like that reference to the Hurricanes. That's an alma mater for myself and for Adrian. So go Canes. But last, certainly not least, Mr. Mark Powers, I get to have an amazing thing to say that you are both an advisor and investor in our company, as well as been pretty involved in one of our research consortiums. You have your own Powers Hour, where you actually go into it with many of our community to talk about the regulatory landscape. I know you're retired now, but you're still doing a lot for the space. Tell us your revered history, the incredible stuff you've done, and then how you're participating in the digital assets ecosystem today.
Yeah, Herwig, great to be here. I'm thrilled that you have so many people signed up for this program. I think it's fantastic. This TokenizeThis 5 years after you guys founded this being the inaugural one and being part of it is amazing. And it's great to be here with Dan. I actually, when I was going to start teaching and figuring out what I was going to do as my third or second act, I actually knew that you were down in Miami, and I had talked to FIU, Miami, a bunch of other schools down here because I knew I wanted to spend time down here. And so it's great to spend time on a panel with you. And Adrian, I knew of you because of through Herwig. I do want to throw a shout out again to Powers Hour, if I may, because that's the subscription service of security token market or group that they throw together, and once a month I pontificate on whatever it is that we think is kind of current and new and interesting, and people are able to kind of interact on, and when I go through analysis on generally different cases that come up. And so I will make one further correction, and that is I'm not retired without something after that. I'm retired from law firm practice. That's how I kind of talk about myself. So I kind of figured after 40 years of practicing, I figured it out. And so so now I spend my time teaching at FIU, both blockchain regulation and fintech law, one class a semester. And my career I started my career at the SEC in enforcement, first 5 years. As I was saying before we got on this open live mic, the case that I worked on as a junior lawyer at the SEC was SEC v. Aquasonic Products Corp., which involved geographical dental licenses, which the SEC brought an action against the parties participating in that and claimed that they somehow were issuing investment contract securities that should have been registered. And that case, we argued, was a security. It went up to Second Circuit. It was affirmed there. And that has become one of the seminal cases up in the Second Circuit that still is vibrant and is still cited even by current cases, all of which in this token space, security tokens. And so I think I have a little bit of understanding what investment contract is, given that, of being involved with it for 40 years. And since then, I was at the last 20 or 50 law firms, Reed Smith and then Baker Hostetler. I moved over to Baker Hostetler to build and lead a securities litigation SEC defense practice. And then I also began its hedge fund industry practice. And I left in 2020. And maybe a little bit longer than others, I apologize. But that's my background, and it's thrilling to participate and hear from other people's point of views on things and have people hear what I have to say.
No, I think that's great. Again, we got an incredible panel. We got, both perspectives, even though you're no longer with the SEC. We do have kind of your thinking there. We also have, Daniel on the other side, and then Adrian, who's actually one of the technology providers, providing a lot of the compliance software that helps power and make a lot of this technology legal in the first place. But before we get too technical and dive into the tokenization side, I think I'd be remiss that especially for everyone in the audience, the number one thing on their mind is probably, what do you all think about Ripple? And again, we're going to stick with you, Mark, because another toot for the Powers Hour horn here is you correctly predicted actually some of the outcomes in the past for some of the things that are happening. And so, I think it's great to get your experience, what you thought about the Ripple outcome, and maybe how that might affect the landscape moving forward.
Sure. So what's the landscape look like? And then I'll get specifically into the Ripple case. I think the landscape is pretty clearly set up that with, you have a chair, Gary Gensler, who I thought, unfortunately correctly, that knowledge is good and bad. And the fact that he had a tremendous amount of information and knowledge about blockchain and experience with it before joining the SEC and teaching a subject at MIT, people weren't sure if that was going to be good for the industry or bad. In my opinion, it turned out to be bad, right? And I thought it might be. And he's used, and I also knew, based upon his experience working at the CFTC, being the chair there, he was the only agency in the entire, of all the various executive agencies, administrative agencies, that implemented every single rule and requirement of Dodd-Frank, the only one, okay, by putting in swap exchanges and doing all these, and the like. So I also knew he was very ambitious and aggressive. He's now bringing that to the fore with this in the area of digital assets / blockchain regulation. So in a short version of this, if I may, is that the only way, in my opinion, things are going to continue to advance, not just for security tokens and fully regulated businesses that are using blockchain, but for those that are going to be outside of the regulatory sphere of the US and SEC. The only way that's going to happen, in my opinion, is either through the courts or through Congress, because Gensler's not going to do it. And it's clear he's not going to do it. I mean, he went, we'll get into it maybe a little bit, but if you think about it, Coinbase he went after because it breached the traditional way that the federal securities were set up of segregation of businesses, right? And he called out a conflict, an insurmountable conflict. So he's suing them for registration violations of being a broker-dealer, being a clearing agency, and for selling unregistered securities, all because it's all housed within one platform, the way that it's currently operating for security cryptocurrencies currently. So with that background, I also thought all along that in the Ripple case that the judge was playing down the road and would likely not give the SEC certainly the injunction. I wasn't sure whether or not she would ultimately find it to be a security or not, but ultimately she found it wasn't. And maybe that's not, it's the rationale one could question, because it ultimately, the way it's set up and the way she set it up, it provided for giving more disclosures and information to institutional investors who generally needed less than to retail investors. If you kind of cut through it. But I think from my early days from dealing with her in that case and following her rulings and participating by observing some of the oral arguments early on in the case, I thought she was going to be sending a message, and she did. That's what that case is about, because two things occurred. One, I thought that maybe she would not fund its security, but I'm not going to grant the injunction, which she could have done potentially. She could say it's not going to repeat itself, and she could have done that in the Ripple case because they're just an issuer. And as an issuer, all they had to do was say, we won't do that again. Or she could say there's not no likelihood of future violations. And she could have gone that route. But she went the full route of saying there's no security. So what happened there is you have the Ripple case, where she's clearly sending a message to the SEC. You should start thinking about reforming or being more accommodative to the blockchain space and what's going on in CeFi and DeFi, centralized finance and decentralized finance. And I think by her recent denial of the SEC's recent request for review to the Second Circuit immediately was fantastic from my point of view, because it really will hopefully put the SEC's feet to the fire. The only way you're going to bring them around is by forcing them to come around, because I get to my second point, if I may, and then we'll go back to Ripple and have everyone else's input on and their viewpoints on it, is the grayscale case. It's a triumvirate. There are three major cases that are out there. So Ripple, we have a decision. The second one I thought to be also a favorable decision in was grayscale. Okay, that involves issues relating to transforming a prior product of grayscale, which is a registered asset manager, of commodities, or Bitcoin, Ethereum, and other kinds of potential securities, but an asset manager that was trying to convert their trusts, which they created using Davis Polk, to set the whole thing up in a regulatory compliant way, to turn it into an ETF. And Gensler, because he controls the agenda and gets to direct the way he wants to have things come out. And there is, as we know with the SEC, the way it's structured, there are two Democrats, there always will be two Republicans, and the chair gets to be picked by the President of the United States. So that always provides for a 3-2 majority for the chair to have him followed or her followed, which is generally the case. And in the grayscale case, has, along with others, has continuously denied allowing a spot ETF, to be clear. It's a spot ETF we're talking about, to be allowed to be offered to retail investors. The DC circuit in that case knocked down the SEC again there too, basically saying their decision to deny a spot ETF when they allow futures ETFs to be allowed and traded in marketplaces was arbitrary and capricious. I thought that was going to happen, and it did. It was fantastic. The third shoe that's going to fall. So I believe by the end of this year that the SEC have no choice but to allow ETFs. Maybe they'll try and punish Grayscale and not let them be the first one. They'll push BlackRock ahead or something like that. We'll find out. Which is also a secret ETF. But I think the third shoe to drop, and again, it's a court, right? It's not the SEC voluntarily doing any of this. I think is the Coinbase case. Not the one where they're suing them for unregistered violations, which I mentioned before, but the one in which Coinbase is suing the SEC, which is being heard in the Third Circuit for failing to put forth regulations around blockchain advancement, and adoption. And I think there too, if you read if you saw part of the rulings there and part of your arguments, or the rulings, if I may say, I think there too, the SEC is going to lose. So the landscape, things will improve, not just for security markets, security token markets, but generally for the cryptocurrency markets overall, not because Gary Gensler wants to have that happen, only because he's got no choice.
Daniel, do you agree with all that? Do you think the SEC,
even some of it?
do you think the SEC is going to also take a couple losses here in the courts? How do you feel about the whole situation, given you have a whole host of clients in the digital asset space?
Yeah, I do agree with much of what Mark said. Let me just raise sort of a few points that I think are very significant. It's probably no surprise to our audience here that really the hallmark of the regulatory environment for digital assets in the United States is a lack of clarity. Unlike other jurisdictions in the world, there's no federal statute or regulation that governs the treatment of digital assets. And that's a problem because digital assets can have a nearly infinite variety of different properties and characteristics. So figuring out the taxonomy of which of these are securities, which of these are commodities, which of these are currencies, is really important. And Mark's right, the SEC here is taking a very aggressive approach of regulation by enforcement. There are people within the SEC, including very senior people, including commissioners of the SEC, who disagree with the approach. And there are other regulators in the federal government, including those in the CFTC, our commodities regulator, who disagree with the approach. So the battle that we're fighting in the industry is on two fronts. And I think that there's a relationship between the two fronts. The first is Congress. And unfortunately, I think the issue has become balkanizing. And it need not be that way. I mean, for many years, I've argued that this should be a bipartisan issue, and that there are things to like on both sides of the aisle of digital assets. And the most consequential piece of legislation right now is indeed a bipartisan bill by Senator Gillibrand from New York and Senator Lummis from Wyoming, who probably don't agree on many things, but they do agree that the SEC should be divested of jurisdiction over many different types of digital assets. So there are efforts to educate Congress right now and impress upon them the importance of having a clear and fair regulatory environment for digital assets. You know, right now, what is a security under US law? We're looking at statutes that were passed in the 30s and cases from the 1940s. And generally, the SEC is trying to shoehorn digital assets within the sort of catch-all phrase investment contract, and that's creating all sorts of problems. So the second front is in the courts, right? And I agree with Mark that there have been some important victories. There have been some important losses as well. So not long after Ripple, another judge in the same court, the Southern District of New York, which is one of the most important courts in the United States, issued a decision that really called out Judge Torres's decision in Ripple and disagreed. But there is one thing in common between the two opinions, which I think is very, very important. Unlike what many of us on this panel, presumably, and many people in the audience, I would assume, regard as traditional security tokens, tokens that have features and characteristics of what we think of when we traditionally think of as securities, equity interest in a company, some sort of profit sharing, etc. You know, with many of the digital assets that are the subject of these cases, you don't have those properties or characteristics. And what both Judge Torres in Ripple and Judge Raykov in Terraform said is that those digital assets themselves, XRP and UST, are not in and of themselves securities. That is really important, and that's something of a nuanced issue. The point that they were making is under certain circumstances, they can be sold in investment contracts in the same way that oranges in the Howey test, this is the seminal investment contract test, oranges are not securities, but they can be sold in a securities offering. So really the highlight from the decision in the Ripple Labs case is that the primary issuance, the direct sales from Ripple Labs to institutions of XRPs, that was probably a securities offering. That was a securities offering as the holding, because at the time, Ripple Labs was still sort of developing itself. There was a high degree of centralization. There was sort of an expectation that there would be an increase in value of XRP based on the efforts of Ripple Labs. But in the secondary market transaction, where you were just trading with anonymous counterparties, a lot of those things didn't exist. So that was not an investment contract. So that is, I think, really a watershed moment for the industry. That's what we've been arguing in many cases for a number of years, and it's starting to get a lot of traction in the courts. And I guess the final thing that I would say on the grayscale case, I think I agree that that is very important. So unlike in Switzerland, where I've spent the past week, we have no spot ETF for Bitcoin in the United States. And it appears that this decision coming out of Washington, D.C. has sort of cleared the way, because the decision from the court was that the SEC's decision to deny the application to convert to a spot Bitcoin ETF was arbitrary and capricious. And there's great language in that opinion for those who are interested in reading it. But I think the reason why it's important, or one of the reasons why it's important, is because it really helps to sort of normalize digital asset trading. There are big entities out there that really don't want or can't custody digital assets themselves. So the fact that you can have exposure to spot Bitcoin trading activity via an ETF could potentially open the floodgates for investment in Bitcoin. And one of the challenges that we're facing in the industry is this reputational stigma that I think is going away, but it still exists, certainly in the minds of some politicians. And when you have, major institutional ETFs and major institutions purchasing ETFs, that helps a lot to sort of normalize the industry sector.
Yeah, I think that's really good insight. I mean, to summarize of sorts, we're all agreeing that there needs to be clear, addressable rules and regulations for the crypto assets. The SEC is trying, or we're seeing some counteraction in the courts. Let's go over to Adrian. I think one of the big concerns or issues is that security tokens, they're completely legal. We have on-chain funds that are publicly registered. We have tons of traditional private securities that have been tokenized, many other use cases. However, it always seems to be that this stigma, this reputation that crypto developed due to the lack of clarity, seems to also drag down the tokenization industry, specifically around securities and debt. Do you agree with that? Do you think crypto asset regulation needs to catch up in order for security tokens to succeed? Can it succeed without that? I do want to end on Daniel's great point about the fact that securities laws themselves, the investment contract rules, they are very old within their own regard and may require some updating in order for all of digital assets to end up succeeding properly. What do you think about that?
Yeah, I think the main issue is that the SEC is trying to fit 20th century regulations onto 21st century technology. You could have a digital asset can allow you to have a store of value. It can be a currency. It could be a ticket to an event. It could be a collectible, and all of those things could be one object, which is in a physical realm is not a possibility, but in the digital space it is. And so there's a disconnect between what we've had in the past, which US common law, it's all based off of precedent. This is literally an unprecedented technology, and so it's going to take an unprecedented maneuver by regulators to be able to balance out the corralling of it, in that you're providing safety for the consumers that are doing it, but also allowing it to breathe enough to to foster the innovation and the potential benefits that we can reap from it. Just as a bit of a history lesson with InvestReady, we actually helped one of the first ever security tokens to launch it all the way back in the ice age of 2018. Where we had a friend of ours come to us and say, "Hey, I want to do this ICO," and then putting my lawyer hat on, obviously, like that's totally illegal and it's going to get you dinged by the SEC. But then we were able to set him up with a 506c. I think they ended up raising like $7 or $8 million through it, and I think that the token's still around today. And so there is a a stigma associated a lot with crypto, and that it's, you know, associated with terrorism, or it's associated with drugs, and, you know, all the Mt. Gox stuff from back in the day with Bitcoin. And in general, that I feel has kind of made it where we have two sets of completely different customers, where we have the crypto bros, you know, for any other to name them something, where they're very anti-government, anti-regulation, want to have the privacy of Bitcoin and everything else, and then we have the trade finance people that, you know, want to be able to utilize and digitize their space, just like every other space has been digitalized, you know, in terms of content creation. Everything else that we see in our society. One of the last bastions is the financial markets, because we have entrenched players that know what they're doing with the system that they have now. They have the pockets of the regulators and the lobbyists in Wall Street, and then we've got the up and rising crypto people on that side, which had a huge run with a lot of the bull markets that they had in the last couple of years. But I feel, it's like a war between the two sides in terms of the Wall Street side trying to basically both come into crypto and dominate it, as well as put down any potential competition from that has been sprouting up beforehand. It's a little bit of a game of whack-a-mole. I think, you know, just to go back to the original question with XRP case, I feel that it was decided poorly, but the outcome is better for the industry. I feel that because by saying that it's not a security, you're causing more issues later on. You know, if you were to secondary trade a stock, I mean, nobody's saying that that's not a security in terms of just a public stock that's on a secondary market, but yet having a private market for a token now and on the secondary market doesn't make it a security. I think it's going to end up getting reversed on appeal. I do like that she made it so that the appeal is not going to take place for a couple of years. So the SEC kind of has to work around that process for a couple of years and figure it out before then. My main argument, so I actually, when I saw the case was happening after the whole FTX collapse, and I saw the coming war between the factions, I was like, look, maybe using this XRP case as a vector. I ended up writing an amicus brief for on behalf of the SEC nominally, but the actual outcome that I was hoping for was that XRP would get grandfathered in. It would say, yes, it's a security, but in order to figure out whether it's a security or not, they have to go through some sort of decentralization audit. So you basically, taking the four prongs of the Howey test, which are an investment of money and a common enterprise with the expectation of profits to be derived from the efforts of others. That fourth prong, if you have enough decentralization within a token sphere, like Bitcoin or supposedly like Ethereum, then there's no others to be derived from the efforts of, because it's a decentralized blob in terms of who it is that the other would be. So therefore it wouldn't then transition from being a security into a commodity at that point, and then transition its regulatory process from the SEC into the CFTC, where we basically have a way to have a process in place to show, okay, I'm doing this token. All tokens are not securities, which is another really good thing that I think came out of that case, where it's not that, okay, default, if you do a token, it's default to security. I think that would have been too far. So that at least allowed for some space there, which is what the SEC was really seeking. They wanted full control over any tokenization. They wanted it to be default security and then move into it. I think having a way to transition it from a security into a commodity, be it through the courts, be it through the SEC regulation, be it through Congress, however we have to do it, that's going to be the way that we basically light the path to allow for these tokens to go through and say, okay, I'm making a token, I'm going to raise some funds for it through an STO. I'm going to go through this process. And then now in 2 years, if I do X, Y, and Z, it's no longer security. I can be freely traded wherever. And, there are some ways to do that, even if it were a security, but having the ability to just completely desecuritize some sort of token through a legal process that's laid out specifically, some sort of safe harbor regulation that would allow for the market to have an understanding of exactly what it needs to do, check the boxes to have to do this particular thing, and then, okay, now I'm going to be okay with the SEC. Or if the SEC comes after me, look, man, I checked the boxes. You can't do anything to me. So that's what we really need at the end of the day. Some sort of, okay, this is the list. You check this box. Yep, you're a security. You check this box. You're not a security. And then if you do these things, you used to be a security, but now you're not. That's really what we need. That's the clarity that's required of this industry that Gensler refuses to provide. And I think it's going to end up being forced upon him either by Congress or the courts.
Well, I gotta tell you, I sincerely hope that Congress is listening to this panel. I think you're all spot on. I got about 4 minutes left with each of you, just to get some brilliant thoughts from you here as we leave. Daniel, I want to go over to you. Let's stay away from the digital asset side. Let's assume I'm one of the many people in the audience here. I represent a portfolio of assets. I'm an asset manager. I'm an entrepreneur raising money. Maybe I'm starting to start a broker dealer in order to participate in this space. How can you help us? How does your firm work with individuals looking to get into tokenization?
Yeah, well, the financial services regulatory environment, even in the traditional realm, is amazingly complex. The most well-capitalized and well-lawyered institutions in the world, the big money center banks and broker dealers, get dinged by people like Mark. Well, he was a cub lawyer at the SEC, and his brethren there all the time, despite their best intentions. So it's very important to have knowledgeable legal and compliance counsel to help navigate that environment. So an issuer of traditional securities assets or digital assets that we regard as securities, has to consider, among many other issues, how to do a compliant offering, right? So are they going to do an offering pursuant to Regulation D, sort of a private placement type offering, or are they going to avail themselves of one of the other registration exemptions like a Reg A offering, or are they going to go for it all and try to do a public offering? And so that's just one of many threshold considerations for an issuer of securities, and there are pros and cons of each of those approaches. For broker dealers, they often require licensure with the SEC and membership with a self-regulatory organization, an SRO like FINRA. And that can be a challenging process to undertake. And I think that for early stage companies, really a piece of advice is try to get the legal and regulatory strategy right from the outset. That will save time and money in the long run. And, entrepreneurs have great ideas. The whole move fast and break things ethic has, created really an engine of innovation in this country. But when you're talking about the financial services sector and you're dealing with other people's money, my recommendation is resist that impulse at least a little bit and pause to really get the legal architecture and the compliance structure right from the outset.
Yeah, because if you break something with somebody else's money, they'll sue you.
Yeah, right.
Problem. Well, I can tell you from firsthand experience, Daniel and Kim and the whole team over with you at Winston, they're absolutely the right people to be talking to figure this stuff out. Mark, we're going to head to you for your last thoughts here. I want to ask you, you're so good at predicting things. You got such an insight onto the space. What do you want to leave us with to look forward to for 2024?
The Loomis Gillibrand legislation, I think that's the one that should get the most traction and will, because it's coming from it's bipartisan, and look for that implements and puts the CFTC as the primary regulator. I think that's going to happen. I mean, SEC Gensler is a political, he's astute individual, but I'm hoping given the fact that most of these assets are not easily characterized as securities, that's actually the place with it, and more money is given to CFTC to deal with it. The only other thing I'll mention, which is always very interesting, and to follow up on Adrian's point, is he says, there needs to be some clarity in safe harbor. Well, guess what? Back in 2020, and again in 2021, SEC Commissioner Hester Peirce put forward safe harbors precisely to address this. Chairman Gensler, if you're listening, start seriously considering her proposals, because those laid out, depending on what you become after 3 years, whether or not you need to be, you'll be deemed a security or not, and allow capital raising and small businesses to be able to grow with seed capital. Those are my thoughts.
I think that's absolutely fantastic. And again, for everyone listening at the STA Success Network, our research consortium, will learn more about that tomorrow. You can tune in to Mark Powers' monthly Powers Hour, where you can get these insights every month. Last but not least, of course, Adrian, I want to give you a chance to just give a little bit of a self promo about how InvestReady works with the industry, and maybe, give us an illusion of what the future looks like. Maybe it looks a little bit more like, instead of you get a call from an individual and hearing a pitch in person, you might open up an email, check your compliance, and then end up buying a token. It's a very different way of investing. Tell us about how InvestReady helps power all that.
Sure. So we're primarily focused on helping people through private placement verification, though you can use it for Reg A or Reg CF. If you're an accredited investor that's been verified, you have unlimited, you're not limited in how much you actually can invest there. So InvestReady helps platforms comply with Reg D 506C specifically. We verify if someone's an accredited investor via income, net worth, or third-party letters. We handle the entire process for the issuers or platforms on their behalf, and even contact the investors if there's some sort of issue with the process. We actually just launched this past month, which happens to be our 10-year anniversary for InvestReady, in by InvestReady, which is our new newsletter platform that's allowing for the issuers that send us their investors to get verified to actually reach the rest of our network with a newsletter that goes out every Monday that lists not only the deals that we get from our own issuers, but we actually pull SEC Edgar data and get all of the issuances from the past week that investors could then go in and research, call up, and get information from if they're interested in going to the Reg D 506C route. We're also allowing for anybody that wants to promote their Reg D 506C listing to get on the newsletter as well, besides just being the past week. So if anybody's running any sort of Reg D 506C is interested in getting onto the newsletter, I think last week we sent it to over 16,000 people that we have on the list that we have permission to email. So it ends up being something that is going to allow for the space to grow, I believe, naturally. And then in terms of what's coming next, the SEC is actually under Dodd-Frank required to relook at the accredited investor definition every 4 years. They just did it in 2020, so we're expecting them to do it again in 2024. Gensler being Gensler, we think that they're going to actually raise the thresholds, so it's going to actually reduce the number of accredited investors. So we're thinking, especially with all that's happening with inflation, they're likely going to raise the thresholds and peg them to inflation. So we're talking probably going up from 1 million to 2.5 million. Probably from 200,000 to up to 500,000, with like maybe 750 for joint. That's my prediction. It may end up being a little bit higher or lower. They'll probably end up negotiating that amongst themselves. What I'm hoping for is that the Republicans on the other side that are negotiating this require them to also add the ability to have an exam that allows you to become an accredited investor. If we basically create an exam, which they could already nominally do that with the Series 65, which you're not required to be licensed in order to take, although you are required to be licensed to be able to be accredited. If they were to just say, hey, if you have a passing score in the Series 65, you are now an accredited investor, I think that opens up the floodgates in terms of people that will have informed consent to be able to go into these deals and understand what the risks are, but allows for a huge influx of potential investors that may have not qualified before because they don't have $1 million or 200,000 in income. So I think having, it's going to be a little bit of a mixed bag in terms of just having fewer investors that are eligible with the old system, but I think it's going to hopefully open up the door for new investors that can be financially sophisticated or have some sort of degree or license like a lawyer could hopefully potentially invest in these in the future. So we'll see what happens.
It's exciting times ahead in 2024 is what I'm hearing from you all. And not to mention, I will also say that for Invest Ready, the great highlight here, folks, what I think you just heard there is this concept of passporting. Digitally investing can be instant thanks to a one-time check that you can then apply and passport to other brokers, to other platforms. For any of the blockchains in the audience, reach out to Invest Ready. We've got a credit token, so we do have a soul-bound NFT we can tie to wallets in order to make sure that that wallet has been identified and is indeed accredited in order to participate in any deals. A little glimpse of the future. We're going to learn more about that later today on our crowdfunding panel. But first, we've got to move on to our next session. Thank you again to all the speakers. This was absolutely amazing. Please follow up with them. Send them a message on the Zoom platform if you have any questions. And again, thank you all for this amazing panel.
Followed that up with our State of Security Tokens 2023 Q2 report, sponsored by Coinbase. Q3 is in the works, so for any industry partners, any big updates, send me a note after this. I'll be sure to include that in the upcoming piece. But the best part about kind of our positioning in the market is working with all the industry partners, all the brokers, the banks, the issuance platforms, anything in between and way beyond that. And so it's my pleasure to kind of host this panel. We're going to look at raising capital with tokens, kind of how that differs from traditional raises, what some of the people who are on the ground, boots on the ground on the forefront are looking at and hearing from their clients right here on the panel. So without further ado, Richard, if you don't mind starting us off with intros one more time, and we'll kind of kick it from there.
For sure. Thanks for having me on the panel. My name is Richard Luftig. I'm a managing partner at Castle Placement. We're a FINRA licensed broker-dealer. We were founded in 2009. We have 40 bankers located around the country and around the world. And we have been focused exclusively for 15 years on raising private capital for companies and funds. We've been pretty successful. We raised multiple billions of dollars for our clients. We span all industries, sizes, equity and debt stages. We've raised a lot of money for startup companies, for contrarian companies, balance sheet lenders, real estate, technology, aviation, fashion, you name it. We built the platform based on the thesis that to do a proper capital raise, you really need to be a data technology company and a full service investment bank and fully integrate those two practices. And that's what we've done. We have an app called the CPGo app, and it's a way for companies to find investors, for investors to find companies, for clients to participate in the transaction actively. And we have jumped in the last 2 years into Reg CF and Reg A equity crowdfunding. And we also built an ATS and got that approved a few months ago to facilitate secondary trading of private securities. And we are extremely bullish on tokenization, although a little reticent about many of the challenges for it to be widely adopted. But when it is, we hope to be an important player in the ecosystem.
Beautiful. Thanks, Richard. And Castle Placement, been following you guys for a while, so always good to hear. Eitan, I know you guys are nearby in the city. Why don't you kick us off next?
Sure. Thanks, Peter. Eitan Butler, I'm the founding chairman at Dalmore Group. We are a FINRA and SEC registered broker-dealer investment bank headquartered in New York and founded in 2005. We're also a technology company, perhaps primarily these days, a more so a technology company that has been developing tools to assist issuers who are raising capital online at scale globally. We've worked with over 1,000 companies including over 315, I believe, Reg A issuing entities. Clients of ours have completed over 1 million Reg A investments, over 200,000 secondary trades, and super focused and also bullish on the continued growth of some of the Jobs Act born securities exemptions, and excited to be here with the esteemed group of professionals around here. So grateful to be a part of it.
Awesome. Thanks, Eitan and Dalmore. Klaus, talk to us about yourself and DigiShares.
You're muted. Yes, thanks for inviting me here. My name is Klaus. I'm the CEO of DigiShares. I have a background as a researcher. I have a PhD in computer science, so no finance background, which is sometimes a problem in this industry here. We started DigiShares about 5 years ago, and today we are one of the leading providers of technology and infrastructure solutions for tokenization. So half the business is about providing a white label end-to-end turnkey platform for tokenization of real-world assets, having functionality for investor onboarding, actual investment using fiat, crypto, share capital management, distributions, internal trading, and so forth. And we have more than 150 clients globally in more than 40 countries using our platform. The US is our biggest market right now with 45 clients. The US is also, I would say, in many ways, the easiest market for us to operate in. We also have a transfer agent license, and we're getting a crowdfunding license, and we are launching, as the second half of the business, we're launching our own exchange, especially for real estate trading based on blockchain technology, hopefully in Q4 in the US to begin with. We are generally, I would say, we don't assist with any kind of capital raise, I would say, from our business, right? We see ourselves primarily as a technology provider, but of course we're dipping our toes a little bit with the exchange. So yeah, so that's looking forward to the discussion.
All right, thanks, Klaus and DigiShares. And Bob, what's going on with INX? How we doing?
Hey guys, thanks for having me on this panel. As always, well done, Peter and the team at Security Token Advisors. I shared a stage with some of you guys as well in the past. It's good to be here again. I'm with INX. I head our sales, business development, capital markets function. We are a 6-year-old company, but the first 3 years were spent with the SEC, getting through a F1 prospectus to basically launch and run the first ever blockchain IPO in US history. And we did that successfully about 3 years ago. We raised $85 million from 7,000 plus investors, retail and institutional investors in 60 plus countries around the world. Investors were able to invest using fiat or cryptocurrencies. And we effectively proved the model that you can raise capital from retail investors around the world underpinned by blockchain technology while giving them the same investor protections that they would otherwise expect to receive in traditional securities. We since acquired a bunch of licenses. We're a transfer agent. We run an ATS. We are a broker dealer. And we also have 48 money transmitter licenses to date that allow us to offer a cryptocurrency trading platform. And we've done a decent job of complementing the cryptocurrencies platform with the security token platform or vice versa. And effectively, they are one platform. It's our flagship product. It's called INX One. Investors can go there and invest in a bunch of security token offerings, which are currently live. They can do that using cryptocurrencies or fiat. So since then, we've had really a great run of, kind of penetrating this space. Of course, it's early days, but we think we've positioned ourselves very well, including a bunch of partnerships, which I'm happy to speak about on this panel. What a wild ride it's been. And it seems like, it's just going to continue and get even more exciting. So yeah, happy to be here.
Definitely. Yeah. Thanks, Bob and INX. Always happy to hear the story. And listen, this is an interesting panel makeup. It could be kind of pseudo-competitive, could be cooperative, collaborative, whatever you want to say. I think after this, even and as the industry continues to expand, we're seeing there's a big challenge in raising capital as a whole on the macro picture, let alone with kind of new technology underpinning things. It would make sense in the future if worlds, all of us, let's say the 5 of us here, start to converge a bit more than expected, or maybe even more than 2021, 2022, whatever. But I want to look at this, on a couple levels. So there's raising from the Jobs Act, like Eitan mentioned, raising from retail, raising from accreds, raising with kind of the fintech underpin, and then raising with, let's say, underpinned by tokenization. So more broadly, I would love to hear how you guys are all seeing deal activity throughout 2023, whether from like a generalist perspective, if there's any certain industries or sectors that are catching your eyes. If Reg A is really taken off, if Reg D has been a little stagnant, if Reg S happens to be most popular, I'm curious, just kind of some general commentary as a whole, token notwithstanding, but just general business practices. I don't know if any of you want to kick that off.
I will. First thing, I wanted to just comment on the word that you suggested, competition. It's a really funny industry, in my view, because it's so massive. Capital raising is just such a gigantic opportunity marketplace that we don't think about competition at all. In other words, every one of our competitors can 5x their business, and there would still be massive opportunity for castle placement. So and that's a joy, because there are other industries that are razor thin margins and everyone competing in a very small pond, and it's probably not a lot of fun. This is a lot of fun, because every time I see someone doing a successful transaction, that's hugely beneficial for castle placement. So it's nice to be able to root for other people in your industry, as opposed to trying to crush them like a grape. In terms of the marketplace, I would just say that investors, we found, are much more selective today than they were a year and a half or 2 years ago. It's, private equity, venture capital have definitely reduced their investment volume. I think equity crowdfunding is probably about flat, but other people on the panel might have a different view on that. I don't think that it's grown tremendously. I think it will grow tremendously, but and the last thing I would say is that we're having a lot of success in off-road, contrarian strategies, roll-ups of industries that are in distress, balance sheet lenders where they're making private loans where banks used to make loans, and the like. So.
Awesome. Eitan, you seeing anything similar with Dalmore?
Yeah, no, I share your views, Richard, as far as abundance thinking. There are 30 million private companies just in the US alone. And my assumption is that many of them are not even aware of the alphabet of these exemptions, like CF, D, A. What does that mean? What do I do? What's a platform? And there's such an opportunity, given that these are such new exemptions, to educate entrepreneurs and founders that they have a bunch of different solutions that go beyond friends and family and trying to convince an investment bank or a VC to give them a shot. They can really take control of their own destiny in a lot of ways through some of these exemptions, which really ultimately make it as easy as placing an invest now button directly on your website in a compliant, organized, obvious way. But that's pretty revolutionary when you think about it, because it allows for pretty much any company to take whatever structure and valuation structure and terms that they're comfortable with and offer them to the masses, to their own customers and followers, and be able to solicit and market that offering in many places throughout the world. And that's a very powerful tool that allows for companies that have a community or have a fan base or recognize the value in marketing and promotion to consider utilizing. So we're doing a lot of work just trying to educate the overall industry and the financial industry that these exemptions exist. What's interesting that we've seen is that given the relatively low investment minimums in these offerings, right? $1,000, $100, in some cases $1, right? A lot of what we do is on the fractionalization side. It's not necessarily the best word to describe it, but it really is, you take an asset, you decide what's the price per share, call it $1. You don't necessarily have to tokenize it to achieve that. And then you offer these shares out to a community, to the masses, to RIAs, to whatever that might be. We're seeing a lot of growth in that area, and bullish on that continuing. As far as tokenization, our clients were approaching us with a lot of questions about tokenization and blockchain. It was more so a year and a half, 2 years ago or so. I think a year, whatever that was. Time goes by so fast now. Less so these days, or perhaps more so immediately these days. But in general, it's been issuers have not been approaching us with those needs or those interests. Instead, they're deploying strategies similar to some of our other clients who are offering good old-fashioned equities. However, from a investor experience, these things seem immediate, right? You could transact right away. You could buy a $1 share, you could buy a $10 share, you could build a portfolio. And oftentimes there's not the inclusion of blockchain or tokenization. That said, we recognize the tremendous benefits that blockchain and tokenization present, and believe ultimately that whatever's most efficient and cost effective is gonna succeed. I know that a lot of other participants here on the panel and this one in general are really building in that direction, and look forward to hearing more about what you guys are focused on.
Yeah, very interesting. Eitan, is that down more digital or is it down more direct? Correct me if I'm wrong. Where you're like placing a
down more direct is an invest now button on your website, typically for like a one and done CF, A, or D. Then we have an API version. We have an enterprise version, and we also have Downmore Fraction, which is a white label app that we build for our clients, that our clients own, that we develop, that has all of the plumbing, escrow, KYC, payment processing, custody, ATS options, access to RIAs, et cetera. So we're building out a transfer agent we have as well. So really we're offering that single sign-on experience, really trying to reduce as much friction as possible, because we've noticed that this industry operates a lot more like e-commerce than it does investment banking in many ways, because of the low investment amounts. Because if someone's considering making $100 or $1,000 investment, oftentimes on their credit card from an iPhone, that's responsive to something that they see online, behaves differently than an investment banking opportunity where you're talking to an advisor and you're looking at comps and doing diligence, right? It's a very different behavior. So the need for automation, friction reduction, world-class UI UX is critical, as much as it is so for a Shopify store and abandoned cart technology, et cetera. So that's really what we're seeing the most of. What we haven't seen is anyone, regardless of how many investors or subscribers that they say they have, offer anything significant on an ongoing basis of value to issuers who are looking to raise money from retail investors. It is ultimately, in my opinion, on the issuer's shoulders. The question is, what are other people doing that are succeeding? Not what is a salesperson telling you should expect from my 1 million registered users. Usually that's crickets, right? That's what our experience has been, or they're marketing their own products, right? So the question is, how do you utilize marketing, promotion, syndication effectively to get an adequate return on advertising spend? And that's critical, especially if you're a yield-based issuer or a REIT, which we have many, right? You're very, very thin margins. So you really have to, try to figure out how to win before you start. And that's what we're really focused on.
All good points. The e-commerce piece is an amazing analogy, or kind of parallel, if you will. I mean, combine that with what Richard mentioned, how just big the market is, and when you really look at it, how many potential issuers could come through, who they could work with. I mean, there's plenty of room. And now I'm sure even if there's something like a retail level raise through, let's say, a Dalmore direct type, and then even complemented by a typical banking process on an institutional or a higher level, let's call it. I think that's also very feasible. Something we have some interest in from our clients, all interesting. And then you mentioned even it's kind of on the shoulders of the issuer. Bob, obviously INX had one of the more successful raises in this space, I would say. Unbiased, just speaking. I think you guys raised what, around 85 million a couple of years back for the INX token. Was that a heavy user base target, or was that a fresh thing? You know, curious what that looked like.
Yeah, it's very interesting when we look back at those days. Remember, that was the height of the bull market, right? That was a whole different, you know, there was a whole different excitement around crypto assets at the time. You know, the fact that regulation was coming was kind of, you know, becoming clearer and clearer at the time. You know, some of the major failures hadn't happened yet at the time. And the way we, you know, so we kind of clearly we rode the wave of that, you know, just the times and the excitement that was out there with the bull market then. But we were very organized when it came to marketing and distributing that raise, and you know, deploying our team and our resources in the ways that, you know, people who had relationships or that had, you know, expertise in marketing in previous roles where they had done things with you know, the technologies available in marketing and distributing or kind of generating you know, the feeling of FOMO and being able to kind of create this you know, this is a once in a lifetime type opportunity, you know, or you know, you kind of want to get on the bandwagon, you know, now and get onto this investment. Those were things that we were able to kind of strategize around and say, how do we actually push this message out there? And of course, we had because it was an F1 prospectus, we could basically take investors from, you know, countries all over the world. So we were able to kind of harness the time and do that. Now, times are different now. It doesn't change the fact that the responsibility still rests squarely on the issuer, right? To create that emotional connection between what they're raising capital for and the investment community that they're targeting. And of course, we'll, you know, support them, and I'm sure all of the other platforms out there will you know, do things to support them and potentially even guide them along the lines of here's how you could actually have a more effective marketing campaign, or here are some relationships that you could leverage. Here are some marketing agencies that are looking at STOs, because that's the other thing, right? There's marketing agencies that will shill your, you know, your NFT projects, right? But they're not necessarily suited to going out and promoting a security token offering and speaking the right sort of language and knowing what to say and what not to say. So there is definitely a need to really focus on having this distribution mechanism. And I do think that there's there's collaborations that need to happen for that to succeed. And there's no reason why we can't, you know, try and get some of the key players, whether it's, you know, broker dealers, whether it's some of the other guys, you know, that are running similar solutions, to really figure out the right way to kind of promote this new investment opportunity within traditional investors, you know, like your accredited investor crowds, investment groups, and so on. You know, one example is the way we are looking at a partnership with Republic, which is one of the largest crowdfunding platforms, and an investment capital raise solutions platform in their own right. We have just gone into an agreement with Republic. They've taken a stake in INX, and that gives us access to a much larger investor community. But then, like Ethan says, you know, it's one thing to have a large community. It's another thing that they're engaged and that you're offering them investment opportunities that are exciting to them. And when you look at demographics and the different kind of personalities that will exist and the different investment opportunities that they're looking for, you could have millions of investors, but only a subset typically would be interested in specific types of investments and might be there looking for those types of investments. So you kind of need that community, yes, but you need the deal flow. You need that marketplace with exciting products where they can filter and choose and look at these various investment opportunities. So there's definitely a concerted effort that has to happen, and we're definitely working on that as attested by this partnership that we're closing here. But always, and I think everyone else will share this same thought process, is to keep the door open for potential collaborations and partnerships to kind of achieve the goal quicker.
All good points, gentlemen. And Klaus, I believe you guys are indeed raising capital now with the security token offering.
Yeah, it's actually a normal crowd safe, and it's on the public. We are allowed to tokenize a crowd safe, but haven't decided yet. Yeah, so I totally agree with what Bob is saying. We operate in exactly the same way, right? We recommend broker dealers, marketing companies, and so on, but we really take no responsibility for the capital raise itself. And we get lots of requests from companies that want to use tokenization as a vehicle to make it much easier for them to fundraise without having a real understanding of how it works and the challenge of fundraising and reaching investors without any real plan and budget, right? So we normally reject that kind of clients. Pretty much, I would say all our clients in the US are doing Reg D and Reg S. It's easy and it's fast and it's efficient, it's inexpensive, right? So it's easy for them to do, and they can target accredited investors in the US and any type of investor outside the US. So that works actually quite well normally. And they can market as much as they like. But as a tokenization infrastructure provider, right, we always explain to our clients that tokenizing the asset in itself doesn't really make it worth more, right? The asset itself or the project itself has to be of value in itself, and then tokenization is just, I would say, an infrastructure or add-on to make it easier to onboard investors, to add some liquidity, and to automate and reduce costs, right? But it's also, of course, about fractionalization and democratization. That's one of the key value propositions of tokenization. So in reality, we need to be able to reach retail investors longer term and smaller accredited investors, I would say, in order for tokenization to really reach its long-term promise, I think. And retail adoption globally is coming quite slowly, I would say, seen from our perspective, right? And it's also in many countries almost impossible for retail investors to participate. But we do see the trend going in the right direction. So we are very much working on real estate tokenization. And if you look at the trend for individual investors invested into REITs, it's increasing every year. And that indicates, of course, that there is an increasing interest from retail and small investors into real estate or real world assets. They are learning what it is, and they're learning how to invest into it, and they're learning how important it is to diversify into it and have part of their savings invested into this asset class. The other trend that we're tracking all the time is wallet adoption. Tokenization is not going to succeed if not enough people use wallets, and that's luckily also increasing every year. So with those two trends increasing, we'll see tokenization in a sweet spot in a few years.
Okay, understood. And that's, of course, looking at it from like a retail, more digital asset side, that makes a lot of sense. I think what I'm even a bit more curious about, just given some of our clientele and conversations we're having, is it really feasible to raise capital, not from retail, but from larger accreds or even qualified purchasers, just at lower levels? So we see a lot of the whole democratization of investments with tokenization and whatever. And we still see a lot of these offerings on the bigger side are for QPs, even with a $20,000 minimum buy-in. The common, rejection or rebuttal is, this does nothing for the average man, the commoner, and QPs could afford millions. But if you're a low-level QP and you have to rebalance or you need new allocations, it'd be tough to put even like a fifth of your portfolio into one product. Maybe it has a $2 million buy-in. I don't know. Are you guys seeing anything? Let's say a private credit firm is looking to raise capital, take advantage of some distress situations these days. Is it really feasible to raise something like $20 to $50 million? Would that be something doable with the Jobs Act, or is that something a bit more removed and takes a bit more grunt work on like the traditional banking side?
I'd say logically. Yeah. So yeah, let me go first on that one. Logically, when you look at some of these institutions that hold, crypto assets, and have done for some years now, there's clearly institutions out there that embrace the technology, the investment opportunity. Maybe they are looking for, getting exposure well before the rest of their peers do, and kind of getting a real good head start there. These guys understand wallet management. They have, institutional grade wallet management policies, and they'll use, well-recognized custody solutions, like whether it's a Fireblocks or a BitGo, and so on, and maybe take a MetaMask institutional as well, and put that policy wrapper around that, and be very comfortable with managing, self-custody of their assets. So there's, that's a niche, or that's a target group that could easily pivot into investing in security token offerings, right, in various other industry verticals. Whether there needs to be a concerted effort to kind of demonstrate the, I would assume that what they're looking for is choice, right? It's a depth of investment opportunities, or a broad spectrum of investment opportunities. If you take trade finance, for example, invoice factoring and account receivables, this is a space that kind of has been dominated by large banks or non-bank institutional players, where your smaller family offices or high net worth individuals, I probably would like to have a slice of that pie, right? There's, capital preservation. There's a whole, some of these opportunities could be low double-digit, yields on your investments, right? There's a lot of good opportunities out there. I think there is still potentially it's an education thing. It's about pushing these product offerings in front of them, and actually engaging and going through that process of educating and demonstrating that while you already have exposure to cryptocurrencies, there is security token offerings which are poised to actually dwarf, the cryptocurrency market. Pay more attention and come in, and but you would need to have, again, you need to have that done in a concerted effort. Otherwise, you're going to bring in a handful and still not fill those raises. So again, coming back to what I was saying earlier on, it needs to be, I think, it needs to be a group coming together and identifying a strategy that works, and then working together to push that in that direction.
Okay, interesting. And so Bob and Klaus, you both mentioned wallets, actually. So perfect, from the digital asset side. And I'm curious, Eitan and Richard, what your opinion is. Looking at it, even if you're talking to more traditional investors, is the infrastructure still a big hindrance in their entrance? If you have an offering and you're trying to push and say, hey, this is going to be tokenized with so-and-so partner, we're going to, help you onboard with them, or maybe it's you guys offering the technology yourself. Is that a big hindrance, or, are they hear wallets? Do they run the other way? Are they kind of open to that? Does it change the whole game? Yeah, I guess what I'm really asking is, what's the challenge from the infrastructure side? And is it really that big of a challenge, or that big of a wall to get over?
Wallets, from how we refer to wallets today, is more like Stripe wallet, and which allows for, like, I guess the equivalent of like a Plaid, that allows for a investor to link their bank account to, right, so that funds could go both directions and could get distributed back to them. Less so about, with cryptocurrency. And as far as the other question you asked, like, is it reasonable to raise $20 million through Jobs Act exemptions? Yeah, it is. I mean, first of all, 506C, it happens frequently. We have one client that has a combination of Reg D and Reg A that's raising $30 million a month, minimum, for the last 3 months. That's a lot, right? So the question is, how are issuers doing this in this environment? What tools are they using? What PR strategies? What does their return on advertising spend look like? How do you learn from that and mimic that going forward in an automated way, and anything up until then? But as far as wallets, I don't know, Richard, are you seeing wallets as a hindrance in working with clients? Are you seeing an interest in the usage of wallets for crypto related transactions?
It's a major hindrance.
Yeah.
If you really think about it, for an investor to pull the, well, bad phraseology, for an investor to commit to an investment, everything has to align. They have to love the opportunity, the industry, the management team, the strategy, the track record. All of the technology also has to be in line. And if the investor doesn't currently have a crypto wallet, the probability of them creating one just to invest in this transaction is very, very low. And that's a huge obstacle. And by the way, that was something that we were debating 5 years ago. And 5 years ago, we were having discussions with clients that wanted to do token issuance. And we said, 99% of our investors don't have a wallet. Do you want to play those odds? And that was 5 years ago. Is it better today? Yes. But is it a hindrance? Absolutely, yes.
Yeah.
Yeah, I think it really comes down. I think it makes sense in a lot of cases for a lot of, at least let's say, major asset managers who want to be issuers in this space, to kind of go the retail and then just, keep it separate on the institutional side. Retail would be the pure wallet. We're rotating crypto holders. We're rotating, it's not to use your word again, e-commerce users in a way into our brand. Whereas institutional, and we've even learned this from some of our clients on the STA side, a lot of their business flows through existing either fund admins or custodians or certain banks that are distributing their products, and they're not going to really roll the dice on anything major. We still see some good promise of, smaller funds or even kind of tester funds that are still on the radar. And that's something that could probably rotate eventually to maybe even, probably Reg D, but, maybe to a more retail crowd even, should the stars align. But it's always interesting to keep in mind and to kind of balance the whole, crypto narrative with what's actually going to work to get capital in. I think a lot of these stuff, and this is aside from our topic here, but a lot of the money market stuff we're seeing is interesting because it's getting new companies, some major firms familiar with the technology at least, and getting their teams kind of up to speed. Hopefully the spillover effects are as strong as they could be. But always very interesting. And, that's kind of where we're leading up to. I know we have a few minutes left here. It's more like thinking about how do we really scale the infrastructure? Again, there's a lot of different solutions kind of pieced out in the industry now. How does that become a little more collaborative, just so to benefit the issuer? So if I'm trying to raise, say, 100 million, I may have to work with a few different parties, a few different brokers. How can I really piece that together and then get my optimal scenario? So I don't know if there's any color that anyone wants to kind of present on that front or any parting thoughts, but I'm all ears.
Well, I would say one thing. I would say that it's kind of unfortunate the way this has all played out over the last few years, because starting with the ICO nightmare, okay, where companies just raised capital with complete disregard for securities laws and regulations. Now most of the headlines regarding crypto are focused on, trials and criminal activity and, fraud and regulatory problems. So that's not an inducement for people to jump into the pool. With all that being said, the opportunity is massive, okay? I think without question, corporations, assets, they're going to be tokenized. It's going to happen. Not tomorrow, maybe in a year, maybe in 3 years, maybe in 5 years, but it's going to happen. It's inevitable. Everything comes together, Web3, general internet connectivity, the equity crowdfunding, the payment rails, the marketing strategies. It's all coming together to help investors get access to different asset classes, and they want it. They want it in their regular accounts. They want it in their self-directed IRAs. And, the people on this panel are going to deliver it. So it's going to happen, but it takes time.
I absolutely agree with that. There is, and there's a lot of stuff that needs to happen, and that we're all working on. And whether that is, support for, multiple wallets, or, blockchain agnosticism, and the ability for assets to move, across chains, and live on different chains. The gamification of the entire experience, right? That whole kind of UI, UX, that's critical. Regulation needs to change. Again, to your point, like the media right now, it's awash with news about trials and this backdrop of everything that's happened. But let's also look at the regulatory, the strong-handedness of the US regulator in these last couple of months as well, which you could argue, right, regulation is needed, but maybe the approach and the way things are being done could actually be off-putting to new entrants into this space. And I think that's just the cycle that we're gonna look back one day and be like, well, there was the positive initial phase, and then we went through the challenging phases with the trials and so on, and then we hit the next bull run. And a lot of shops that raised capital during the last bull market, they're quietly working and developing products and solutions and bridges and things like that. So I definitely look forward with a lot of excitement, Richard. I share that same view. This is all inevitable, and we know that stuff is happening, whether it's within our own firms here, or also at the large institutional traditional finance level. We saw the move with Citibank 2 weeks ago, I think it was, with their tokenizing, or creating a tokenized way to basically represent assets across all of their different business units. That's huge. That is huge stuff. Of course, the adoption is going to take some time, but there are many things that are happening and will continue to happen that will just propel us in that direction.
Absolutely. All right, gentlemen, we are just about at time. Really appreciate all the insights here. I'm sure the world will continue to collide going forward, just given what we're talking about, given the licensing, given the necessities and components, and given the landscape. So I'm looking forward to more of that. I'm sure we'll have some mutual clients in the near time. But really appreciate everyone, Richard, Eitan, Bob, Klaus, for joining. Amazing insights. Hopefully we stay in contact moving forward and enjoy some other panels coming right up.
Thank you very much.
Thank you very much.
Bye. A little bit to join in. All right, you'll be live in 3, 2, 1.
Thanks, Jason. Do you want me to just kick off, or did you want to do a quick intro? Happy either way.
Go ahead and do go right ahead.
Okay, cool. All right. Well, thanks to the team for having me on the webinar. For everyone who doesn't know me, I'm Kirthi McCall. I run the product team at Onyx Digital Assets. We'll touch on a little bit more in detail today what Onyx by JP Morgan is, and then get into the details behind Onyx Digital Assets, which houses the firm's tokenization efforts. We'll go through a brief problem statement around what the platform is intended to solve, and then get into the details around the different use cases that we have live on the platform today. And it's super exciting that this session lined up with today's date, because we actually did announce another application that just went live last week. So we'll be able to talk about that in a little bit more detail too. But to start us off, just wanted to give everyone a brief primer on what Onyx by JP Morgan is. So Onyx is the firm's blockchain-based business unit that was launched back in 2020, but it was really founded on 5+ years worth of effort done by the firm in the blockchain space. So we actually had a smaller R&D team that was set up back in 2015 that had started experimenting with the technology and actually ended up developing Quorum, which is a fork of the Ethereum network, but with a layer of privacy and permissioning attached to it. And through that initial effort back in 2015 through 2020, we were able to work with different lines of business internally, work with different clients, and really get a sense for where blockchain can actually deliver real value. And so from there, what we ended up first launching and I think this was around 2018, was the Link network. So Link, as you can see on the left-hand side of the screen, is the firm's platform for information exchange between different correspondent banks that we partner with and transact with. And what Link really, from my perspective, what Link gave us was our first foray into a productionized system built on decentralized Rails, and a platform that we could then build different applications on top of. And so from there, what we did was we recognized that there was a need to bring cash on ledger. And slightly different than stablecoins or tokenized deposits that you're seeing kind of take the headlines in today's world. What we wanted to do was figure out how our clients could actually benefit from, the same treatment of cash in their demand deposit account, but now functioning on blockchain-based Rails, where there's faster speed of settlement and programmability that could be attached to those cash movements. So through that effort, we then introduced coin systems. You might have heard this referred to in the past as JP Morgan coin. We often get a lot of flack for the name, but really it's not a cryptocurrency. It's not a new asset. It's really just the use of a blockchain-based system to record deposit liabilities that the bank holds. That was really important, again, because I think, again, very personally, it furthered our ability to deliver on the asset tokenization agenda, because when it comes to tokenizing assets and it comes to the programmability that you can introduce around asset movement, you really unlock real value once you start introducing DVP on chain. And so we'll talk about that in just a second too. So with our understanding of what a live blockchain platform looks like with the cash on ledger, what we then introduced was Onyx Digital Assets. So Onyx Digital Assets is the firm's platform for tokenized assets. It is, again, built on Quorum, so it is a permission network, but our applications very much look and feel like every other kind of dApp in the Ethereum ecosystem, in that there's a series of smart contracts deployed on this platform that represent these financial assets and have programmability baked into them around how they move. And really what we're looking to do with Onyx Digital Assets is address the limitations in today's settlement infrastructure that prevent certain asset classes or certain newer financial products from really forming and achieving newer forms of utility in today's world. So then the last stripe that we have within the Onyx organization is the blockchain launch team. And this is the next generation of that previous effort that I mentioned that had gotten kickstarted back in 2015. That's looking at, what are the products of the next 5, 10, 15 years that we need to start thinking about and then incorporating into our live platforms. So there's a lot of focus that's being spent on topics such as digital identity, topics such as, figuring out how we can introduce wallets to our institutional clients in a manner that's not as disruptive as some of us might have felt interacting with wallets feels like today. This also, I think really notably, the team also spends a lot of time looking at different protocols in the public ecosystem, so DeFi protocols included, and thinking through, what would it actually take for an institution like JP Morgan to meaningfully get involved and some of those, maybe not directly involved in some of those protocols, but directly involved in terms of utilizing smart contracts in that manner to make money and assets move around a bit more effectively. So for instance, the work that we did with Project Guardian back in November of last year really centered around this idea of bridging the worlds of the institutional space with the innovation that Web3 has brought to the market. So hopefully that gives a good idea of what is Onyx, what is JP Morgan doing in the blockchain space, and what are the different product lines and stripes that we have within the organization. I'm going to move forward to how we see, asset tokenization specifically. So as I mentioned, Onyx Digital Assets is the firm's asset tokenization platform. It's intended to be multi-asset, multi-functionality, and really what we're looking to do is through the tokenization of assets, leverage a blockchain and smart contracts to, at our core, record keep the different positions, but really then add on layers of programmability and build a system that's extremely composable, so that we can unlock certain benefits as listed on the page. So increased utilization of these different assets, atomic settlement being a huge sort of like unlock that we get through asset tokenization. And what I mean by that is truly with a single blockchain transaction being able to see both cash and asset exchange hands between two counterparties, which is something that, centralized depositories give us in some capacity today with that trust in an intermediary. But for a lot of different types of transactions, there is settlement risk where a counterparty might be concerned with not receiving their side of the transaction at the same time that they submit to their counterparty. The other pieces that we would look to, or that we have looked to demonstrate and realize value for our clients include also boosting operational efficiency. So ensuring that, when we are creating these newer forms of utility or these newer products on top of these blockchain-based rails, it's not introducing a ton of operational overhead, and in fact is actually reducing operational overhead when it comes to mobilizing different assets. So again, the core problem statement that we're looking to address with Onyx Digital Assets really comes to the heart of expanding beyond the limitations of today's settlement infrastructure. I see that there's a question, but it was actually just a comment. Okay, so the next piece that I think I want to touch on is something that further contextualizes that problem statement that I mentioned, which gets into the core of the design of Onyx Digital Assets, which is intended to be a platform that supports multiple different types of applications. So we have two apps that are live on Onyx Digital Assets today. The first is called Digital Financing, and this was the application that we took live back in, I want to say, December of 2020, so around the same time that Onyx had launched. And it was the first app that went live on ODA alongside the platform. So Digital Financing, what it's intended to do, or what it does, sorry, I keep saying intended to, but these things are live, just to be clear. So Digital Financing looked to introduce a new liquidity tool into the market. So what we did was, we recognized that, today when clients want intraday funding, they're able to come to the bank, access unsecured, uncommitted lines of credit. They do so at scale in the order of, billions of dollars a day. But what they're able to get from overnight and longer term markets are access to secured financing, where they can actually place down collateral and then receive sums of financing that are much larger. And so we thought to ourselves, why has that market not really developed in an intraday capacity? And some of that comes back to these limitations that I mentioned earlier. So because it's a bit more difficult to move cash and assets programmatically in the hours, in the order of a couple minutes or a few hours, we hadn't seen that market really develop previously. So Digital Financing looked to couple the active tokenization. So we basically immobilized assets at the different institutions, custodial institutions, tri-party agents, so on and so forth, where they're held, and issued tokens or entitlements to those assets on the Onyx Digital Assets network. And then we coupled that with cash on ledger, so the JP Morgan coin solution, and then built a series of smart contracts to basically encapsulate the trade execution activity and settlement and maturity activity of a repo trade. So basically, we're able to take all of those different pieces and introduce an application that creates an intraday repo tool for our clients. And this application, I think, since we've gone live, we've seen nearly $1 trillion in value transacted across these rails to date, which definitely proud of. But I think it's really a testament to the fact that what we did through looking at the act of tokenization is really introduce a net new functionality that our clients and ourselves weren't able to tap into previously. Similarly, the TCN, the Tokenized Collateral Network, this is the application that we went live with and I think announced today. This app builds upon that, I don't know if hypothesis is not the right word, but builds upon that idea of utilizing or of tokenizing assets to unlock a newer form of utility for that asset. So for the TCN specifically, this was an application where we partnered with BlackRock, and we they came to us with the idea of wanting to enable their own investor clients to be able to utilize their units, their ownership of money market fund shares for margin posting. So today, where they might have a series of and by they I mean fund managers in general, money market fund managers in general might have a series of investors that anytime they have to make some sort of margin posting event, they withdraw from the money market fund, they take their cash, they post to their counterparties, and when that exposure changes, they reinvest back into the fund. So instead of that entire process, what we were looking to do is say, can we couple tokenization once again with the idea of streamlining that whole process and enabling those investors to directly just use their fund units to post. So take out all of that operational overhead of having to, withdraw from a fund, post, and then resubscribe, and actually just enable them to utilize the units directly. The reason why that's difficult to do today is in order for an investor to actually do that, they would currently have to onboard all of their all of their counterparties onto the same transfer agent where that fund is record kept. And when we think about how many money market funds are out there, and we think about how many transfer agents are out there, that very quickly becomes to be something that's quite untenable. And so what we did here is, take that tokenization on-ramp, plug it into transfer agent infrastructure, and then enable investors who, already have these relationships set up with their with the transfer agent and with the money market fund manager to be able to just tokenize those fund shares, move them into a specific account, have them be represented on platform, and then pledge or transfer them to any receiver that had been onboarded directly to ODI. You don't have that multi-step onboarding problem that you do in the current sort of settlement rails. And so again, I got into the weeds a little bit there, but I think the main thing to take away from that is another example of utilizing tokenization to directly create a new service or a new type of product that our clients can't currently access in today's world. There's a lot of effort also internally to look at, how can we, from an end-to-end perspective, think about tokenization of an asset. So thinking about native assets, for instance, through issuance, through trading, through settlement, so on and so forth, how can we start to build the rails for all of those pieces? But we are also recognizing that sometimes you don't need that full end-to-end issuance flow in order to unlock value. And we've demonstrated that through both digital financing and TCN. And I think that is something that slightly differentiates us from some of the other initiatives in the finance space today. So moving ahead. So this is more a visual of how we break down the Onyx Digital Assets platform. So at the top, we have the application layer, and slide needs to get updated because TCN is live. So at the top, we have the application layer, digital financing, TCN, and what we are looking to currently expand to are one, a new set of JP Morgan applications, but also in the future, figure out how we can partner with different applications that are built in the general blockchain space for them to deploy contracts onto ODI. So we do see that as being, something that will help unlock scale for us. And so that is an effort that we're currently working through from, a legal compliance regulatory standpoint to enable that sort of third-party activity. Then below the application layer, we have the platform layer. So this is the set of, this includes the set of assets that are onboarded onto the platform and then usable by the different applications and users that interact with them, as well as the different platform services that those apps can tap into. So, above the blockchain layer, this is things like the JP Morgan coin system, for instance, the payments infrastructure that the different applications are using. These are also things such as a key management system to ensure that client keys are protected in the right manner. And it also includes, I think, notably integration with our legacy infrastructure. So, API connectivity to the Swift network, for instance, has been something that's pretty major in terms of helping us automate those tokenization on-ramps. And then lastly, at the baseline, we have the network of institutional participants that we connect to. So I think publicly, this is like the likes of BlackRock, Barclays, Goldman Sachs, different financial institutions that come together to form the network. Oops, sorry. Cool. So I think we have a little bit under 5 minutes left. So I think I will wrap with this slide and then happy to answer any questions. When we think about Onyx digital assets, what immediately comes to mind, in addition to the live use cases that have delivered, real value, as you can see on the screen, processed over 900 billion in transactions to date. A platform that can deliver real value, but also is empowered by the next set of applications, the next set of assets, and the next set of participants that come on, build on top of that platform, and can tap into these functionalities around tokenization and programmatic settlement. So with that, I will stop sharing, but happy to answer
questions for you.
questions. Yeah. Okay, cool.
Okay. First of all, wow, I've got goosebumps. Incredible things that you are building. The first question I have for you is, do you think there's an opportunity for bringing in stable coins like USDC onto the Onyx platform?
It's something that we've thought about previously, especially because right now, JP Morgan coin, sorry, the name always throws me, but JP Morgan coin can only be held by clients who are payments clients. So already have that relationship, which that's incredible, but also in some ways restrictive in that, if we're trying to tap into larger pools of liquidity and whatnot, we want to make sure that we can cater to clients who might hold cash accounts elsewhere. But I think with the stablecoin piece specifically, it'll come to two things. One is demand. So it's not something that we've actually had clients request in the past. I think part of that is around the uncertainty of, what is the stablecoin? Like, is it cash or am I holding a different type of asset? And I think the second thing that it'll come down to is, obviously from a regulatory standpoint, is this permissible for us to have on the network? Oh, I think you're on mute.
That was perfect. No, I think that's super interesting and makes a lot of sense, especially given you're one of the biggest banks in the world. You can't just run through that. Another question I have for you here is, can you share more about what types of DeFi partners or protocols JPM might be interested in exploring, as in what type of functionality or use cases you think these partnerships might help solve?
Yeah, definitely. So, I guess publicly, the protocol that we had partnered with or not partner with, but leverage last year was Aave. And we can see, you know, there's direct correlation between what the likes of like Aave and Compound can enable and what the intraday repo application does, right? It's expanding the tool sets available for accessing liquidity. But I think across the board, and sorry, this is going to be a vague answer. I think across the board, like JP Morgan's business lines touch a wide range of functions and a wide range of markets. And so really anything that crosses over into that, into any of our lines of business, which again is such a broad, I know it's broad, but anything that has that crossover is of interest to us, maybe not to, you know, form a direct alliance, partnership, whatever, but to look at and learn from and see if there's you know, a better way of doing whatever that market or line of business is currently doing. I hate giving vague answers, but like it is quite
I totally understand. Yeah, no, this is a big one. So it's hard to get into detail. I'm gonna sneak one more out of you and then we'll let you go. Again, I speak for the whole audience that this has been incredibly exciting and very lot to learn there from the Onyx side of things. The last question I have here is what regulatory or operational changes could create a hockey stick in the usage and liquidity for any of your current or future projects?
Sorry, what changes from a regulatory standpoint?
Yeah, what regulatory or operational changes could create that hockey stick that might, you know, solve for liquidity for your current projects or future projects?
Yeah, so definitely increased regulatory clarity across the board, and I don't want to say less scrutiny because I think the scrutiny is a good thing, but it does take quite a lot of effort for us to put any of our initiatives into production today. And so if there is a way that we could figure out how to like expedite some of those like review processes with our regulators, I think that's an expedite in a controlled manner, those processes, I think that's one big piece. But over and above the regulatory point, because I think, you know, everyone has heard a lot about that. Operationally, I think firms have to get comfortable with utilizing blockchains as a system for record keeping. It's something that we've spent a lot of time internally, you know, with different teams having to get them not upskilled, but like attuned to what a blockchain is and the fact that it's not like some scary new thing that's completely different than how they record keep assets today, but it is a process to bring all folks along that journey. And so I think if there's some way of catalyzing that process across the industry, right? Because like we're one organization, that would also be, I think, pretty major in terms of bringing people on board and like unlocking new forms of like liquidity. I think some of the hesitation that we see around like connecting to a blockchain or using a blockchain or just like scared of the word. I mean, no one's scared, but I think some of that hesitation is also a bit of a barrier right now in terms of adoption. Go ahead. Sorry, I was just gonna wrap that with like, and like if I think about it, like from where I sit, like we're really lucky in that we've made that investment and have, you know, 250 plus people working on blockchain itself and championing our efforts within the bank. Like not a lot of clients and not a lot of like institutions necessarily have that. So I totally understand why it's a bit of a longer journey, but I think it is something that we will need to get to adoption.
Well, you and the Onyx team have made incredible investments in this space, making it all possible. I would believe anyone learning about blockchain for the first time if they don't think it's daunting or scary or some level of technophobia. But I can tell you clearly with Onyx and you, Kirthi, that it's a lot less scary. It's a lot safer to go through that process. So again, super appreciative of your time. Again, we're very lucky, everybody, that we may be getting to see you again tomorrow at our institutional panel. So if you love this keynote as much as I did, folks, you might get some more insights tomorrow. Be sure to tune in. And with that, Kirthi, we thank you and we hope you have a great day.
Thanks so much for the time. Appreciate it.
Ciao.
We are doing a panel on the tokenization of real estate as a way forward for the advancement of real estate in Web3. I'm going to go ahead and hand it over to our guests very quickly and allow them to quickly introduce themselves and tell us just a little bit about what they do. Ed, why don't we go ahead and start off with you? Good to have you, Ed.
Thank you, Justin. Appreciate it. I'm Ed Nwakati. I'm the founder and CEO of Red Swan CRE. We are a marketplace and platform of digital assets of commercial real estate. We simplify the process of buying commercial real estate.
Fantastic. Going over to you, Samuel.
I'm the president of the Ed Fan Club. No, I'm just kidding. I, amongst many things, I'm the managing director, real estate services for Invenium. We're a data operating system platform. Basically, we make sure that the data is accurate, verified, and anchored to the blockchain.
Very good. Excellent. Going to take it over to you, Remy.
Hi, I'm Remy Jacobson, CEO and founder of Realty. We are the largest token real estate tokenization platform integrated in DeFi with over 1,700 units tokenized as of today. Lending platform, secondary market, and been in the business since 2019.
Wow. Okay. 1,700 units. That's great. And Matt, we're going to take it over to you. Just go ahead and tell us a little bit about yourself.
Sure. Matt Andelman here, CEO and founder of ABC FinTech. And we started ABC Tokens, which is essentially a private tokenized commercial real estate fund. So ownership shares, live in the form of a digital token on blockchain and represent fractional ownership of all of the portfolio of properties.
Fantastic. So, for a while now, real estate has been pointed to as a great opportunity for tokenization. Truthfully, I've been reading white papers and working on white papers for probably going on 10 years that have to do with this exact kind of product. I know we've made some progress over the past 5 years or so. What advancements, where are we right now? Are we opening up? I'll take this question over to you, Ed. Are we opening up real estate markets or these kind of investment markets to a wider range of investors by fractionalizing investments like this through tokenization? Or what kind of opportunities is it creating that weren't there before?
It's creating a significant opportunity for investors who typically are not able to buy high quality real estate. My background for the past 20 years has been in commercial real estate. I used to be the executive director for capital markets with Cushman & Wakefield. And at that time, most of my clients were all institutional clients. The average ticket size, $2 million and above to participate in those type of deals. But now with tokenization, we're actually bringing that price point all the way down to $1,000. And even in the foreign markets, as little as $100. So everyone can really get involved in the high quality real estate, not the core plus type of assets that most people are going after. And so, yeah, I think it's opening up the market quite a bit for U.S. accredited investors and especially for foreign Reg S investors who really have no access to or very limited access to the kind of quality real estate that we're bringing to the marketplace.
So that's been kind of the hue and cry of tokenization for a number of years. Samuel, I'm going to take it over to you. I don't know if you prefer Sam. Do you prefer Sam or Samuel?
Unless you're my mother, yes, I prefer Sam.
Unless you get out of line, and then we switch to Samuel, right?
That's right.
So as Ed pointed out, of course, it is an important thing to note that we opening up markets to international audience. I can see how that would clearly work out, but at the same time, even with if you talk to people who are working at family offices, but even not as high net worth investors, there are a lot of people adopting institutional style investment now where they've got a certain percent of their portfolio that's going toward capital investments or pre-IPO or crypto. Is this creating another opportunity for those people who are for that kind of investor? Is that the kind of person that we're talking about who maybe on a global basis at least didn't have access to these kinds of investments and does now in a more meaningful way? Is that kind of what this shift is, as well as adding liquidity to the market?
Well, first I'd like to address, you use the C word, which I think it's very important to differentiate that what we're talking about here is the tokenization of of assets that has nothing to do with crypto. Having said that, we all thank the crypto world for providing the platform and providing the audience and really proving that these transactions can occur on chain by the touch of a button. Now, the reason I make that differentiation is because what we're talking about here is truly the bond of a portfolio. Ed and I were talking about this last week on a call. And, you know, when you mention family offices, absolutely. Like, this is, with Red Swan right now, you can, you know, you'll be able to invest in a diversified core asset portfolio, right? So to me, it's better than a bond, right? Because, you know, even as high as bonds are these days, right? You know, 4 or 5%, but it's that 6% with a kicker, right? With upside potential. So to me, family offices, absolutely. Institutions, absolutely. This is a big audience, but sort of off the topic, but to get back to your answer, yes, this opens up the markets for many people. It's bringing quality, verified investors, accredited investors to developers. At the same time, developers, owner operators, whatever you want to call them, are opening, you know, their assets up to people who didn't have access to them before. You live in Boise, Idaho, you can invest in a Manhattan skyscraper, or vice versa. So the deal flow, in theory, should be much larger, and the educated investor should have better choices and easier access to not only assets, but assets with true, verified, accurate, trustworthy documentation and data.
Well, it's interesting, and I'm glad that's the C word you were talking about. I had to think back over my statement. But yeah, though, that I see what you're saying. But obviously, tokenization and the fractionalization of fundraising or collective investing, however you want to put it, has been, you know, obviously tremendous advancement of the past 10 years or so, depending on where you want to put it, maybe longer. But, you know, right now, Remy, obviously things have been a little bit tough. Now we've got this, we've got a terrible situation going on in Gaza Strip, for example, right now. You've got black swan events like, you know, Ukraine being attacked by Russia, for example. We've had global supply issues. We've had global liquidity issues. So we can talk about what kind of opportunities, as I was just a minute ago with Sam, talk about what kind of opportunities this is for investors. But what about those who are on the sell side? Are we, you know, this would be a good time to have a little bit of good news for people who are looking to develop, for example. Are we creating opportunities with this kind of approach?
Well, let me go a little bit back to the first question that was asked about what is tokenization doing and what kind of access it's creating. I'll give you obviously Realty as an example. When we do an offering, we place multiple thousand of investor per offering in 154 different countries as of today, which gives access, not only access to more investors joining a deal that they didn't have the opportunity to join before, but it gives liquidity. Today, you could buy a token in Realty, collect your rent Monday, Tuesday, Wednesday, Thursday, sell it on Friday with a very dynamic secondary market. On top of it, you don't want to sell your token. What is real estate without lending? Well, lending is tough today. Interest rate is hard. Realty has the RMM, the Realty Money Market, where you could deposit your token and take a 50% loan LTV on your token in 2 clicks without encumbering the property. This is giving access to liquidity, transparency, and is giving confidence to investors that real estate is no longer a 7 to 10 years investment, and you no longer need the big ticket. You could invest with $50. And we did it with over 17,000 active investors today, with a very dynamic secondary market, very dynamic lending platform, and primary market. Liquidity, transparency is key to our industry.
Right. Right, definitely. You know, can you see, do you think that this is the right time and place for this, though? I mean, things have, we've kind of had a rough market in a lot of ways. We've got a lot of forces sort of beyond our control working on the economy right now. Is this a matter of technology solving a problem that technology solving a problem in a new way, or are we kind of launching this as a capability into what might sort of be a rough market, Remy?
There is always a rough market at some point. Yes, rougher situation, but in real estate, you buy when there is blood on the street, even if the blood is your own. And that's a rule of thumb when you do acquisitions. So it's going to happen. It's going to go back up. It's going to get stronger. People need a roof. People need real assets. So yes, it's not ideal. No, it's not terrible. Yes, we'll get through it. And yes, the technology is changing everything on the level, on the field of how people can invest, can interact with their investment, and can decide to hold them. Non-custody, you're the master of your own destiny with your private keys.
I think, Justin, also, I think that you have to look at, you say timing. I think the timing is really perfect for the real estate tokenization market right now, because when you look at it from the standpoint of a sponsor, sponsors have a rough time right now generating capital. The lenders have pulled back. Private equity is now, or private lending is very huge, and the interest rates are approaching 14%. So the market has changed, the world has changed in terms of real estate, and sponsors need another option because the current options that they know about are closing, and therefore they're stuck. There's about $1.6 trillion worth of mortgages coming due over the next 24 months. And the gap between the value of the assets that they financed maybe 4 or 5 years ago and the value of the asset today, and the appetite in terms of loan to value or loan to cost from the lender, that's also compressed quite a bit. So if somebody has to fill that gap, it's not going to be institutional vendor or lenders. It's going to be difficult from private lenders because they're going to see this as an enormous opportunity to discount the price point. But I think going out to the retail investors who could be digital investors buying in, trading their cryptocurrency, or even just deciding to use a wire transfer to buy these assets, is a great opportunity for sponsors to find new sources of capital.
I'd like to add. Go ahead. Let's let Matt jump in. Yeah. Go ahead, Matt. Go ahead.
Great opportunity here for sponsors, but then also investors. I mean, one of the reasons I started ABC was because I worked for a developer for 7 years and was never once offered the opportunity to invest alongside of him. And so even though I had that connection with the developer, it still felt very exclusive to me. I was also a broker at a national brokerage, and I was finding great opportunities, but I would just broker the transaction. I didn't get to invest. And now I think even with my network of commercial real estate professionals and access to this, it was still difficult for me. I bet the average person or retail investor knows that there'll be opportunities to buy in the dip right now. We see interest rates have risen, cap rates have risen, property values are coming down, and retail investors should want, I think, some exposure in their investment portfolio to commercial real estate. And I think tokenization and lowering that capital minimum investment and being able to even have multiple investments and multiple commercial real estate properties to be somewhat diversified makes a lot of sense for the average investor right now.
So say you are a retail investor who's determined, the amount that they can invest at this point, you peel off, 10 or 20K, you want to try and put your toe in the water. Where is the place to start here, Matt? How do people get on board? I mean, because I'm assuming that's the plurality of our audience listening right now. Go ahead. Sorry.
Well, I'm a bit biased. I'll say ABC, but I think there's a lot of great opportunities. The guys on this panel right here, I think you should check out their companies as well and what they're doing. Yeah. Our company has an advisory board with over 300 years of experience in commercial real estate and $6.5 billion of transactions executed. We formed this team to be able to source, quality commercial real estate investments, to be able to underwrite them and offer fractional ownership to investors. And I think in order for mass adoption to occur, we'll probably get away from talking about blockchain eventually, or even the word token, and people are going to be interacting with these investments and going to a Red Swan or going to a Realty or an ABC and investing in tokenized commercial real estate or residential real estate without even knowing that blockchain really is operating in the background.
Yeah. You make a great point. I mean, first of all, Sam made a great point, honestly. Calling it crypto in the first place never struck me as as really good advertising for the overall space. Like, if you look at the root of what that word means, I like digital assets personally. But, Ed, in order for us to work out this new world of highly volatile digital assets, essentially what we're talking about here, although tethered to real estate strikes me as less volatile than a lot of other classes out there. How are we going to navigate and where do we stand right now from a regulatory point of view? Because don't we need to wait for Gary Gensler to work out how he feels about tokenization in general before this can really be viewed as a solid investment by real money out there?
Well, I'm glad you said that, because I think there's always this confusion out there in the marketplace that the SEC is against digital securities. And that's not the case. The SEC had ruled in 2018 that STLs were legal ways to raise capital. And that's when we jumped in business, because we saw this as an opportunity. So I think the question is, are you compliant with the process of selling these digital securities, or are you non-compliant? We started in 2018. The first thing we did was go after our licenses with the SEC to make sure that we are compliant. So I think as long as you're providing a quality service to your client in a compliant way, then there's no problem. There is no issues with regards to the SEC. They want you to do it correctly. And I think the problem is that many people confuse it with cryptocurrency, which is not regulated by the SEC. And so for their different issues with regards to crypto, but as Sam very clearly said, this is not crypto. This is digital securities, just like stocks securities you're seeing on NASDAQ or New York Stock Exchange. So it's just in a digital form. And as Matt said, pretty soon we're not going to be talking about tokenization. We're just talking about buying assets. We're buying securities of real estate shares so that people can have that same ownership interest in a property that the major investors have. So you'll be buying right alongside of major institutions that are buying real estate, but you just have a pro rata share of ownership, which I think is pretty exciting for US investors, but also for foreign investors. You think about emerging countries that have a lot of problems with interest rates, hyperinflation. They can't keep their money in the bank because it keeps losing value. If they can now buy some digital real estate that's paying them a dollar denominated return of whatever, 8%, 9%, you name it, that's a whole lot better way for them to hedge against inflation and build wealth than the current situation they have right now.
If I could, Justin, if I could just add add a little bit to that, and then I want to go back to Matt's comment. But it's, if we all sit here and say that we're going to wait until Gensler does something, then it's going to be another 4 years of Ed and I flying around the world, educating everyone on a process, on an industry that's just never going to go, right? Mm-hmm. So I believe wholeheartedly, and so does everyone, well, I don't want to speak for everyone, but regulation is imperative. So it's an end to the means, right? The only way this is going to be done right is by regulation. Now, is it a pain? Absolutely. But it's the only way to make sure that everyone is doing this the right way, because that one person that does it the wrong way is going to ruin it and stop all of the momentum that has been created by numerous people in the ecosystem over the last few months. That's first. Second, blockchain is, in my mind, is not an option. It's a requirement. And the reason for that is the only way that we can avoid a situation like FTX or a situation like any Ponzi scheme, because let's be honest, a lot of people in this world that are putting their money places are very scared where they're putting that money and is it going to happen to me? And so because of the way that blockchain shows you that audit trail, I hope that we never go away from blockchain. I hope we stop talking about it, because when you say blockchain, people hear crypto, even though they're not related, a little related, but not the same thing. And so it's an easier way for the ecosystem to grow if we stop using words like tokenization and blockchain. But the fact of the matter is that's the only way that we're going to make sure that this is done the right way. So kind of that double-edged sword.
I see it completely opposite, but completely opposite. I think the world is going to get educated much more into blockchain, much more into token. Composability of the token is a very important part of the proposition that we offer. I think that the wallet and the seed is a problem for the newbies in general, but abstract account that Vitalik announced a few months ago is solving this. With your email, you're going to be able to control your wallet. Now, the SEC has a set of rules that we have to play by, but the great news is the set of rules of the SEC is much, much more softer than most other jurisdictions in the world. They're not trying to hurt us. They're just wanting to make sure the consumer is protected. We have to play into the rules. But blockchain, we're going to hear more about it. We're going to hear more people saying, we want tokens more than a shares. We want to have self-custody of our goods. We don't want to have to wait for 9 a.m. for our broker to open and pick up the phone. I want to go on my phone on my computer at 4 a.m. and do my transactions. I want to put my tokens in there. I want to take a loan. I want to sell them. I want to be in charge of my destiny.
You know, you do agree with me. You just said it differently.
I think token is going to be the word, and blockchain is going to be here. Now, let's not let's not take something into consideration. Which blockchain is going to become irrelevant very soon? Today, you have Polygon, you have Gnosis, you have Ethereum. Like in 1997, you used to know where your servers were and which data farm you had your servers. Blockchains are going to be the same. You're not going to know in which blockchain you are, but you're going to know you're using blockchain. You're going to know you're using a token, and you're going to know you're using a cryptographic technology, blockchain technology.
You know, Matt, when I look at some other parts of the financial services industry operating in Web3 or operating on blockchain, I'm thinking particularly of like personal small business loans. You know, at one point, I've seen a couple of banks, or I've written a couple of stories this year, where they kind of got around the regulatory thing. Well, I should say, or they complied. I mean, really, they didn't really get around it. They complied by absorbing or partnering with a traditional bank that was already licensed to lend. Are we going to see more of those examples? Because I've kind of been waiting for that to become more of a thing. We've got traditional finance, you know, working hand in hand with blockchain-based finance digital assets.
Yeah, it's going to be a trend. Of course, it has to. You're going to see people with the traditional banking license, with brokerage license, insurance license going towards tokenization, just because of the ease of transaction and the cost saving that there will be per transaction. Just that is an incentive enough for this to happen.
And the time savings.
Right. You know, I'm going to take this to Matt. You know, Matt, what do you think is the next big opportunity? Like I said, I feel like we've been cooking on this one for a minute, because I've been hearing, I think the first project I worked with that was doing this was in like 2016, you know, so it's been on the precipice of going to happen for a long time now. And obviously it has happened more now. There people have been transacting with selling real estate and so forth. Yeah, but where do you think the next you know, big opportunity really is? Where do you see this growing into over the next few years?
The opportunity in terms of commercial real estate investments, which is really that's the foundation here, right? The underlying investment, regardless that it's in the form of a digital token, it's really the real estate. So yeah, I think distressed office and retail properties here nationally, I think there's a lot of potential. Personally, I think maybe Class A multifamily is going to be a strong asset class. Industrial logistics, I think we'll stay strong, and I think it always depends geographic location too, right? I think the northern half of the country versus the southern half of the country, or east versus west. Once you get into the details, you know, it's going to depend.
You know, and it feels like we've talked about the U.S. market, you know, quite a bit, and obviously I'll tend to skew toward talking about it, since I know it a little bit better. But you know, I can't imagine that that's necessarily where the best opportunities are necessarily on the buyer side or the seller side. And there have been other nations that have embraced blockchain more openly than the U.S. has, which has shown some misgivings about it, or at least certainly had a lot of regulatory back and forth about it. So where do we see, geographically the greatest growth starting? Ed, do you see, are there any areas that excite you? Take a Singapore or something like that, which has got kind of done a hard turn from being, very against blockchain to trying to be more open.
First of all, I think that your question about opportunity is that all the assets, all real estate assets, in my mind, are going to be transitioning to the blockchain. So therefore, opportunity for service providers to get involved in that process, that transition, is a huge opportunity. And getting ahead of the game before everyone else is where you're going to really get the benefit of that. We're seeing a lot of opportunity here in the United States. Of course, sponsors are calling in. We're tokenizing a lot of assets. We've already tokenized about $5 billion worth of assets. Another $3.5 billion just came into our laps 2 weeks ago, and that's overseas. So yeah, I think that there's markets we like. We like the whole continent of Africa. We like the GCC. We like the United States. We like Canada. These are all, and we like Vietnam. These are all markets that contacted us and are interested in tokenizing assets. And we've had calls from France and other places around the world, but we have to kind of pick our areas where we have some level of knowledge and education. So I see a huge opportunity as all real estate transitions. The question is, who's going to take it seriously and get involved with it? And one thing Red Swan has done is really made a business out of transitioning these assets onto the chain, putting it on the marketplace so the investors can actually take a look at what assets they want to buy and actually start transacting to buy these securities. So the opportunity is happening today, and we're excited about it. And I think it's going to continue for the next, forever, because once you go digital, I don't see you unwinding, going back to an analog state.
Right. That makes sense. Yeah. I mean, Sam, at this point, it's kind of necessity, isn't it? I mean, I don't know, you give it 10 years, 20 years. I grew up, my father was a real estate lawyer, essentially. So he did lots of closings, title insurance, that sort of thing. So I kind of grew up around it. But I must say, it's a pretty antiquated system in many ways, much using of fax machines, much mimeography. I mean, it might be a slight exaggeration, but not much of an exaggeration.
No.
Go ahead. Yeah.
So I also moonlight as a real estate developer, owner, operator. I have built my company over the last 20 years, Fairchild Acquisitions. First of all, just the opportunity. I look at multifamily housing as a bond for life. It just is, right? Unless you buy bad in a bad neighborhood or significant economic changes happen to a neighborhood, you're going to do fine over a long period of time. Having an asset tokenized, like Remy said, just allows you to drive the possible liquidity event when you're ready, versus waiting for the 5-7 year disposition and capital event. I think the biggest opportunity in this world right now is actually debt. I've refied and bought a lot of assets over the last 6 months. And, it's funny because it's sort of an oxymoron, because the real estate industry is the backbone of the world's economy. Has always been, will always be, right? Just a fact. But it is the most inefficient industry in the world. Sure. So digital transformation is bringing efficiency to the most inefficient industry there is, but also the biggest industry there is, right? I think the last number I saw was something like 9.3 trillion in alternative investments across the world, right? So of which a big percentage is real estate. So I think the ideal play, and I've been saying it for 2 years on a lot of panels all over the country, is that a blended cap stack, a multiple token offering where you can not only have a piece of the debt, but you can have a piece of the pref and you can have a piece of the mezz, and you get a blended rate of return in the 7 to 9%. You're solving a lot of problems. The biggest problem today is not lack of supply And it's definitely not lack of demand because everyone wants to buy. The problem is that banks have taken the LTVs from 75, 80 even down to 55 or 60. The DCRs have gone from 115 to 130, and the cost has gone from 4 to 7. So I'm not saying let's provide cheaper money and let's make riskier loans. What I'm saying is let's use the digital platforms that have been created to allow financing to be more efficient, investing to be more efficient, and operators to do deals for transactions to happen better, faster, in a more efficient way.
And to add to what Sam said, we believe that a token needs to have a life on its own. The real estate asset itself, or whichever asset for a fact, is not going to move once it's tokenized. The tokens will be moving. The asset will stay in place. So tokenizing asset is great. But if you tokenize an asset and the asset doesn't move, it has no real value. You could put 25 billion on the platform. You need to give a token a life to this token. How do you give life? You bring the demand for those tokens. You bring the lending, you bring the secondary market, you bring the liquidity. This is where the big transformation is. And each token, each asset has to live on its own as a total separate offering. That's the way we see it. And what I mean by this is, like Sam said, you have access to the liquidity whenever you want. The asset, you don't need to wait for 50 owners to say, oh, we want to sell. And then they all sign. Here you have 5,000 owners or 2,000 owners on a property, and you want to sell your own asset, you're free to do it without impacting anybody else. Those are some of the major change we're going to see.
Yeah,
go ahead.
I just think, just to talk on that, I think this basically what I do when we take on projects is really to spend time with the sponsor to understand what their needs are, because managing your capital stack and building your capital stack is very important to a sponsor to make sure they have the right amount of debt, the right amount of equity, as Sam said. And so I think tokenization can play a very important part of that, whether you're tokenizing equity for the project or you're tokenizing the debt on the project, but it allows for optionality for both the sponsor as well as investors coming through the door. And I think you look at family offices who just have the option to buy into an asset. They don't have the ability to sell that asset when they need to sell and get out. They always have to wait for the sponsor to sell the property. And as a broker for 20 years, that could be a 9-month process. Well, if COVID's hitting in 2020 and you're trying to exit out of hospitality, waiting 9 months, you waited too long. Having digital assets and be able to turn the corner and sell at the demand of the market. So you might take a haircut, you may not, but at least you have that optionality. And I also want to point out the fact that we go to IRA events, we go to broker-dealer events, many of them, 80% don't know what digital assets are right now. They're learning. And but we're showing them that, look, you're offering these analog securities to your investors. If you gave them the option to say, you can buy this for $50,000 shares in this particular development project, and it's analog, and basically you're going to hold it until the sponsor has that liquidity event, or you can buy the same digitized version for $50,000, and it gives you the option for liquidity. I would say 9 times out of 10, even if they don't know what it is, they're going to take the option that gives them that liquidity. So it's just a matter of educating the market as to what the advantages are of digital securities. And once you explain it, I think people become hooked and sold. That's the kind of success we're having on bringing a lot of deals on chain.
And the access to the underlying assets, data and documentation that goes with it, right? I mean, in today's world, people want the access to financials when they want to see them. They want to be able to log in and see, okay, this is how they're performing. The rents are up, the rents are down. Here's what collections are. Because of blockchain, because of how you can push data into the token itself, into the owner's portal, they have that access. And, so the institutional investor that's making $1 billion allocations into REITs, they may get decent information, but not the information that we're talking about here. This is real-time valuation. This is real-time data in a real asset that you can touch, feel, and go see if you want to.
Right.
And
sure.
only thing I want to add to Sam
Well,
is
let me go over.
I don't want to log into a centralized platform. I want to go on chain and be able to look at it without relying on a third party to be able to see my asset. If it's not on chain, I don't trust it.
Well, let me take that question over to Matt. Because I'm wondering about this. I mean, I know in a nutshell, just from having been around the industry long enough, if there's any single reason why the real estate industry becomes so Byzantine in terms of its regulation, its processes, and its forms and so forth, is because there's a lot of it is very much not decentralized. You have a system of gatekeepers that have to approve at various points over and over and over again. That's how you end up with a lot of faxed forms and having to overnight for signatures and that sort of thing. And now they're doing e-sign and so forth. But that's where it becomes so Byzantine and complicated. But at the same time, there is a reason for centralization. People tend to want to deal with individuals that they trust. That's how that's how things have happened up till now. Can that dynamic be replaced with a DAO, for example? Can it be replaced with a sufficiently talented enough smart contract, or with a voting system with investors behind the scenes? We certainly have the capabilities, but will the industry accept it? Will that ultimately be better, in a more decentralized form than what we've had up till now?
I would say absolutely. I think with time, more and more people will understand the difference between an unregulated cryptocurrency and a digital asset security. I think historic performance of a specific token that's tied to a specific property will be proven. People will start to trust the data that's on the blockchain, and like Sam said, being able to, and Remy, being able to access that at any time, 24/7, will be huge. I like the efficiencies created with smart contracts and, let's say, distributions in the form of a stable coin. One thing I like to think about is, if there's no question whether if you hold that token in your wallet, you're the one getting the distribution, right? And if I send that token to you, well, now you're the one getting the distribution. I don't think you need intermediaries at that point to look over lengthy legal contracts and go this back and forth, and to take weeks at a time in order to do that transaction. And then if let's say you move, or your bank account information changes, or your mailing address changes, that doesn't matter, because your digital wallet is your digital wallet. I don't need to contact the sponsor, the person who sends the distributions to, maybe it's hundreds or maybe it's thousands of investors. That sponsor, with the click of a button, can shoot out that distribution to all of the token holders directly to their digital wallet. And so it's just going to take time. But I think that's why we do these panel discussions and educate others on the benefits of blockchain and why this all makes sense.
Mm-hmm. You think it's going to lead more people into investing in this space, Matt?
Will what lead more? Will what lead more people?
The availability, the fact that there's more flexibility in terms of getting in and out, that you can get in at a lower threshold. It seems like there's less resistance to investing in commercial real estate than there once was. It's the kind of thing that you would imagine you'd have to be in a certain tax bracket in order to be able to do. Maybe now, not quite so much.
Absolutely. I also, again, with time, right? Because when we look at, we always say, when is this going to take off, right? A lot of us have been in this for a number of years. The industry has grown, but it hasn't grown as quickly as we had hoped. But also, if you think about when we're selling tokens right now through an offering called a Reg D 506C, which we verify the investor's identity. We verify that we have a third party verify that they're accredited. And the ownership shares are non-transferable for a year. So I think there's a lot of people right now. I think Red Swan, I can't speak to Realty, but I know others who are tokenizing commercial real estate investments. And because those shares aren't transferable for a year, there is no liquidity because of regulation. And so in 2024, those that are tokenizing now, you might see some liquidity begin a year from now, because again, due to regulation, they're non-transferable anyway for 12 months.
Mm-hmm.
We focus on Reg S.
Right. Oh, well, there you go. And I think with the Reg A plus tier 2, you can raise up to 75 million, and those are available to non-accredited investors and accredited alike. and are, I believe, tradable from day one. So
Right.
that's the route to go.
Right. I mean, of course, guys, there's a really high profile trial going on this week that it almost seems like an omission to not mention some way or another. I think, all of our relatives, if they know nothing about blockchain, might know the words blockchain, Bitcoin, and Sam Bankman-Fried. So, how do we, we're trying our hardest, right, to come at this from a point of view that should be miles away, should be universes away from what went on there. How do you explain that, Ed? Because I bet you've been asked. I mean, if your family's like mine, people probably asked you about it. They kind of lump it all together like it's all one thing, like digital assets are all one thing. How do you make that differentiation for the layman?
Well, first of all, you have to let them know that there's a difference between digital asset securities and cryptocurrency digital assets.
Right.
A cryptocurrency digital asset could be in your wallet, and if your wallet is stolen or you lose your address, that money is gone. A digital asset security that's in your digital wallet is on an address, and so it's whitelisted. So if you lose your keys to your wallet, it can be burned and replaced. So it's just like a stock certificate. So I think once people understand that what we're bringing to the marketplace is like a stock that's registered with the SEC and compliant, that will change the mindset, because crypto has been out there such a long time and people have been kind of unfortunately burned by some crypto. But now when they realize there's another product out there, there's safer, much more regulated, and also there's a much more variety of options, I think they'll start moving in that direction. I mean, the problem with digital securities is that there's really not a whole lot of product on chain. So on the other hand, cryptocurrency has thousands of cryptocurrencies on the marketplace. So if you're really trying to get involved in digital assets, I think our job, all of us here, even Remedy, is to put more assets on chain to make more optionality available to retail investors, to institutional investors, family office investors. The more you see optionality, the more you will be interested in buying this type of product.
I think that Justin, if I can jump in, I think the difference is night and day, right? I mean, if you're trading cryptocurrency on Coinbase on a daily basis, how much due diligence are you doing, A, and how much information are you being given, B, and C, what is the underlying value? What is creating that value? What is it tied to? We're talking about digitalizing the ownership of a real physical asset that comes with it documentation and books, real accounting, and an audit trail. So what did everyone do wrong with FTS? I don't think we have enough time on this panel to get into all of it, but very simply, there were no books,
right?
There were no books, there was no regulation, there was no due diligence done, period. So again, you want another great example, Valley Bank. Had they had information distributed, there probably wouldn't have been a run to pull the deposits out when if you knew what their plan was and the communication and access to that data was available to the investor.
All right. Well, thank you so much, gentlemen. I really appreciate you taking the time to share your thoughts and experiences with me today. It's been great having this discussion with you. Thank you for joining us. We really appreciate it.
Thank you.
Thank you, Austin.
Yep.
Thank you, guys. I'm Justin Roberti with Benzinga, writer-producer. Thank you for joining us. I think we're going to be switching over to the other panel, or we should be in just a minute or so. So I guess I will wait for that to happen, or are we switching over? Sam, are we switching over? Okay.
Or we could keep going.
Or we could keep going. All right, that's fine with me.
I'll just give a shout out to the security token market team for producing this amazing event and giving us the opportunity.
Oh, definitely. It's great learning there. Remy, what are your views on decentralization? Do you think that ultimately, I think that DAOs could potentially be such an empowering boon for different kinds of retail investors at all different levels. You were talking about, a sort of a cross-chain future. you think ultimately a lot of this is going to have to come down, to DAO and DAO voting in order to work optimally?
I don't know if DAO voting or a DAO will be the vehicle that will be used, but it will be an on-chain vehicle. It will have a voting system, and like every vehicle, it needs a locomotive to make it go forward. So how is this going to take shape? It's going to be an interesting next 3-4 years before we see it. As the regulation comes alive, there'll be a much bigger guidance. But I do believe that voting rights, DAOs have a very potential future. I believe in decentralization. Obviously, you could hear it with the way I think about tokenization. Decentralization is key to the financial future.
All right. Well, okay. I think we're going to go ahead and wrap it up here. I think the other panel is starting as well. Thank you, guys. It's been fantastic talking to you. I hope we'll see you again soon.
Thanks.
Thank
All
you.
right. Talk to you soon.
We appreciate it.
Bye, guys.
Way for entrepreneurs who grew up in everyday cities like Phoenix, Arizona, where I come from before I moved to beautiful Miami. And it got me really excited. It showed me that this is a turning of the day where everyday entrepreneurs can leverage the power of the internet to raise capital. As we dug deeper, you started to realize that tokenization is a big part of that total equation, because I always tell people it's easy for an entrepreneur to say, hey, give me money today. The harder question to say is, how do I get my money back? And then we realized, kind of putting together the pieces of the puzzle, tokenization plus crowdfunding has the potential to change capital markets.
I love that. I can't wait to dive more into that vision and what you're building there. We're going to head over to Caitlin. She's with Republic. I'm such an admirer of Republic as well, because for those of you who don't know, they are one of the top 3, but maybe the largest Reg CF platform in the world. That's an incredible KPI, a stat to be proud of. Tell us, Caitlin, what should we know about you and Republic?
Thank you for the intro. I'm super excited to be speaking on a panel with all of you. Really knowledgeable people in this space who are of course pushing the limits here. In terms of myself and Republic, I started off in the more traditional ventures space working for a growth fund, and then joined Republic 3.5 years ago. And at the very beginning, really what we were most well known for was that crowdfunding platform, running deals through Reg CF. And then later, as we opened up our broker dealer via Reg D, Reg S, and Reg A as well. But what a lot of people don't necessarily know about Republic is that we have 2 other really amazing arms as well. We have a private capital arm that likes to invest into the deep tech and crypto space as well. And then also our advisory services arm, which focuses on bringing Web2 enterprises and helping them along their Web3 journey, whether that means bringing a token to market and helping them plan out the infrastructure and everything of that sort. But really the way that we are thinking about tokenization as a crowdfunding platform is to really give investors a different type of way to interact with traditional kind of equity assets that they've had before. So, being able to have more liquidity through secondaries trading, and also just a different, more tangible way to hold and kind of interact with your investments. So on our end, we've also started to open up security token offerings that we do on our platform, utility token raises, and Republic ourselves too have really dedicated to the mission by creating our own note, which actually is a token that allows for all note investors to get upside into the Republic portfolio specifically as well. So we're super bullish in the area and are excited to see kind of just like how investors adapt and adopt tokenization in this way.
Absolutely. I'll put your money where your mouth is and making it happen. I love to see it. And the same goes for Joel. You helped co-found Rialto, one of the almost really end-to-end ecosystems, putting it all together. You guys have done a lot to be able to make that happen. One of the leaders in the Reg CF, especially for tokenization space. Tell us more about yourself and tell us about Rialto Markets.
Well, interestingly, I think I'm the old guy on this panel. But thrilled to be here because the vision is the same. I just came about it from a different angle. I am traditional, unlike what Corey said, I am traditional New York, born and bred, capital markets, Wall Street, but it didn't take much several years ago to realize that that's not what's happening in the future. The new investors, the new generation, there's going to be trillions of dollars that are transferred to the next generation, and the next generation trades differently. They invest differently. They invest with their feet, they invest with their hearts, they invest in things they care about, and they want to control their investments. And we work with Republic. We work with a lot of these companies in there. We think that the groupings of our teams together and all the different visions that we have are really what's going to make this work, because crowdfunding is a new way not only issuers to raise capital and be able to be entrepreneurial as necessary, but it's also a new way for investors to diversify their investments and participate in areas that until just a few years ago they were not able to do. And to me and to us at Rialto, that's the most exciting thing. It's being able to take traditional capital markets to the next generation. And the next generation is not traditional. It may need to abide by much of the regulation. It may need to conform with some of the requirements, but nonetheless, it needs to think a lot more out of the box and a lot more innovatively in order to create wealth for the next generation and to create new businesses, new opportunities, and just new visions in all different industries. And that's what we're most excited about.
Yes, the term democratizing investing, I think, comes up. I completely agree with you. This whole panel, I think, is it right here when it comes to creating the new wave, the new generation of investing. And I want to stick with you a little bit, Joel, to go dive into the Rialto ecosystem. You gave us a little bit of the vision. Talk to us about how you built out the ecosystem and how we can take advantage of the unique positioning Rialto has built.
Yeah, so what we did is we are a FINRA broker-dealer. We operate an alternative trading system for secondary trading as well. And what we did really was we focused on how to bring all of those complexities and all the different parts of the ecosystem into one single place so that an individual investor can just go to do what they have to do, fill out whatever forms, and be able to have the whole process. So if you think about it, there are so many component parts to make sure that an investment can actually be done, whether it's escrow agents and transfer agents and payment rails and credit cards, ACHs, wire, whatever it might be, all the broker-dealer requirements. We decided that we're going to deliver the ecosystem for it. So the example that I use is actually, it's a sandwich. There's the bottom layer, which is the ecosystem and infrastructure necessary from an operational technological perspective. That's the bottom layer of bread. The top layer of bread is really the oversight and vision of a regulated entity to make sure that everything is working in compliance with what it has to get done to protect investors. And then there's the meat in the middle. And whatever meat you bring to the middle, that's up to the issuer, that's up to the investor. We're providing the layers of bread. And everyone else can bring in whatever they want, whether it's real estate, whether it's any ESG company, whether it's gaming, any kind of issuance that they might have, they can bring in and take advantage of the entirety of the ecosystem with all the requirements of legal, financial, payments, et cetera, and all the regulatory assurances of anti-money laundering, know your customer requirements, advertising, and doing all the things you're supposed to be doing the correct way. And that's really how we came about building the offering. And what we do is we offer not only to individual issuers, but also to enterprises. So you might be an enterprise that offers this solution to 20 different properties in real estate or whatever that might be. You can take advantage and white label what we have in order to help those companies raise capital and in order to help those companies trade in the secondary market.
Wow, incredible. And I know how much hard work has been behind the scenes in order to make that possible. I know Corey knows it firsthand too, going through the process. For those of you who don't know, a crowdfunding platform, it can be a broker dealer, but it also can sometimes be its own form, a broker dealer light, they call that. Corey, tell us about your journey going through setting up ChainRaise and how you dealt with all of that.
Yeah, absolutely. So we are not a broker dealer. We are a licensed crowdfunding portal. So when we kind of took a step back and envisioned what online capital raising plus tokenization can look like, we said this needs to be an ecosystem. And then we drew that ecosystem out, saying that the online capital raise is the first part of that ecosystem. So that's where we put our initial focus and emphasis on, is building out that RegCF platform, getting it licensed through FINRA, which of course allows companies to raise up to $5 million from both accredited and non-accredited investors. In addition to that, the tokenization and cap table management software is being built out right now, which then gives the companies that are raising the capital the ability to manage their investors. And we built it like this on purpose, knowing that even for a company to be able to trade, it takes 12 months. So you need to get the companies in the pipeline first before you even build out any other parts of the tech, if you want to be that full ecosystem. Ideally, we do want to partner with a company on the ATS. I'm not ready to wear all the hats of being a broker dealer. I salute someone like Joel who is. FINRA, God bless them. They are fantastic. When we got into the space, a lot of people warned us about FINRA. I will say almost all of them have been completely wrong, because FINRA has been a really great partner to us and has helped us work through whatever we need to be able to get licensed. And we really feel like we have a very collaborative relationship with them. With that being said, a RegCF portal is a fraction of the amount of compliance work than a broker dealer. But of course, we do look at ourselves as an ecosystem being built. At the end of the day, I do think that ability for a company and for an investor to be able to not have to switch from one platform to another is extremely important, because who wants to go through KYC all the time? No one does. It's a cumbersome process that investors are not excited about. It's one of those things that you have to do it. So the less that you have to do the ugly work, the better. But the idea of being an ecosystem is what excites us, and the ability to also have that investor dashboard in the middle, connecting that primary offering and that secondary market, I think is also really crucial too, because that's where you get the ability to almost own, probably not the type of word I want to use, but you kind of get the ability to own the investor's attention and the issuer's attention. And I think that's really important in terms of building that relationship with both the company and the investor. When I take a bird's eye view of why this space is so impactful, I think it's because of the lack of data and clarity when we do private investments. I was on the phone with one of my buddy's companies I invested into about a week or so ago, and I'm asking him, hey, how's the company doing? How much capital have you guys raised? And then I get to the ugly question, saying so how much did I get diluted? First off, he didn't even know how much I got diluted off the top of his head, because they've done a handful of deals where they brought on a new CEO. They done 2 rounds of investing. He's like, I'll have to go check the spreadsheet. I was like, oh my goodness. But that points to the importance of having that dashboard in the middle where you can be able to access that data as the investor without having to pick up the phone and go ask someone for this. But yeah, so, getting that license as kind of going back to the main question there, we ended up getting licensed as a crowdfunding portal, and over time we will build out that full ecosystem, ideally being a broker dealer, just kind of waiting until, everything makes sense on paper, because it is a lot of work.
Yeah, totally. And that's a similar story for most crowdfunding platforms that have come to market, and props to everybody on this call. And Corey, there really aren't that many folks. Not many people are willing to go through the work of getting that crowdfunding portal license, maintaining that, or going the full kahuna with the broker dealer's license. I think Republic is a perfect sort of scenario there of starting out that way. But now I can't even count the number of acquisitions. Recently, we saw earlier this year a notable investment into INX. Please, Caitlin, shed some more light on the future of the platform of the Republic.
Yeah, absolutely. I think that really a lot of the developments that have been made on the Republic side of things are really in the name of tokenization. So the investment we had made into INX earlier, the ATS that we are really looking towards for being able to open up a secondaries platform is very, very important to that all. And then we also revealed a few weeks ago as well, the Republic wallet. It's a self-custodied wallet that is super easy to set up. If you ever go through the flow, it really just takes a few minutes. And we've created this because we want investors to have a really nice experience and flow from being able to invest while also becoming token holders at the same time too. I think that so many companies are looking to move down the path of tokenization, but there aren't necessarily a lot of players in this space who have a coherent investor experience that really supports that. So with the wallet, being able to prompt investors to create a wallet within seconds while they're making their investment, being able to drop the token in there, and then opening up that secondaries exchange so they can actually trade and kind of liquidate that asset is something that we see as some of the main pillars of our investment platform, in the coming future. And it's something that we're really excited about. And so now it's really about getting a lot of our issuers on board, and then also just finding the people out there that are really looking to raise in this type of way, and raising up education in the area as well. I think that there's always going to be investors who are really excited about a new technology, but then we also have a lot of our really amazing legacy investors, who we want to be participating in these token raises, in the same way as well. So, a lot of focus on creating a nice and cohesive experience in that sense.
Oh, that makes total sense. And I think everybody watching is starting to see the vision come together about what it looks like for regular folks to be able to invest in opportunities that just never existed, not without you helping make that happen. Naturally, we're going to head over to Laura here. You're unique because you don't represent a crowdfunding portal here today, but you do play a very important role. So please, give us a little bit more insight to what Upside does and how you work with Public and others.
Yeah, so let me start with Upside. And Upside is a technology infrastructure, purely blockchain based. We have 28 brilliant minds on our team across 9 countries. The company was founded by Noah Thorpe in 2016 as a venture studio. So Noah's background, he worked for Google, he worked for Apple, he was the VP of engineering for NASDAQ. He and his team built out the tech stack for what's now NASDAQ Private Markets. Most recently, he was a CTO at Republic and developed Republic Crypto. Over the last 8 years, Upside has tokenized upwards of 50 projects, successfully launched nearly 2 billion in tokens, security tokens, as well as utility tokens, and deployed on several blockchains, including Ethereum, Polygon, Algorand, and many of the other major chains. With that, distributed over 1.5 million blockchain addresses, right? So really incredible what they've been doing. Over the last 12 months, we've been hyper-focused on real estate securities and currently putting the finishing touch on a compliant marketplace platform specific for tokenized real estate, where issuers and investors are going to come together. So specific to real estate, yes. Fun fact about Upside, they, in conjunction together with Republic, launched the first tokenized offering under Reg CF. So really amazing things that they're doing. The team is brilliant. I'm so honored to be part of what's happening here.
The first tokenized Reg CF, and clearly Upside, critical infrastructure to power all folks, is the behind the scenes stuff that makes a lot of these things possible. It's the licenses, it's the technology, it's the blockchain, it's all coming together. So I want to stick with you, Laura. I want you to give us some insight to what you believe, the future holds for crowdfunding markets. What does 2024 look like? You're clearly knee deep in the challenges and helping create the infrastructure. So, get us excited. What can we look forward to?
Yeah, I really feel like with what's happening with the CF and with tokenization in general, the idea that we're going to make the efficiency of investing in real estate, trophy assets, commercial assets, things like that, efficient, democratizing, the ability for everyone really to do that, right? US investors, foreign investors, accredited investors, non-accredited investors. CF allows the almost, you know, it's also being used as kind of like a bootstrap to fund subsequent larger raises through like a Reg A, for instance, right? Being able to raise capital and then not only launch under the CF, but under other, you know, subsequent crowdfunding type of raises as well. My vision and what I really love most about what's happening in the space for CF, and I'm really more focused on the real estate side, is that the social cause behind what we can do with the technology and with the regulation, right? The idea that there's these really large developments that are out there, and they could be fully funded, right? But the idea that they're willing to offer a tokenized offering under a CF raise and allow for community participation, there's this massive social cause behind that really contributes to the support of the community getting behind the real estate development, right? Or getting behind potentially living in a apartment building, or, you know, traveling to a hotel, or, you know, all of these different aspects of it that, for me, I think my driving reason and force behind it is truly to share and democratize this whole experience, especially in real estate, because of, you know, the history and how important that asset class is for investment and wealth and et cetera, et cetera.
I think it's obvious to everybody how passionate you are about that. I think I can speak for everybody that we all love that insight and that cause. You know, the social causes is a huge angle to all of tokenization. I think that's under talked about. Unfortunately, we don't have too much time to go into further on that. I want to head over to Caitlin. What do you think in terms of the future of the market? Do you see, you know, the number of Reg CF issuances exploding? Do you see a continuous slow, you know, kind of growth organically? What do you think is going to be in store for 2024?
Yeah, that's a great question. You know, I think it's amazing because Reg CF only came about in 2016, really. So we've been able to track the story and get a good grasp of it thus far, in a more intimate way. And so being able to track changes is very cool on that. I would say that historically, we've oftentimes known Reg CF as a security exemption that startups would take. You know, I think that, you know, democratizing access to private companies in that way has been really amazing and something that excites, you know, the investor base a lot. But I think something that's really exciting that we're kind of moving into a second phase of, especially with the tokenization aspect coming into play, is the ability to fractionalize and invest into real world assets. You know, it really does change the game, because I think traditionally with startups, you have a much longer hold time. You know, you don't get that immediate liquidity, and you also don't get that immediate like revenue as well, because you know, startups don't necessarily pay dividends, right? So, you know, it's a pretty long-term commitment that you have to make. But now with the technology and tokenization and the different partners in the place, in this space, it makes it really easy for investors to get access to those projects that, you know, they will have liquidity in, you know, being able to liquidate their investment quite quickly. And then also at the same time too, we'll be able to see revenue in the form of dividends and payouts pretty immediately. And so I think that because of it, it just gives investors with a much different risk profile, you know, finally an opportunity to play in a space, and also allows for different types of diversification for non-accredited investors. And because of that, I think it's a really, really exciting application and kind of new phase that we're seeing with Reg CF.
Absolutely makes a lot of sense. The liquidity has obviously been a topic all day long. You're able to introduce that element. I completely agree. It just makes it, less risky or more affordable for people to actually participate when they don't have their money locked up permanently in some cases. Joel, do you agree with that? Do you think liquidity is that missing piece that might help unlock and really firepower crowdfunding markets, or do you think it's something else? Give us your thoughts.
Well, I definitely think it's something that can unlock the firepower, as you say, of those markets, but it's still not here. And it's going to take a little time to get here, and that's fine. We'll work through it. But one of the key components of that liquidity is, I think Caitlin was touching upon this. If you go back 20 years, the average time that a company stayed private was about 4 years. Now it's a little more than 13 years. So back then, 20 years ago, if you were investing in private securities and you were looking for a liquidity event, the question you would always ask is, what's your exit strategy? And someone would say, well, I'm going public in 4 or 5 years. You can deal with that. Well, now they're saying I'm going public in 13 years. I have to pay college tuition in 3, right? I'm looking to buy another home. I'm looking to, whatever I'm looking to do, I'm going to need my money a lot quicker than that. So having control over your liquidity, over your exit strategy is so essential. And I think that is the key, is to be able to control your own capabilities of getting some kind of liquidity. And there may not be any real liquidity out there, but at least you're not beholden to the other side. The markets themselves and the ability to, remember, a dozen years ago, a whole bunch of people in the United States and across the world weren't even allowed to get involved in these. Regulatorily, they were prohibited from getting involved in these kinds of securities. So now they're getting involved in it. They're able to participate. Now they're also going to want to look to say, well, I don't want an exit strategy in 13 years. How do I get, well, we're giving you control. It's empowering the investors. But what I want to touch on, one more thing that I want to touch on, is a more grandiose picture of what it's going to look like. It's not just about Reg CF. It's about, as you started with, democratizing the market. How do we get retail involved in the market? Currently, alternative investments, I think it's a McKinsey study of last year, $11 trillion in alternative investments. 220 billion of that is retail. 2% of the alternative market is from retail. That's a lot of potential to get retail involved. Reg CF is one of the ways to do that, getting people involved in funds that they could not touch before, alternative investments, real estate investments that they couldn't get involved in earlier. All of these things are opening up the entirety of the community and democratizing the markets for access. That's the key to this.
Control and access. I think that's a fantastic insight. We need to let entrepreneurs know that this technology exists and it works. I totally agree. Corey, I want to ask you around a similar topic there around liquidity. There was a thesis out there. I think I agree with it. The more holders you have of your security, the more that will potentially impact liquidity, right? There are potentially more buyers, more sellers, more interest versus having, say 3 investors locked up, holding up your tokens because they're waiting till the end, right? So that's not going to help anybody. Do you agree with that? Tell us more about the role you think the crowd plays in this whole liquidity, challenge.
Yeah, so 2 things I want to touch on with that. Of course, for a secondary market transaction to occur, you need sellers and buyers, right? So sellers, the more people that own a token, the more potential that someone wakes up and says, hey, I want to sell today, right? What I think is actually more the bigger thing that I want to put an emphasis on here, and I think this is for the whole space as a whole, is creating the desire for people to buy these assets. Because at the end of the day, we can build all this technology in the world, but if someone doesn't desire the asset that is being offered, all this is for show. And, so when I think about what I hope the future of digital capital raising and tokenization looks like, is a heavy emphasis on good old digital marketing and crowd building. Because, once again, if people don't want to invest, that is that is what we need, right? And so one of the things that we really try to put an emphasis on with Chainraise and with our issuers is educating them on what it takes to build an audience, instead of the reverse of that course, which is just showing up one day and say we have an offering. When I take a look out there, I think people are starting to understand that. And you see people that are kind of in this real estate space / influencer, they have the social media channels and presences. They're starting to realize that when they take that following that they built on Instagram, on YouTube, or anywhere else on the internet, and they reapply that towards investments and raising capital, it is extremely lucrative, and that result can happen extremely quickly. But at the end of the day, though, that comes from building an audience, building trust, building conviction, and then asking them, hey, do you want to invest with me? Or a good company. A good company builds up trust with their customers, and then they say, hey, listen, you love our products. Now, do you want to invest? There's no shortcut around that. At the end of the day, all the technology is smoke and mirrors around the ideas. Does someone want to invest? And that also continues into the secondary market, because if you are an entrepreneur who wants to tokenize your company, you are effectively responsible for creating that demand in the secondary market, whether that is through press releases, partnership announcements, acquisitions of other companies, reporting your growth in your revenue and your profitability, or whatever it may be. It is ultimately your responsibility to create that demand in the secondary market. So when I look at what I hope the future of this space looks like as a whole, is helping entrepreneurs understand you have to leverage the power of the internet to get people interested. But beyond that, you ultimately have to, sometimes shake the hands, get on the phones, do whatever it takes to get people excited to be a shareholder. And there's no shortcut around that.
I completely agree. There's absolutely no shortcut around that. I even think more companies that are already tokenized in space can take a page out of your advice here and do an even better job of that. I want to do one more round robin that we got time for here. I'll stick with you, Corey. And again, great insights from the panel: desire, control, liquidity, social causes. It sounds like we got the recipe for unlocking crowdfunding markets. Awesome stuff. Corey, leave us with your favorite use case that you've seen of a regulation crowdfunding campaign. Can be a completed one or a live one. Obviously, none of this is investment advice. Everybody that's watching, this is just to highlight what everybody likes, what they see in the space.
Yes, great question. You're going to put me on the spot here. When it comes to one of my favorite use cases, I'm going to think about one that everyone can apply to and everyone can resonate with. And that is the local business that they frequent on a consistent basis and being able to enjoy extra perks for being a token holder of the said restaurant, whether that's preferred seating, whether that's some sort of discount or drinks or whatever it may be. But the ability for someone to actually gain a benefit from something that they haven't invested into is a really nice benefit. And I'll tell you why that's so important. When you really think about why early stage investors typically invest into said company, it's usually because they're connected to that product from a personal reason. At least that's what I've seen from angel investors. They're investing into something that they want to use themselves. So to be able to help them have a written out incentive, something that is literally structured into kind of their rights as a shareholder, is something really nice. And, I think a restaurant is the most easy for everyone to understand type of incentive, because who doesn't want to go to their local restaurant and get treated a little bit more special?
I absolutely totally agree. Benefits are what, and that's where crowdfunding started with, right? With Kickstarter, the idea that you're going to get something for backing it early. We got to marry the two. I want stock and I want benefits. I think that's what makes people happy. Totally agree. Laura, you mentioned social causes. Obviously, real estate is near and dear to your heart. Lots of great use cases there with offering hotel stays, benefits, and discounts. Tell us an example of a company you've seen or a use case that you really love for regulation crowdfunding, maybe one that's utilizing the social causes side.
Yeah, I really feel like there are real estate developments out there, like I had mentioned earlier, that are large, hundreds of millions of dollars in valuation, right? They're building huge resorts type of offerings. And the idea that they would consider a CF offering to allow participation of the community or participation around that cause. These are eco-friendly, right? We have another that we're working on right now that's a surf resort. I mean, the idea that we're going to provide the opportunity for those who really love and are passionate about the cause to participate in the real estate development and the success of that real estate development is, I just think that's game changing. You get the community to rally around you get the community to rally around the project, as opposed to, what we see a lot in real estate development, a lot of opposition, a lot of people in the neighborhood don't want that particular building to go up in that particular location. So, the idea that they can share in the success is, I just think that's game changing for the industry.
I find it hard to disagree with you. I think that's phenomenal insight. Joel, I'm going to head over to you. You can even cheat because I think you have a Reg CF of your own, but you're welcome to call out any example you'd like.
Yeah, actually, I'd like to sort of take a similar avenue that Laura took, but with a different industry or different concept. There are many private equity funds and a lot of the funds that retail investors have always read about that everyone's getting rich off of. And now we're working with some funds that are democratizing. They're tokenizing their fund so that they can get from investments that were minimum of $250,000 to minimums of $2,500. Because they've been tokenized and they've created this. And there's a lot of work, a lot of legal work that has to be done in order to make sure this happens. But when it happens, imagine, for example, we're working with a company that does carbon credits. How do you get involved when you're a retail investor to really make money off of that kind of world? You have to be able to get involved in a fund that invests in a whole bunch of different things. Well, those funds are really pretty much closed to anyone who's only willing to invest even up to $10,000. You're not going to be able to get in. But here we're tokenizing it. We're bringing it to the retail segment. And now this entire fund market that really was designated for PE firms or hedge funds and all those things that retail investors have read about but have never been able to participate in is now being made available for their participation.
Absolutely awesome use case. The institutional playground was always an institutional only club. Even private markets, maybe many argued, were the accredited only club, right? It wasn't until Reg CF truly enabled this democratization. And now what you're saying is we're going to be able to jump right to the front of the line and get those institutional deals. I'm looking forward to that. Caitlin, we're going to head over to you. I'm not going to let you use the Republic Note. I'll give a quick promo because I think the Republic Note is very cool because it gives you a chance, and it did do a Reg CF, a chance for anybody to get exposure to the collection, the portfolio of companies that Republic has helped raise money for. So they actually have exposure to those companies directly, and through their note offering, you can get exposed to that whole basket. Super awesome use case. Love it, but you can't talk about it. Give us another one, Caitlin.
Thank you for that shout out. And yeah, I think I think the use case that I would probably choose is one that's pretty personal. I've always been really interested in the music industry, and we actually were able to do a music offering on our platform. We raised money for a pretty well-known rapper, Lil Pump, his song on the platform. And I think that it was a really amazing use case, I think, both on the fan side, where he was able to involve his top listeners, people who wanted to be able to say that they owned a piece of a song made by one of their favorite artists and be able to see the economic upside of that. I think that aspect of it does create a really amazing flywheel because you automatically have those champions that are going to be listening and streaming to the song or whatever release it is on the day it comes out. But also at the same time, On the flip, for artists, I think there are a lot of financing industries that are pretty dated. We've seen with the strikes that are going on with the Writers Guild, I think there's a lot of unfair contracts that people within the creative industries will enter into, and a lot of that has to do with funding and kind of the rights that they're giving up at the very beginning stages. And so I think that through crowdfunding, being able to tap into someone's natural audience that they've garnered themselves over time, and not necessarily having to rely on maybe more predatory labels or kind of producers that they may be working with, really allows for both the artists and community to benefit in that way. And so I think that crowdfunding really does provide an opportunity and an avenue to shake up some pretty dated, funding avenues and industries that have kind of been waiting for a change and, have been wanting a change for a while now.
Yeah, no, I love that use case. Unlocking, specifically the music industry itself has its own issues and its sort of monopolies. So again, democratization there, I think, is an awesome use case. Well, with that, folks, we are out of time. I was hoping to maybe get in a few questions. So for those of you who do have questions in the audience, I highly encourage you to reach out to our panelists here. And if you haven't put it together, we haven't been doing a very good job, that you today, it doesn't matter who you are, whether you're accredited or an institution or none of those things, there are great opportunities available for you to invest in, many of them tokenized, Chainraise, Republic, Rialto Markets. That's where you got to go check out some of these amazing opportunities. Again, not investment advice, but just knowing how great you all individuals are, I'm sure it's the same for the deals on the platform. So again, thank you all so much for joining us. Appreciate your time, and we hope to catch you all on day 2. Now let's head over to our closing statement for day 1.
Good to go.
All right. And that is a wrap on day 1. What an exciting group of panels. I mean, can we talk about how much sauce was shared across this first day? We started at 10 a.m. hearing, or 10:30 a.m. hearing from our fearless leader, Herwig Konings, opening statements on the amazing potential of tokenization, went right into my panel on ATSs and solving the liquidity problem. And then we went into a whole host of different panels with amazing speakers talking crowdfunding, real estate, and all kinds of tokenization applications. We had a keynote from JP Morgan talking about all of their different solutions. We heard from Oasis Pro Markets, or Oasis Pro, and their markets, their ATS, from our leading sponsor, as well as I want to shout out and thank all of our sponsors that are making the TokenizeThis conference possible. Those are Oasis Pro, as we mentioned. You see their logos everywhere around here on the frame throughout the day. We also have Block Time Financial, Fusion IQ, Invenium, and Red Swan. So very much thanks to all of those amazing sponsors that are trailblazing in this industry. And the reality is that we can't make media and events like this possible without the support of the industry. This really is a group effort, especially in a market climate like we see today. Because even though markets are tough and marketing budgets are slashed and the stock market is trading sideways, that does not prevent innovation from happening, as we've seen from the institutions on the panel today, and as we're going to hear from many of these institutions tomorrow, as well as the working session on Friday. Remember, this is a 3-day event. We've only scratched the surface on the opportunities here. Tomorrow, we're actually really putting a focus on that institutional adoption. If you didn't get enough of that intel from some of the leaders today, well, we've got a whole lot more for you tomorrow. We're going to be talking with BNY Mellon, Wisdom Tree, as well as talking with other companies and leading asset managers like Franklin Templeton. We're going to hear from STA's expert Peter Gaffney talking about all of the amazing updates going on in the world. He is maybe the leader in global research on tokenization and institutional finance leveraging blockchain technology. I also am going to be leading a great panel with the STM team talking about what we're seeing in the markets from data, from arbitrage, from opportunities on the secondary markets, looking into where the trading gems just might be found. On top of that, we're going to get into custody and solutions around holding these assets. We're going to hear from Invenium, have global opportunities to talk about regulation and regulatory arbitrage and what that could mean. We've seen all kinds of adoption around the world, from the APAC region to Europe and into the MENA region, which has been very, very hot as of late. So not to mention, we do, as I said, have that workshop on Friday where you're going to be able to be much more engaged. We've seen some YouTube comments of people asking, oh, my question didn't get answered. Well, we're really sorry about that. But unfortunately, most of these events, we've actually not even had time to get to too many of the Q&A from the crowd because of how passionate a lot of our speakers are. Well, Friday is the solution for you. We're going to be much more involved. As we mentioned, we're also going to be talking about the book. If you haven't checked out Blockchain Explained, it's on Amazon. It's on Barnes & Noble Kindle. You can get anything that you want, but this one is that paper version that is being taught at universities around the world, authored by your hosts here, myself, Herwig Konings, Peter Gaffney from the STM team. So check out the book if you want to learn more about the actual practical applications of the technology. And we'll talk to you tomorrow at, I guess, 10:30 to start bright and early for another 8-9 hours of nonstop tokenization intel to help you drive the future of financial markets. So from everyone here at Security Token Market, we thank you for tuning in. Please leave comments, like, and subscribe, and we will talk to you tomorrow morning.